Good morning, everyone. I'm going to probably use this mic here because I don't like standing. Let's see if that works. Testing 1, 2, 3. Yep. So good morning, everyone. I did meet Sam Zell yesterday. That was an amazing meeting. I have met Sam Zell before. In fact, the reason I wanted to see Sam yesterday is I have a new book coming out here. Just actually launched this book about a month ago called The Intelligent Reit Investor. And many of you are probably familiar with The Intelligent Investor, which is Ben Graham's legendary investor, Ben Graham. And I autographed the book for Mr. Zell. And he has, again, a testimonial right here on the back of the book. He obviously knows a thing or two about REITs because he's serves as chairman of two of the very high profile REITs that we cover in our REIT coverage spectrum. And so I told Mr. Zell that everybody's familiar with his name, The Grave Dancer, and I said address the book, Mr. Zell, the quintessential value investor, which is really what he is and what he aspires to be. And you'll have to read my blog today, but I did write up 3 secrets that of Sam Zell's success. So let's move on to net lease. And this slide here is actually where I started about, literally, this is the first net lease deal that I built. I think it was around 1990. There's a company called Advance Auto Parts, which was privately held at the time, headquartered or based in Roanoke, Virginia. Built this store. I was right out of college and wanted to get into become a developer. And so that was actually a 10-year lease, gross lease. At the time, again, Advance Auto was not publicly traded. They weren't investment grade. I think we looked at a D&B to see, how the companies, whether they were profitable or not. But anyway, I built that store, and that was really the catalyst for my career in not only in net lease, but just in real estate in general. So I became a developer, and over the course of 20 years or so, maybe a little longer than 20 years, I built multiple stores for Advance Auto, Family Dollar, Blockbuster, did quite a few of those, Hollywood Videos, primarily in the Southeast, as you can probably hear. I'm from South Carolina, and so I focus primarily in those Southeastern markets. Learned a lot about how to construct net lease buildings, hire architects, engineers, all of those things. And, we ended up building more multi-tenant properties. I remember I went to a little town called Coleman, Alabama, to build a Blockbuster and an Advance Auto. And I found this piece of property that I ended up building a Payless. Long story made short, I ended up becoming more of a shopping center developer because I could generate better returns using the economies of scale. Now, this is, so I pivoted to REITs back in I call it 2009 or 10 as a result of the recession. Won't bore you on all those details other than the last 10 years I've been covering these companies, these REITs, net lease REITs. You can see here the growth of these net lease companies like Realty Income, National Retail Properties, Agree, Monmouth. I should have had WP Carey on here. I know that. I want to point that out. But I think they're on one of the slides here, hopefully. But obviously, you got some stalwarts out there like Realty Income, National Retails, and WP Carey, who have been around a long, long time. So again, I guess the difference between me and your typical analyst or writer is that I've actually been in this business. I built a lot of this stuff and understand how these buildings and how value creation is really done in this space. We can go to the next slide now. Here we go. Thank you. This is just an evolution we've seen of the business model. I do have WP Carey here. I want to point that out. 1973. Realty Income goes back to 1969. They didn't list until later. And of course, Monmouth, which has been in the news quite a bit, more of an industrial REIT, but obviously they've been focusing on a lot of FedEx and logistics. And then you can see National Retail, a lot of these companies, EPR, Spirit, I'm sure you're familiar with a lot of these. Then really during the last recession, the Great Recession, I should say, you saw a lot of this capital starting to really come into this space. And a lot of that was due to the non-traded REIT space. A lot of these non-traded REITs were very active in 2009 and 10. obviously because they didn't have that volatility with being publicly listed. So we saw a lot of those companies start to raise capital. And then you can see Essential Property Trust listed just before the pandemic. And then in 2020, you see there's actually, next slide, please. There's actually been a number of new net lease REITs formed last year during the pandemic. This is actually an interesting slide, and I stole this from Realty Income. I've sourced it down here. But this actually shows to the left the size of the European market. I just got back from Paris. I was in Paris in Spain last week, looking at some properties there, and pretty amazing market there. There's $8 trillion of opportunity there, and around $4 trillion in the U.S. These are all property sectors. It does include office, retail, as well as industrial. And then in the U.S., there are really two listed REITs, one of those again being WP Carey, and now Realty Income has become more active in that market. Realty Income, of course, doesn't compete directly with WP Carey. WP Carey doesn't have as much retail exposure, which has actually been a good thing. But you can see the size and dominance of the net lease space as it exists today. And again, that's just the flight to quality of these net lease properties. We can go to the next slide. Another area that really has interested me, I was just back from Vegas about a month ago. Actually, this will be my second conference since coming out of COVID. I was speaking at the Money Show, and I got to visit some properties in Las Vegas. Vici is a very large name in the gaming sector, and really gaming is a subsector of net lease. Vici just announced fairly recently a transformational merger with MGM Growth Properties. Of course, MGM came about by way of the MGM portfolio, and which is how they listed, and Vici came about by way of Caesars. When Caesars had entered bankruptcy, they spun off the real estate into this Vici REIT vehicle, and then they have gaming and leisure properties. So now there's three. There's going to be two. Vici also announced an acquisition of Venetian, which is one of the largest resorts in the world. And so when those close, Vici will become a very dominant player, not only in the gaming sector, but also the net lease space. I will add that although this is gaming, Vici in particular has really evolved into a more experiential business model. So they're investing capital in companies like Great Wolf and Chelsea Pier, if you know where that is in New York City, and some other properties that are more experiential in nature. I do suspect Vici and gaming and leisure, specifically Vici, will probably expand outside of the U.S. because there's a completely larger opportunity set there. Let's go to the next slide. This actually shows, I took this from a presentation from Vici, but this just shows the addressable market opportunity at the bottom. It's about $40 billion in gaming. So there's definitely a lot more opportunities for Vici and gaming and leisure properties as well. We can go to that next slide, please. Thank you. This is an interesting company that we began covering. As many of you probably know, that in December of 2000, and I think it was, can't see the slide there, I think it's 15 or 16, President Obama signed a law, part of the Tax Hikes Act, which disallowed C corporations to spin into REITs. However, before that law was removed, we had companies like Four Corners Properties Trust or Darden spin their properties into a net lease REIT. We also had a number of other REITs, Seritage, for example, with their Sears portfolio. And actually, I wrote on a number of companies like McDonald's and Target before that law was changed, because it was before that, I guess, loophole, we'll call it. There were a lot of companies that were looking to utilize the REIT structure to become more tax efficient, we'll call it. And so now Four Corners exists. They got in before that law was changed. And of course, now they've evolved into a much more diversified business model away from the Darden portfolio, which I'm sure you're familiar with those restaurant chains. So now they're buying more smaller franchise types of credit. But that's another change that we saw. Now you still can see REITs are able to spin REIT to REIT spins. So we've seen that with companies like Spirit, companies like Ventas, where they've taken, or even Simon and Washington Prime, they've been able to spin off some of the properties into a REIT. So a REIT can spin into a REIT. C Corp can't spin into a REIT. Let's go to the next slide. This is just some of the things we do at our research here. This is our kind of our performance chart. You can see all of these companies here and how they've performed, annual returns. Some of the more legacy names, Realty Income, National Retail, WP Carey, kind of how they've returned over 20 years. You can see that stability, by the way. And one thing that's really attracted us to this net lease space is, in general, we've seen around 10, 11, 12% annual returns over the many decades now. The great thing about net lease is they've been around a long time. It's a very simple business model. You can see the 10-year return, 10-year performance, moving on to 5, and then you can see COVID and EPR. Obviously, if you're not familiar with EPR, they have substantial exposure to theaters, which is one of the reasons that they drastically underperformed during COVID. Now, I will point out there's actually 2 net lease REITs that actually increased their earnings. The earnings metric we use for REITs is not core earnings. It's adjusted funds from operations. By the way, that's all in my book here. And so you can see here that during 2019, obviously most companies sold off. Monmouth actually did pretty well being in the logistics side of the business. But now we've seen a really nice, I'd say decent recovery, not a nice recovery. Net lease REITs today are generally undervalued still. We still see a lot of opportunity in investing in these net lease REITs. A lot of that has to do with what I call the misconception of the inflation fears, interest rate fears. Obviously, net lease is still recognized as a bond-like structure by Mr. Market, we'll call him. And so we've seen kind of this underperformance year to date. Again, so we still see more value with some of the equity there. Let's go to that next slide. Again, I mentioned last year we had 3 new players, and I think, frankly, there's going to be more coming. A lot of you in this room, or most of you in this room, are involved in the net lease industry in some form or fashion. And you can see these companies all listed. They all have different stories. NetStreet built a pretty nice portfolio use with some private equity money down in Dallas. Alpine was and that's ticker symbol NTST. Alpine was a spinoff of a company called Consolidated Tomoko, CTO, and they took their net lease properties into a smaller portfolio called Alpine, tickers PINE. Last one is Broadstone Net Lease, which aggregated through primarily high net worth investors. They built a very sizable portfolio, and they're more along the lines of a kind of a more of a smaller WP Carey, I'll call them. That's the type of properties they invest in, but they do have some retail, which of course Carey has avoided. Let's move to that next slide. Thank you. One thing we do also, we like to look at a lot of the net lease investing really comes down to spread investing. And so what we try to do every quarter is look at the overall cost of capital. Now, the first line on the left is the WACC, that's the weighted average cost of capital. So we take the equity, debt multiples for each of those companies and figure out what their cost of capital is. And then we try to apply cap rates based upon the earnings. We're now getting ready to go into the third quarter earnings season here. So companies like Realty Income, I'll use them again, ticker O. Their weighted average cost of capital is around 4, actually arguably could be lower than 4 today. And they're buying at about a 6.3% average cap rate, which generates investment spreads for them of about 230 basis points. And that's why we kind of use these models. By the way, the 21, 22, and 23, those are the analyst estimates for those companies. So we like to consider, what the analysts think, how those companies are going to grow their earnings as well. And again, with companies like Realty Income, National Retail, and WP Carey, you've seen a very stable performance, stable earnings growth, stable dividend growth. All 3 of those companies have been able to increase dividends for over 20 years or longer. But again, we're seeing now this list is getting bigger and bigger. Now, there is some recent acquisition news. Realty Income has announced they are closing on their Reit in a deal that should close in the fourth quarter of this year, I believe. And that'll be a significant deal, in fact, transformational for Realty Income. I just mentioned I just got back from Paris and looked at some of the properties. They did a sell leaseback with a company called Carrefour, which is essentially the target, I'll call it the target of Europe. They're also in Brazil and some other markets as well. We don't have specifics on those cap rates due to confidential reasons the company didn't disclose, but we think that is going to be a very attractive part of that business model, just like WP Carey, because they can access capital much cheaper in Europe than they can in the US. For example, Realty Income, their debt in Europe is something in the range of around 2%, which is about 80 to 90%, 90 basis points over the 10-year, and they use 100% leverage in Europe. They over-equitize in the US, still maintaining their covenants, and that's why they generate much higher investment spreads. That's kind of been the secret for WP Carey, and I want to again point them out because I wrote an article today on Realty Income, and I should have spent more time on WP Carey. Now, let's go to the next slide. This is the dividends through the pandemic, and you can see that net lease and gaming, there's 17 companies in net lease, 3 in gaming, going to be 2 shortly, but only 3 dividend cuts in the net lease sector last year. We actually knew where those companies were going to cut because those payout ratios were extremely elevated going into the pandemic. But they've been very stable, and that's really the benefit that we've seen with net lease is the stability of that income and the fact that they've been able to generate very consistent dividend growth over time. And I think you're going to see a number of other companies and really product types enter the net lease space. As you all know, anything can be kind of rolled up into a net lease wrapper. And so I think you're going to see other categories other than gaming. And we all talk about this experiential element and the applications that can be applied. For example, why couldn't a football stadium be converted to a sale-leaseback or a baseball stadium? There's a lot of applications with net lease. And again, I go back to what I said earlier. There is an $8 trillion opportunity set in Europe and a $4 trillion opportunity set in the US, which is substantial. We can go to the next slide, please. This is actually, I'll show this. We have several model portfolios. This one we call our durable income portfolio. I'm pretty proud of our results. Since 2013, we generated about 27% annualized returns compared to 9% or so for VNQ, which is the larger kind of proxy REIT ETF. We can go to the next page. But the reason we got this durable income performance is because of our allocation to net lease. We've got around almost 25%, including gaming, of exposure to long-term, long-duration leases, which are net lease and gaming. I'll also point out healthcare, which is really a lot of the healthcare assets are net lease, whether it be senior housing or skilled nursing or even the hospitals. So that's really another subcategory we could almost call for net lease. And we've also got very high exposure there. We can also say data centers and cell towers also have some element because they're long duration leases. So with this particular model, and the reason we've given you all the secret sauce of my durable income portfolio, but we've anchored the portfolio with our long duration leases, net lease, gaming, healthcare, cell towers, data centers, long duration leases, very dependable. And again, all of those assets today are very attractive to us because the market has sold those off. They're cheaper today because of the fears of rising rates. But we all know that net lease REITs do generate rent growth. And that's been part of the myth of the REIT world and rising rates. Let's go to this next slide. This shows the average dividend yield for net lease and gaming. You can see we're the highest yielding category in the REIT space today. And then the market cap there on the right side, which is growing substantially. So the takeaway here is I think net lease is going to move up and probably even move closer into the market capitalization of the industrial and cell towers sector. So becoming a dominant sector overall. Let's go to the next slide. So I'm going to close it out. Started out and said, 1990, I built my first advanced auto parts store. I had one rent check coming in. This is my portfolio today. I own all these companies. And if you add up all the rent checks collectively, this is before the Reit merger, by the way, which would be substantially more rent checks. This is how many rent checks that come into my bank account every month or every quarter. Some of these companies pay monthly. Realty Income pays monthly and Agree pays monthly. But there's a lot of rent checks supporting. So I've got a very diversified portfolio today, much more diversified than 1990 when I built my first advanced auto parts store. Now let's go to the next slide. there's me. Yesterday, I had my Francis, my chief of staff, put that in, and did get to meet Sam Zell. Sam is again on testimony in the book, and I only brought one book with me today. And I thought, what I would do is kind of do a giveaway real quick here if we've got time. And so, if anybody can tell me what is the size of the net lease sector internationally, U.S. and abroad, I'll give them the book. Does anybody want to give a shot at this? Nobody was listening. Any guesses? Any guesses? Yes. 12. Okay, there you go. We've got a book sold in the back. Thank you very much. And I don't know if we had a Q&A format. I guess we don't have time. So if we have any questions, I'll be glad to answer anything. Again, I'm trying to keep you on track. You've got a busy day here. Anybody have any questions? Good. Well, thank you, everyone. And again, it's an honor to be here. Thank you very much.
Hello. Hi, it's Randy Blankstein, and we're going to start this panel. The state of the market, ready for the boom. First, I want to thank Brad for his last speech, and I want to thank Real Estate Journals for hosting this 7th annual event. Missed everyone last year and glad to be back today. A special thanks to Mark Menzies, who worked tirelessly by himself on this event. So thank you, Mark. And I think we're going to get right at it. First question today is, where are we in the stage of the cycle of the net lease market? So let's just go down the panel. Tyler.
Sure, and I'll give a quick intro. I'm Tyler Swan. I'm an executive director with WP Carey, which you just heard plenty about from Brad. So I won't give any more intro. But as far as where we are in the market, I think I would say kind of mid-cycle. Clearly you look at cap rates and see some pretty eye-popping numbers. But when you look at the amount of capital that's been raised and that's going to go into this space over the next few years, there's a lot of money that's going to support asset values. Companies still need capital. There's tons of sale leasebacks to get done. So I think we're kind of mid-cycle. We got plenty of room to go here.
Mark?
I would agree with that. It's Mark West with JLL. I co-lead the net lease practice group with my partner, Kohler Yoakum. We're in Dallas, but our team's located across the country. I agree. We're probably mid-cycle. I think it'll be interesting to see what happens with interest rates and what effect that might have on cap rates here in the very near future, along with what's going on with inflation and replacement costs. So it's a very interesting time to see what's going to happen over the next 12, 18 months.
Hi, everyone. BJ Feller, Stan Johnson Company. I'm managing director and partner. Where are we at in the cycle? I think the popular thing that hopefully we've gotten away from, everyone wanted to talk about what inning we are and add the game and be like the 14th or 18th at this point, if we use that analogy. We're in a new norm in net lease. I started doing this 15 years ago. And much to Brad's great presentation and just more broadly, we're in a new norm where net lease is an asset class unto itself. It's sustainable. We're in an environment where yield costs have gone down, servicing kind of a generation of baby boomers who are retiring right now. So I really think that we've turned a corner where the market's sustainable and really going to operate in a sustained fashion as it is right now. 1031, which I'm sure we'll get into a little bit later, really the threat of that going away has gone to the wayside. So I think that's the only thing that could have really changed the new norm of sustainability for the net lease market.
Nick Kainich, I worked at Marcus & Miller chapter in Chicago. I'd agree with all the other panelists. I think that what has happened over, I'd say, the past two and a half years is that the net lease sector, as it's kind of pulled itself away from other product types, whether it be industrial or retail, it's kind of become its own investment vehicle. And because of the different types of buyers for those assets, whether they be big firms or small one-off 1031 buyers, or even private capital just looking to place into the sector, I think that hopefully for everybody in this room, it's going to stay sustained and it's not, an inning type of a game that's going to continue to roll through. And it's still very strong.
All right, so let's hear the other side of the coin, which is what challenges are out there in the market today? Obviously, we're at historic cap rates and a lot of competition. What challenges are you seeing out there? Tyler?
Yeah, I mean, I think for us, the biggest challenge is just supply of deal flow. I mean, there's so much money out there chasing deals. And I think folks have, for the most part, remained pretty disciplined in the deals that we're doing. And it hasn't pushed pricing to crazy levels or returns to crazy low levels. But what that just means is the volume that you want to do based on the amount of capital that you have it's tough. I think we'd like to be doing twice as many deals as we are, but supply of deals is tough. But hopefully, I think there's still tons of demand from capital, from corporates, and next year that probably bodes pretty well. And I think I expect deal supply to expand, and that challenge to be kind of overcome.
All right, hold on 1 minute. Jason's joined us via Zoom. So Jason, can you hear me?
Yeah, I hear you.
First question to you is, what stage do you think we are at in the net lease cycle?
The worst stage possible.
And why is that?
I mean, I'm hoping that we're at the bottom of this compressed cap rate market. It's just been tough. I just heard everybody speaking here. Deal flow's good, but the cap rates are making it very difficult for a REIT like us to transact at these lower levels. So we've been, hopefully things start bumping up on the cap rate side, but I don't think it's going to happen anytime soon based on the all the capital chasing deals right now.
Thanks. Mark, back to you for challenges in the market.
Right now, I think the biggest challenges are, it depends on what side of the coin you're on.
Let's take your side for the moment.
The challenges for us are finding enough product because of people, like Tyler, Gino, and the likes. There's just so much capital out there trying to find product, and there's new entrants coming into the market every day, not necessarily in the public vehicles, but you've got firms like KKR and Apollo that are now have started their own net lease vehicles and just have a huge appetite. So I think the challenges for us is to find the product, and that really the other challenges I would say that I'm a little worried about are inflation and interest rates. And generally, as a rule, in our business, and it's not just in the net lease space, the cost of the capital is not necessarily what disrupts the market. It's the flow of capital. And if you get a sudden, jolt in the interest rates or something like that, it could slow down the flow of capital, which that affects our business. We're in the transaction business.
BJ, challenges?
I think the challenge is unlocking value. And what I mean by that is the net lease market, whether it's institutional or private, tends to really place value on long-term credit leases. And that's understandable. We all know it's a bondable income stream. It's a bondable investment. But we see the most value on kind of mid-dated duration right now. We think our assets are really underappreciated across all asset classes, office, industrial, retail, where people are starting more and more because of the pressure that Jason mentioned on cap rates being so low for that kind of core acquisition target. People are starting to look at assets with shorter duration, with non-conventional uses, and really try and underwrite the value and the stickiness of that tenant in that property in a way that they might not have done. But I think that's a slow process. The cost of capital in net lease is in this long-term downward trajectory. And I think that's going to work its way into the areas that people may have shied away from. And we've seen that trend manifest itself over the last 12 months and think it's going to continue to. So I think it's both a challenge and an opportunity, Randy.
Nick?
I think that, dovetailing off what Mark and BJ said, it's the inventory. And I think that there is a fair amount of inventory out there, speaking as a broker, that is in the market. And I think a lot of it, it's hard to find good saleable product that doesn't have some sort of challenge, whether it be an over market rent that's baked up on a sale leaseback, or a less than competitive positioning, or, you know, just any host of little challenges that buyers are going to figure out, even unsophisticated buyers. And what I'm seeing in the market today, and I would imagine that other brokers are, is that you do get a lot of bids on properties, and oftentimes you have to go through two buyers to find the right purchaser on deals. And it's just a challenge to keep the second or third or fourth buyer engaged while the first buyer goes through. And hopefully you don't have to go through two or three buyers, but the challenges with every single deal are definitely there. And the very clean, no issue net lease deal is few and far between.
All right, there's a whole
Randy, can I just add
Go ahead.
on one thing real quick? It's a very interesting time in the market, and I've never seen it like this before, not necessarily just in the net lease space. But what BJ just said is absolutely what's going on in the market, especially in the industrial market. Industrial assets are trading for as much vacant as they are leased. And if there is a development going on that's going to complete in 6, 12, 18 months, 12 and 18 months is worth more than delivering today. And it's because investors believe that the rent growth is going to continue that has happened over the last 12 months, which is absolutely amazing. I've never seen it before in my career. They think rent growth is going to continue to grow at 10, 12% on an annual basis.
And what do you think the consensus is in the office market? I know that's the industrial market.
It's completely opposite. I think there's still a lot of questions in the office market in it. But it's very interesting. We'll see how the return to work, continues to evolve over the next few months.
It's a horrible time to be a box checker right now. If you're a box checker, be prepared to pay 25 basis points more than cap rate. Right now, the people who are, I think, thriving are the people who are really finding value.
All right. Anybody else want to talk about the office market, or? No. That's what I thought. All right. There's the whole panel on sale leaseback later, so we won't talk about it in depth, but I do want to get quick thoughts and kind of on new entrants and kind of how the sale leaseback market is different than the rest of the net lease market, if at all, today. Jason?
Yeah, so the sale leaseback market has gotten pretty ugly in my mind, especially these PE driven deals. We're finding that, deals in tertiary markets with substandard credit, the PE firms are still are driving the bus with these assignment language clauses that basically hamstring the owner into owning an asset that you're always concerned about them driving the value down to zero with the tenant, but now they're basically demanding the right to do it whenever, however, without your consent. And I mean, I can tell you, we've walked away from 3 sale leasebacks over assignment language. It's just become a real problem for us.
Tyler, sale leaseback market, thoughts?
Yeah, I would say structure and the deterioration of structure is certainly has been an issue for us as well. But I mean, we've continued to kind of pick our spots. I mean, we hold firm on structure. We like to do deals that are assets that are highly critical to the companies that operate there, and those deals are still out there. I mean, we're certainly more selective than we'd like to be. I mean, we're going to do $1.5 billion of new acquisitions this year. We'd like it to be $3 billion, but we're just kind of having to pick from a smaller pool and just pick the right deals, and they're still available.
Mark, sale leaseback market, thoughts?
It's been robust. The M&A activity in the private equity space has been very, very active. There's plenty of capital in that space, just like real estate. But I agree with both of them. From where we stand, our position in the transaction, it certainly, that language is from us on the assignment has switched from landlord to tenant. And it's continues to move that direction.
BJ?
I mean, Nick, you could probably chime in on this as well. You take a sale leaseback deal to market. I don't care where it's at. We've got one in the middle of Pennsylvania, in the sticks, industrial, middle market credit. The deluge of phone calls you're going to get in the first week. I mean, it's unbelievable. And if that feels unsustainable, we talked about sustainability earlier, but it feels unsustainable to be able to stack up 3 bids within 6 hours at full list on a in the sticks industrial deal in Pennsylvania on a $500 million top line credit, $5 to $10 million EBITDA. That feels unsustainable. So the pendulum has swung, to Mark's point, totally in control of tenants right now, unless you're going to have the discipline that you guys have and say, I'd like to do 3, I'm going to do 1.5. I'm not going to compromise assignment. The pendulum is totally swung. I got a call from a CFO, at a medical manufacturing company yesterday who got a bid probably from somebody in this room on a direct unsolicited basis and said, this is interesting, got hooked up with me and said, should I do this deal at a 7.25 cap or should I go to market and what would that look like? And within 5 minutes, I mean, that decision became very easy for that CFO. So they're going to market, but it's a tough time that takes a lot of discipline. If you want to be that box checker that I talked about, be prepared to get run over on your lease form, be prepared to pay, 25 basis points above markets. It's just really intense right now.
Yeah, I think from the private client perspective, which is where a lot of our business is done, there's a lot of flood in the market of certain particular product types like car washes, for example. And what I think that has helped in the general industry or the subsector of the industry is the cap rates get established very quickly when these big sale leasebacks happen. So that car wash space was in the low 7s on a one-off basis, and now it's kind of pushed sub 7. And a lot of folks that might have smaller businesses that they're looking to do a sale leaseback on, not necessarily the large groups that are doing this programmatically and doing them one-off to private buyers, they're seeing that lift in value for them because they can say, hey, look, a market's been established for this property through a lot of sale leasebacks that have hit the market, and they're able to benefit from that. So I think that it's good for certain folks, but I think, as a lot of people on the panel have said, for the buyers that have been active in it for a very long time, it has swung in the direction of kind of the more retail buyer, and those folks aren't aware of all the pitfalls that these experienced buyers have.
All right, let's move on to kind of new, unique, or different things that you guys are working on or have done this year. Kind of give examples for the audience to get a sense of kind of where the market is. Jason, you want to start?
Sure. Yeah, new and unique. We pretty much stuck to our knitting. I mean, we've bought a few more things in Europe than we would normally. But I mean, we're on pace to do $1 billion worth of transactions this year across the 2 funds. So we've been pretty much sticking to our knitting and not doing much new. We're taking a little bit more risk on credit and diving deeper into that. But, I don't know that we've really changed our profile that much. We've been keeping the cap rate steady. It's dropping. Our average cap rate's dropping, but we haven't done anything really exotic or, life altering. All
right. Anybody here want to weigh in on that?
Sure. I mean, our approach is, generally our strategy is the same, but I would say, with the decreasing cost of capital, we've talked a lot about cap rates coming down, but by the same token, cost of capital has come down massively too. I mean, we can borrow money at 2%. Our cost of equity is at an all-time low. And what that's meant is that we can get into certain asset classes like nice logistics facilities that trade in the 4s, which is a number historically we could have never gotten to. But with a very low cost of capital, we're able to buy these. We just closed a $100 million logistics facility in Indianapolis at a 4.5 cap. That's something that historically we would have liked to have bought, but the cap, our cost of capital just wasn't there. But it's there now, and that's kind of allowed us to sort of open up a new sort of asset class that wouldn't have been WP Carey typically over the last 45 years, but it's something we could do now. So in a way, that's kind of an opportunity for us.
Anybody else have a recent transaction they want to talk about as an example of the market?
Yeah, I'll grab that one. A bit of a cliche, but cannabis is a space that really is getting enormous traction right now. Still remains a private asset class. I'll give a shout out to my main man, Christian Tremblay, in the front row here. Just closed a couple of cannabis transactions at really all-time low cap rates. We're just seeing incredible compression there. And I think I could point to cannabis as a separate industry, but I really think the story here is a broader theme we're seeing, where you're seeing the shift from a pure emphasis on credit and lease term duration to really an understanding of what the profitability of locations are. You referenced car washes, same idea, really an emphasis on the EBITDA and the rent coverage ratios more than the outright credit of the parent that's standing behind that lease. And cannabis is a perfect example of that. I mean, traditional retail is going to push sales 500, 600 a square, and a lot of these are doing upwards of $1,500 to $2,000 a square foot in sales, just enormous sales. We've seen entertainment be a venue that's, no pun intended, getting more and more traction. And then I think you're right on. The other interesting thing is it's not an asset class, but the spread game is really something where people haven't been in those logistics properties. And they're like, now this makes sense because my weighted average cost of capital is just so much more compelling right now.
I mean, I wouldn't call this too new or too interesting, but what I have been, and my team has been doing a lot more recently, is taking on assignments with shorter lease duration, because the chasm between the 20-year Chick-fil-A at a 3.6 cap and the 6 or 7 year questionable credit deals is so large that a lot of people are more interested in buying these shorter term deals because they know that they will never be able to afford or just aren't in the market for these very, very low cap rate, trophy assets. So we've seen a lot more activity in deals that a year and a half ago, I would have said, I don't know if there are any buyers for this, and we would have priced it 100 bips higher in cap rate. But we're closing a handful of deals in the next couple of weeks. We've closed, like 4 Steak and Shakes, for example. Those properties the credit is questionable at best, and we're non-contingent on all of them. Closed a few of them recently, and had actually great activity on them, surprisingly.
All right, let's go to interest rates. Mark obviously thinks they're going to go up, as do I. I want to get everyone's kind of opinion on A, kind of what their interest rate forecast is, and B, how do you think the net lease market responds to it, assuming that the rates do go up or down. Everyone can take their own opinion, but just want to see where everyone's mind is regarding interest rates and the impact of net lease. Jason?
Well, I'm hoping they go up and then cap rates do, but I don't see it happening anytime soon. And as we know from history, even if the interest rates do rise, the market's usually 6 to 12 months behind that, is what I've seen. So I'm not optimistic that it's going to change much in the next 6 months. That's for sure.
Tyler?
Yeah, I know. I think similarly, we just raised 12-year debt at I think the low 2s kind of interest rate. So you look at something like that and say, there certainly is not, at least in the short term, any kind of expectation of a rate rise. I do think what Mark talked about earlier, the specter of inflation kind of looming over things is a potential risk. But no, I think in the short term, rates are going to stay low for quite a while.
So if there's a 6-month forward, you're not pricing any interest rate adjustment in?
Maybe very minor, but not much, no.
Okay. Mark?
Well, I agree with Jason. We've already, the 10-year treasuries moved 35 basis points in the last few months, and I don't think there's been any movement in cap rates across the spectrum. I think that the debt markets are extremely healthy, and there's so many different buckets of money, whether it be debt funds or banks or the CMBS market or life company. And the new is the SASB market, which is absolutely blown up and is really cheap capital. People are exercising that market on a weekly basis now. So I think it is the interesting thing about the debt market, as these cap rates have been compressing and the rates have moved a little bit. It's interesting that some people are choosing to go shorter in term on the debt, and not necessarily longer with these long-term net leases. And that can get you in some trouble, but we'll see what happens.
BJ, interest rate?
Yeah, look, I mean, we've seen a massive move in the last decade to a heavier percentage of all cash investors. And that is a massive driver for keeping a lid on the impact of higher interest rates and cap rates. I think there's some buffer built in spreads from lenders right now. The 10-year treasury went so low in 2020 when it dipped, I think at some point to 30 basis points, 35, whatever it was, when it was absolutely in the trough, that a lot of the floors were hit in terms of these rates. So even with the 10-year moving back to 160, wherever it's sitting today, lenders can still, take a 210 spread to a 200 spread and structure more conservatively. So that's really, I think, puts a lid on how much upward trajectory there is at cap rate. And I think there's a lot of people just waiting for even 5 to 10 basis points of cap rate movement to bring a lot more capital in the market. So at risk of sounding like someone who is biased in selling net lease real estate, I don't think cap rates are going to be that impacted by treasuries.
Nick?
I agree with everybody else. I mean, I think that it has been talked about for years now, thinking that interest rates are going to go up, and they really have maintained. And I think that that's probably going to keep constant for the foreseeable future.
Okay, I'm going to take the other stand on this one. I think that there's other fundamental factors that are changing, from the amount of money that we're borrowing to, there's certain other factors out there that will cause them to actually go up slightly this time. I don't think there's a dramatic case for them to go up, but I do think when you're seeing, CPI go up over 5% year over year, it's something different that is happening. We shall see. Let's talk about kind of where net lease goes from here. What are the drivers? Everyone's thoughts on the next 6 to 12 months. What are the drivers that are moving us, to the next level of transaction volume from here, or kind of what the market looks like 6 to 12 months from now? Jason?
I think it'll be more of the same. Just cap rate compression. I don't know if it can compress anymore. And I think you'll see a few new entries into the marketplace, as we've seen a lot this year already. But I think, deal flow seems to be steady, if not, good. So I don't see a lot of change in terms of, the next 6 to 12 months. I think it's just going to be a slog, and you're just going to have to be, persistent in chasing the metrics that you want to see on your pro forma.
So you think we're flat year over year, a year from now, transaction volume?
Flat. Yeah, well, no, I think you're going to see bigger. I've seen a few big M&A type deals. I mean, you've seen the iStar portfolios out there. That's a big deal. So I think you'll see a few more bigger portfolidos like that, which will draw a lot of the private equity capital to them. But I mean, I don't know that you're going to see a whole lot of change from where we are today.
Tyler?
For WP Carey, and this is a little bit different than others on the panel here, but for us, so much of what we do is driven by private equity M&A activity. Private equity firms buying and selling companies and wanting to do sale leasebacks as part of those buyouts. For us, that's huge. And if you look at the amount of capital that's been raised to buy businesses in that space, I mean, it's just an astounding amount of money. And for that reason, I think the outlook is very bright, specifically for what we do. It's a lot of, manufacturing and warehouse sale leasebacks, kind of like what BJ was talking about. I mean, that's the bread and butter of WP Carey, has been for 45 years. And there's, many reasons to believe M&A activity is going to continue to be good, and that's going to be a huge tailwind for our business.
Mark?
Well, we're in a little bit different position than WP Carey and also Jason. Our pipeline would suggest that year over year is going to grow. That certainly 2021 is better than 2020, but in our business, 2021 is going to be better than 2019. And our pipeline would suggest that it's not slowing down.
But what about 2022 and what sources will be better and what's driving those sources
Of deals?
for next year?
Well, I think that, it depends on what sector you're talking about. If you're talking about the private market sector that these guys play in more, the development pipeline is strong for certain assets like C-stores and drugstores and things like that. So that's going to continue to put volume in the market. And then on the sell-leaseback side, just like Tyler said, there's so much private equity capital chasing deals that there's M&A activity is really robust. So I don't see that slowing down, barring some kind of disruption in the market.
BJ?
I think it's easy to lose sight of what's really driving the market here. Well, I don't care whether you're on the institutional side or the private side playing in the net lease space, buying net lease assets. The upstream capital flows are really from people who are shifting from growth-based investments to yield-based investments. That's what's going on. Whether it's capital that's getting in via the DSTs, direct investments, buying in stock market, buying assets direct, that's what's going on. And I said it earlier, we're on the precipice of the greatest move of retirement that's ever been seen in all human history as baby boomers. I've seen the number, I think it's 20, 30,000. I'm probably going to be way off that hit the age of 65 and are going to live another plus or minus 17, 18 years, statistically speaking, according to actuaries. And that trend is not going to slow down. That is a trend that is going to keep going. And that capital is going to find a way into the net lease market because it is the best tax advantage yield play available to you if you need to sustain your income for another 20 years. That's going to keep playing out. All the other factors that we're talking about, all really important, but they're window dressing. They move the needle a little bit one way or the other, but the broad cyclical structural trend for that matter is going to keep going. So I think the market's going to be into 2022, Randy. I think it's going to keep doing a lot of what we're seeing. There's things that can hold it back. If rates go to 225, that could put the lid on it a little bit. But right now we're on track of 60 billion of transactional volume. That's basically flat, maybe a little bit up year over year, 2020 to 2019 or 2021. It won't hit the 2019 levels that push towards 80, 75, 80 billion. But it's going to be strong and sustained in my view.
Nick?
I can't tell if I like being at the end of the line or I don't like being at the end of the line because I feel like I could agree with everybody. I think I like it right now. I would agree with BJ. I think that the net lease is very much the end of the line for a lot of the real estate investors out there that are trying to find something where it's a lot more of a hands-off investment. And again, that's the space that I'm Brad playing a lot or BJ playing a lot. And it's something that we see people constantly flowing in that direction, whether it's apartments, industrial, more hands-on assets that they're selling for great numbers and they don't want to pay the taxes and the capital gains that they're faced with. And they just grab onto something. And I think that for the next year, 18 months, it's going to be a lot more of the same. And I'm glad that, we're sitting where we are because it's healthy for net lease brokers.
All right, Nick, I'll give you a chance to go first now.
Okay.
Maybe you can break down kind of your deal flow and the deal flow you're seeing between private buyers, institutions, and other kind of buyer types out there. And do you see anyone expanding or anything changing among that profile?
I think that the larger groups and the institutional groups that are chasing the net lease deals that I'm in largely the $1 to $10 million space, they're pushing value up and cap rates down to try to compete with the private buyers. And you get certain types of sellers that are okay with and appreciate the fact that it's a large group. They've transacted on a lot of properties. They have a huge track record. Whereas other more savvy sellers that are a little more in tune with the rigid processes that those large groups have, they oftentimes, even though the cap rate spread might be 10 basis points or less, they like to kind of roll the dice on the smaller buyer because they might be all cash and they don't need, a property condition report and a roof report. They might be able to push due diligence down to 14 days or less. And that group, or the private buyers and the people that are tax motivated, sometimes they've been able to kind of make the larger groups try to get to their bottom line, which is usually 30 and 30. And it's been, I would say more than half of the buyers that I've transacted with this year have been the 1031 buyers, and more than half of the sellers are choosing those groups first. Maybe they'll wait if they blow out of 2 private buyers, 1031 buyers, then they might say, okay, fine, well, let's go with this bigger group because I know what the landmines are and I might as well give it a whirl with them, but they like to roll the dice with the smaller buyers first.
BJ, buyer profiles?
Yeah, right now, here's the lay of the landscape. Retail private buyers have the command. They have the high grounds. They set the cap rates 20 to 25 basis points more aggressive than the institutions, the agris, the realty incomes of the world. And the seller's got to make that game time decision. Do I go with surety or do I max my last 20 basis points out? Office, not in favor with institutions. So that's really, generally speaking, unless you got super long dated, that's a private market right now. That's who's going to win most of those deals, 70, 75%. Private or quasi-private. Industrial, the prices, yields between private and public and institutional investors are really on level. I mean, you're seeing private investors get into the low 4s, in some cases 3 handles. You're seeing institutions do it, and institutions are winning today because if it's a push, most sellers, whether that's a developer, whether that's an institutional seller, they're going to go the institutional direction, the surety of execution there. Medical, really an institutional market right now. So, I mean, it's a pretty even battle until you really get to that high caliber industrial product right now.
All right, now I have a question for Tyler and Jason. Given it's such a competitive environment, what's your quick pitch on differentiating your firm as to why you can win transactions, or what's your pitch to sellers to go with you guys?
I'll let Tyler go first, see if I can one up him.
All right.
Set the trap.
All right. So the quick pitch is basically, I mean, there's a couple things that do differentiate us relative to some other buyers. One is that we don't have to put loans on our deals. We don't go to asset level financing, which for a lot of the deals, like I was talking about earlier, we do a lot of deals that are sale leasebacks as part of M&A buyouts. So that private equity sponsor really needs to know that you're going to be there the day of closing. And, your lender is not going to flake, and that's going to cause you to change your pricing. So having the kind of all equity, being the all equity buyer, not having to worry about financing is very important. And I would say the other kind of differentiating factor is that we're long-term holders. I mean, we have assets that we bought in the late 70s and still own today. And for us, that's a perfect investment. Put it on the shelf and hold it, which usually when you're talking to buyers who do have kind of a longer term hold period, they want to know who their landlord's going to be. They want to know that we're not going to be flipping this asset in a couple of years, trying to take a quick profit. So, being all equity and being long-term holders, that's kind of our differentiating factors.
All right, now you're back on the spot, Jason.
I can't do any better than that, but yeah, I mean, all equity, all cash, quick close. I mean, long-term, I mean, everything Tyler said is pretty much my elevator pitch as well. And track record, I mean, we've been doing it for a long time. WP's been doing it longer. I mean, we bring the same, I mean, look, we try to differentiate ourselves by buying portfolios domestically and abroad. We have that capability, but we're going to be there at the end of the day. We're not going to change our number. And on the bigger deals, 10 million and above, I think we shine over a private investor all day long.
All right, I left a few minutes for questions from the audience before I start calling on people individually.
Yes, do it.
Sure.
However, if you don't mind, something you talked about the benefits of your group. Where do you stand on lease term? I know you guys like 20 years. We talked about that a little bit. We passed up on it. That's 15, 17 years just to begin selling that. So,
Yeah, I mean, historically, lease term and structure generally is something that we've always been very, very focused on. But it's very much kind of based on what type of asset we're talking about. You know, the classic WP Carey deal over the last 45 years was a manufacturing facility in a, you know, B or C market, or maybe a non-market, you know, with a 20 or 25-year lease on it. And in those kind of cases, you really do have to stick to your guns and ask for those longer term leases. And if you can't get them, you kind of pass and just accept that for what it is. But, you know, like I was talking about earlier, we've tried to trend towards nicer quality real estate. And as part of that, you know, we're willing to accept 12, 10, 7-year terms in some cases, if we can really underwrite rent growth and really get a good story behind that asset. You know, shorter term lease is okay, but there's no doubt there's pressure on structure to do, you know, riskier deals by shorter leases. And that's just something we've had to contend with for sure.
I'll add just a market comment on that, which I found surprising. We just signed up a sale leaseback with a healthcare service provider to the healthcare business. It wasn't a healthcare business. It was an office building and not in a major market. And the operating business really wanted a 10-year lease, and we went out at 15 and pushed the market and got it all the way down to a 12, which I thought was going to be very, very difficult to do, and basically didn't have any impact on the pricing, which I thought that was going to be virtually impossible to do, but that's just the state of the market today.
Other questions? Josh? Could you speak up a little?
Okay, just when you guys were talking about lease structure earlier, and right now inflation worries, how are you seeing the market respond to that? Is 10% every 5 years enough? Is 1.5% every year enough? Especially as we're seeing these inflation numbers right now.
Jason? Do you have a question?
The question was about the rent bumps.
Yes, is a 10% bump every 5 years enough given inflation expectations, or are you structuring it differently with annual CPI or what have you?
We'd rather a static bump than a one attached to CPI. So 10% every 5 is fine, and 2% annually is great. We haven't, we can structure it on the sale leasebacks, but most of the deals you're looking at are already existing leases. So it is what it is, but more is always better.
But for sale leasebacks and new ones going forward, are you going to attempt to adjust that language or not necessarily?
I mean, we're going to try, but I don't think it's going to go very far. So, I mean, the 2%, 2.5%, I mean, we've seen a few with 3% annual increases, but you're paying for that. So we're going to try, but it's going to be, you want more of a surety in terms of growth, you're going to pay for it.
Yeah, Randy, if I can, we just talked about this on our podcast, Net Takeaways on the Apple Podcast Store. I promised myself I wouldn't do a shameless plug, but I just couldn't resist it. Sorry, guys. Also available on Spotify. No, the fascinating thing is you've seen so many tenants just who are allergic to rent increases. And we really are trying to guide a lot of people, whether it's in a lease negotiation on a new development or sale leaseback, look at a 3% rental increase. Because the truth is, on an NPV basis, tenants are going to do better on their NPV because they're going to get the benefit of that front end cap rate. But preaching that story and educating tenants around that who just really want to see not even 10% every 5, generally speaking, want to be more at 1% or really in some cases flat, is such an uphill battle educating them, even though there is value there. And even though we all know the dirty little secret here, tenants have all the leverage in the lease negotiation. Unless you truly have their mission critical facility that they can never relocate, every tenant in the world's got the leverage today. So it's a battle, but it's a battle that certainly on our side, on the brokerage side, we're trying to fight, even though it's hard, Josh.
Tyler, the same thing in the sale leaseback market for you?
Yeah, absolutely. But I mean, I think the important thing to point out is, we're spread investors, right? So we're buying these deals with fixed bumps or whatever in place, but we're also locking in long-term debt at a low cost. So if rates start to rise, if inflation starts to rise in a couple of years, that does sound a little scary for our business, but at the end of the day, we've locked in our debt costs for the next, 10, 12 years. And so really just maintaining that spread is what's most important. And that's going to be true whether rates rise or not.
One other thing that you have to take into consideration when you sell these specs, when you're looking at these rent bumps, because there's so much focus on four-wall EBITDA and structuring that rent to start going in, that, moving those rent bumps too aggressively, that tenant has to, whether it's a fast food restaurant or whatever the case may be, their performance has got to move to match that rent bump. So you got to be careful. You're going to price yourself where the rent's going to hit a level where you're going to have a hard time paying the rent. The store's just not profitable enough to do it.
Other questions? Thank the panelists. I greatly appreciate it. Thanks again to Mark Menzies from Real Estate Journals.
Mark, are we okay on the Zoom? Who's ever handling the Zoom feed? Mark, should we wait for the Zoom? Are we okay, or we're okay? All right, good morning, ladies and gentlemen. Thank you for coming to the Net Lease Conference put on by Reit Journals. I want to thank Mark for organizing this great event. It's nice to see everybody on the tail end of COVID, let's say. This morning we have 4 veterans in the business, and we're going to focus on 2 sectors, the healthcare sector and the industrial sector within Net Lease. My name is Chad Fercell. I'm the president of Quantum Real Estate Advisors here in Chicago. We also have an office in Los Angeles. We specialize in investment sales, and we do a lot of single tenant net leased investment sale work. If the panelists could just sort of introduce themselves, give maybe a sentence or two about your company and what you guys do, that would be great. And then we could jump right into some of the meat and potatoes of the discussion.
Yeah, good morning, everybody. My name is Steve Wolf. I'm Vice President of Acquisitions for Spirit Realty Capital. I head up our industrial platform. Spirit Realty Capital is a net lease REIT. We're based in Dallas, as I said. We've got about $7 billion worth of assets under management, split between office, industrial, and retail.
Great, thank you.
My name is John Boyasian. I'm a principal of Echo Development Group. We're in the midst of a rebrand. So, I think the website went live yesterday. So it's actually transitioning to Echo Real Estate Capital. We have an acquisitions and development platform based here in Chicago. We really play in 3 different asset classes, primarily healthcare. We also have industrial and retail assets in our portfolio. Currently, we have around $250 million in acquisitions in our portfolio and also in production with some new construction assets in Arizona, Colorado, and Indiana.
Thank you.
David, yes.
So just flip it, it goes up.
High tech. David Piasecki, BV Net Lease Capital. BV stands for Blue Vista. This is a new venture with Blue Vista. Blue Vista is a Chicago-based private real estate investment firm. Lots of different space that it operates in. And they made a reach out to me about this time last year to start up a net lease platform. We operate in office, industrial, and healthcare. And our deal size is typically 10 to 50 million. And we operate with a small or a wide range of credit, from private equity owned single B type credits to lower rungs of investment grade.
Thank you.
Adam Moore with First Industrial Realty Trust. We're about an 80 million square foot real estate, industrial real estate REIT based here in Chicago. I run our Central Midwest region and oversee acquisitions, development, leasing, and operations.
Thank you. We're first going to talk about pricing and valuation, although I want to go back in history for a moment. Selling all different types of asset classes. I remember flying to Arizona in 2010 in May, and there was a portfolio of very, very well-positioned Walgreens for an 8.15 cap. Look at us, 12 years later, and they're 5 to 5.5 for that same type of product. So it's pretty interesting if we just look in our rear view mirror where pricing and compression has come, which is a long way. And the latest comp that I was able to pull up was a Walmart deal in Scottsdale, in the same market. It's an industrial product that just sold for a 3.16 cap. That's an industrial building. So it's pretty interesting to see where the acceptable yields are today and from where they were. And on that note, why don't we just take into account, we're going to break the panel up. We're going to have 2 guys focus on industrial and 2 guys focus on healthcare. And then, we'll just sort of go down the line. But let's talk about the last, call it 5-6 years. And then let's focus on that 18-19 vintage. And then today, where do you see valuations? Where is the demand coming from? I know a lot of it was, opined earlier in this previous panel, but taking into account, let's say industrial, Steve, what's driving a lot of this compression starting back 5-6 years ago and then into today?
Yeah, that's a great starting point. I mean, I think what you're seeing a lot of the compression is there's just so many more players in the industrial sector.
Yeah.
Kind of to tail end on your story about high cap rates. I remember when I was a broker in the early 2000s and selling 7 cap deals and thought I was a rock star. Times have changed, but I think you're just seeing so much more demand in the industrial sector. I mean, I've done it. I've been in the business for 20 years. You've got the PE firms are obviously getting heavily weighted in industrial. You've got private buyers, and even more so what I'm seeing, where I'm seeing a big push, and call it the $8 to $20 million range transaction, or the family offices in the last 24 to 36 months, where they were much more selective in what they bought, much more picky. We're not near as active, whether it's West Coast, East Coast, Midwest-based family office. They're all getting involved, and they're making it really competitive for those of us that play in those markets. Call it the smaller size deals, 10 to 20. I think that's just causing even more cap rate compression. And then obviously you've got the foreign wealth coming into the market the last 2 or 3 years.
Are you guys losing bids to a lot of private capital, or is it more PE, private republic REIT sort of competition, or?
That's really tough to say. I mean, there's just so much in the market right now. I think that we're probably across the board. I mean, our traditional competition, whether it's WP Carey, Angelo Gordon, et cetera. And then I talked to some guys last night that told me about they had a private buyer come in on a deal and went start to finish in 14 days.
Wow.
No due diligence, money hard day one.
Wow.
We can't compete against that.
Right.
Now that's obviously a unique situation, but those guys are out there, and there's more of them than there were 2 or 3 years ago.
Yeah.
So,
yeah. How about you, Adam?
Well, first off, I think part of the compression we're seeing is there's just so much more demand. It used to be there were A buyers, B buyers, and C buyers, and everybody had their niche. Now everybody wants to be an A buyer. So there's so much more demand for A.
Sorry, and when you say A, are you talking asset class?
Class A.
Okay.
Yeah, Class A. So that sector of the market's become so compressed. As far as the competition goes, we used to compete kind of much like you. We used to compete against maybe half a dozen kind of usual suspects in each market. And now you just never know who you're competing against. And it's tough for us because we're a long-term hold. Really look at the value of the asset, value of the real estate, more so than, just kind of clipping a coupon. So if somebody comes in and maybe doesn't know the market or the submarket as well as us, they might be able to talk themselves into a higher rental rate or and that makes it difficult. So, and we see a lot of that. I mean, we've certainly seen deals that we've lost out because somebody underwrote a $550 net rent, and we knew well that the rent was $475, and they get burned in the end. But it's still it hurts to lose a deal.
And has this been, again, just for you two, Steve and Adam, has it been more recent in the last 24 to 36 months with this COVID and the emphasis on logistics, or has this been sort of, call it mid-19 when you started to see a lot of this compression and or competition?
Yeah, probably in the last 24 months, but even more so in the last 6 months.
Yeah.
I always say that people, when I got into the business years ago, industrial wasn't the sexiest asset class, but in reality is no matter what a company's doing, they always need a place to manufacture it, to build it, to store it, and to push it through the door to distribute it. So I think they just have a much broader audience. A lot more folks get it now.
Mhm.
Yeah, that curve has gone from a 45-degree angle to almost straight up in the last 6 months.
Wow. So how about healthcare? I know, John, you guys do primarily healthcare real estate. What have you seen in terms of, cap rate compression, call it 5-6 years ago versus the last, 24 months? Again, another accelerant of COVID.
Sure. So I guess for our firm, our investment thesis really was born 5 or 6 years ago. Up until that point, I'd spent the majority of my career in a retail setting, and I sort of stopped and thought, is this an asset class that I was relatively young, and does it have the runway, for me in my career? And after some soul searching, I figured out or came to the conclusion that the demographic trends pointing towards the expansion of the need for healthcare services in our country is what led me to kind of this world that I'm immersed in now. A couple of the demand drivers that we sort of track and continue to keep us emboldened on the healthcare space. Certainly the silver tsunami that's well documented demographically. I'm starting to be silver too, by the way, so I'm in that group.
Look to your left. No, I'm just kidding.
The emphasis on preventative care at the system level, and so increasing healthcare services so that you are seeing patients before they get critically ill, and you're linking patients with physical therapists and dietitians before ailments that they have get to the point where they are having to seek higher acuity and more expensive medical services. Another kind of trend and what's driving cap rates and a lot of the deals that we all look at are the migration off campus of healthcare services away from the mothership hospital to an outpatient setting. We happen to be very bullish on a specific type of medical office product where it's a single story but multi-tenant medical, net lease, but multi-tenant building where each of these providers have their own individual sign. They have their own tenant entrance. You're not coming into a common core lobby where a patient would have to find the name on the menu board, up the elevator, down the hall, and to the left. That type of MOB product still has its place, but for us, if you're talking about an off-campus, in an off-campus setting, the accessibility of these individual tenant suites where, right in the front door and you're in the lobby, we own a lot of that product and we'll continue to pursue that. And then lastly, the retailization of healthcare, sort of taking healthcare and putting it in a retail setting, I think is an additional driver of cap rate compression, because you're seeing what was a advanced auto parts store, and maybe Advanced Auto Parts leaves, but it's a well-located piece of real estate and could be turned into a clinical healthcare facility, urgent care, or whatever. It's sort of being seen in the same light as the retail asset that was in that building previously.
Well, 5-6 years ago, there was Fresenius, DaVita, dialysis, maybe, an Aspen Dental, et cetera. I guess maybe, just to stay on point with the demand and cap rate compression over the last, 5-6 years, in conjunction with the retailization of medical services. How have those cap rates fared? You guys develop a lot of build-to-suit product. Have you seen just a precipitous drop? Is it plateaued and stayed? And, is it more so in this dental space or vet space and dialysis and less so in the ER or behavioral health? Or, what I'm trying to get to the audience, or what I'm interested in hearing, is where are the cap rates the lowest, why, and what's the trend of MedTail, or this retailization of medical service delivery?
Sure. That for me and the deals that we pursue, the cap rates it's a double-edged sword because I'm looking at cap rates from a yield standpoint and a going in return on cost, right? I hope the cap rate's there for me at the end when I sell. And I like where cap rates are going, and the compression is helping me on an exit of these assets that we acquire and develop, whether it's value add or build to suit. The problem that I run into is there's also competition on the development side, and there's cap rate compression on in competitive situations where I'm pursuing either with a tenant or with a site. And my yield on cost on the development side, it's getting harder and harder to make sense of the risk that I have to take for my private capital to build into a 6.5 or a 6 3/4 cap and hope that the exit is there so I can still make my spread. Cap rate compression is great on the exit, but I'm also feeling it on the development side, which, for risk adjusted returns, it can be a challenge.
And has that increased in the last 24 months?
Absolutely. Absolutely. With the emphasis on healthcare and all the reasons I just mentioned and all the new entrants, myself included, over the last 5 years into the healthcare space, there's just that much more competition chasing the deals. There's only so many hospital systems to go around, and those relationships are hard to come by. And so the competition to develop and build for these systems is getting tougher.
And how about you, David? You're the property aggregator. I know you play both in industrial and healthcare. Maybe you could just speak a little bit on healthcare and how you guys are approaching getting the yields you're looking for, maybe in the nuance of each sector of service.
Well, we say we don't do retail, but as was just stated, the retailization of healthcare is definitely a big theme. And our biggest play in that space is going to be more retail-like locations, working with build-to-suit developers where they're developing a multiple fleet of urgent cares or some form of distributed medical service. Our ability to seek or be competitive on system-based, campus-type buildings is just probably non-existent, really. It's a tough space to be in. The people that do it are very smart and do it quite well. So, that's going to be probably our role in healthcare. And we do have a couple deals in the hopper, in that respect. Anecdotally, since we were talking about the highest cap rate that you ever was and people were involved in, the first deal I ever did was in June of 1985. It was about an $80 million deal with an A-rated pharmaceutical company, and it was a double-digit cap rate. It was a flat deal for 20 years, as was many of those deals in those days. But on a relative basis, just to digress a bit, on a relative basis, that might have been a 10.5 cap rate, but the 10-year treasury was 12. So, right now on a relative basis, the cap rate spreads, even as low as they are relative to, other normative aspects of interest rates is really quite robust. So, but the market has just changed dramatically in that respect. And I think the flow of money into net lease as a recognized asset value, as a discrete recognized asset value, coupled with the fact that people see that spread is why you're seeing all this capital come into industrial, healthcare, even office to some degree. So
let's talk about the influx of capital and how that's just changed the game. And for the professionals in the room, what the investor, and I sort of categorize these as two different buckets. There's a real estate entrepreneur and the real estate investor. And so the investor, when they come in, obviously we've seen an influx. I think Brad, BJ, whatever he goes by, nailed it in the sense that, the commoditization of real estate has just really happened over the last decade. Before we would sell for a developer to a REIT, for a developer to an apartment owner, et cetera. They were real estate pros. Now we're getting calls from a lawyer, a person in advertising, someone that just sold 2 homes in Santa Monica, whatever it is. And that's obviously driving this downward pressure on yield with a private market, is strong. I guess the question then comes in, where's the convergence between core, non-core? Where do you guys see yield And obviously, I would say that that risk-adjusted return is shrunk, right? Versus a 7 cap dialysis in the sticks versus maybe a 5.5 cap in the city of Chicago. Where are you guys, and let's talk industrial and medical, where are you guys seeing that converge? Are those cap rates, and those yields less, and that risk-adjusted return isn't there? How do you guys feel about that? Adam, why don't we start with you down here?
One of the things we're seeing in the industrial sector is, cap rates are at historic lows everywhere you go. But one of the things that I've found interesting is it used to be the major distribution markets, LA, Southern California, Texas, Florida, Eastern PA, and Chicago. Those markets always had about 150, 200 point spread to the secondary markets, the Milwaukee's, Indianapolis, those type of markets. So
sorry, just so we're setting the table right, we're talking core.
We're talking core Class A.
Got it. Okay.
What we're seeing is that the difference between a secondary and a primary market has really come down. That spread is as low as I've ever seen it, and it'll be interesting to see what really, in our world, what Wall Street starts to say about investing in secondary markets, because that used to be a big no-no, and as far as I know, still is. But we're seeing a lot of non-public capital going to the secondary markets. It's driving cap rates down, where what building 24 months ago in Milwaukee, so same building in Chicago 24 months ago would have probably traded right around a 5, call it. And in Milwaukee would have traded at a 6.5 to 7. Today, that building in Milwaukee is going to trade at a low 4s cap, 4.3, 4.4, and that building in Chicago is going to trade at about a 4.
Wow. So what are you seeing there, Steve?
Yeah, just to kind of tail in on that, I think that obviously the core markets are going to continue to do well. The coastal markets, the port markets. I personally think the secondary market's like the new core market. You're seeing such an influx of opportunities where these markets are becoming strong markets. And I'm talking about Midwest markets down to, call it Tulsa, Oklahoma City, over to the Carolinas. I've seen more deals in Ohio in the last 12 months than I've seen in the last 10 years, just to use a state, for example.
Yeah.
But the demographics are there. The fundamentals are there. You're seeing growth in some of these 2nd tier and 3rd tier cities. So you've got labor, you have highway access, all the fundamentals that make sense for industrial.
And what's your investment thesis? Are you going to the secondary market to get that 50, 75 bip spread, or are you staying more, core and primary market, et cetera?
Yeah, just due to our cost of capital and the way we're structured and where we try and blend to on a cap rate basis annually, we're just not going to be competitive in most of those core markets. So we are looking more, we'll look at deals, and, I think Brad talked about it earlier, where you've got in a core market, but you've got a shorter term lease, you've got a very fungible asset that you're not really worried about. There's no concern when it comes to reletting or, releasing the asset. And so we'll look at some of those opportunities in the primary markets where you're calling it more a core market. But we are probably, I'd say, heavily weighted in, if I look at my pipeline right now visually, it's probably more secondary and some tertiary markets, but the tertiary markets makes sense fundamentally.
So are you seeing the sustainability on the use side? And are you forecasting rent growth there? Is that sort of how you're compensating for getting there, or you just?
Yeah, I think we're being very conservative in our assumptions, but yeah, I think it's fair to say you're going to see rent growth across the board in industrial, some markets more than others, clearly. You're not going to see rent growth in outside of Cleveland that you will in Long Beach, but I think industrial, due to the demand and where we've seen it the last 12 months and where we think it's going the next 24 to 36 months, you'll continue to see rent growth in those markets. Absolutely.
You're going to have to see rent growth in a lot of these industrial markets because the price of the buildings is growing so exponentially right now. Industrial buildings gone from $40 a foot. That same building now is pricing at $56, and that's over less than the last 12 months.
Let's jump in on medical, I guess, and industrial.
I would just add, what we try to do and what I think is a good strategy is to try to find secondary markets that are perhaps underappreciated. I mean, you might have said that about a Cincinnati or an Indianapolis or Kansas City. 5, 6 years ago, but look what they've become. And you've probably received a nice appreciation in your asset if you were to go back out and sell that. I've operated under this thesis that Southeastern Michigan is an example of what I'm talking about. It's the Silicon Valley of the worldwide automobile industry, no matter what the propulsion system is for the car. So all the technology and the tier up and tier down relationship of the designers and the engineers mode, that's going to be a very established thing. But it's a secondary market, but until recently you could do really good deals in that market with a 7 handle. So that's a goal and I'll put St. Louis into that category as well.
Okay.
It's kind of underappreciated, but there's a lot of reason to think that there's going to be some good growth there.
Yeah. John, how about you? Are you guys playing in secondary markets? And
We love secondary and tertiary markets. For us, when we evaluate, in the case of a healthcare asset, for us, it has to have a connection to a health system. And that could be by way of tenancy, and the system is represented in the building and has leases with you, or it has to have a geographic connection to a hospital campus. Because for us, sort of the center of gravity in a healthcare market is the mothership hospital, and then the off-campus MOB activity that goes up around it. And that doesn't change if you're in Topeka, Kansas, or Fort Wayne, Indiana. These people still need healthcare services, and there's still typically a dominant health system player, even in a market of that size. The last 3 or 4 deals we did were in what a lot of people would consider tertiary markets. And for us, it means, number one, there's less competition and less eyeballs on it from a developer standpoint. And number two, the health system landscape is way easier to figure out in a secondary or tertiary market. And what I mean by that is, in Illinois, in Chicago, Cranes publishes a list every year of the 20 or 25 largest health systems in the state of Illinois. That is an incredible amount of health systems for this geographic area. You go to a market like Indianapolis, and there's 4. And each of the systems in Indianapolis sort of has their fiefdom and their sandbox that they play in. They have their flagship hospitals, and then they have their clinical network that surrounds them. And what that does is it allows for freedom of movement for smaller private practices. So if I'm looking at a value add lease up business plan, and I know that there are smaller private practices expanding and looking to add clinical locations or expand their footprint, okay, so now I can work on a value add business plan. But in a market like Illinois, that can be very challenging because sometimes there's paralysis from the smaller private practices because they don't want to make a move that somehow hurts their ability to be acquired by a hospital system or a larger private practice that's kind of in a consolidation mode. So going all the way back to the top, it just seems like the health system landscape is a lot more stable in some of these smaller markets, which is where we find opportunities.
are the institutional investors coming to you, or are you selling to a lot of, funds, private REITs, family office?
We, on our dispositions, we are selling both to private capital and to, funds that are still private, but I would call them more institutional because they have a national presence. So we're seeing both. But on the buy side, it seems that, scrappy real estate guys like myself, there are less and less of us because it's a tertiary market and it's a deal that has hair on it. And that seems to be where we're able to unlock value. But once we've kind of completed our plan, it becomes an attractive asset for all the folks in this room.
Yeah, I guess there's no free lunch. The spread's the spread, whether you're, a 6.5 to a 5 in a core market or a 8 to a 6.5 in a secondary. So it's good to hear that there's capital in the secondary markets for healthcare. I just want to talk about development a little bit in terms of, we'll stay with you on healthcare. What are you seeing in, let's just stay focused on the single tenant space, the de novo, the build to suit. Where's the demand? Are these PE firms that, are expanding? Are these health systems that are realizing that the delivery model for healthcare has to be outside of the mothership, like you said, and more service-based and convenience-based locations. What's going to fill that pipeline for just single tenant net lease product?
For us, we've seen an opportunity to partner with private equity firms that have made an investment in an MSO or a DSO, and now they have this vehicle.
And let me just interrupt. So a DSO and an MSO is management service organization, dental service organization. It's where all the practices sort of get bought and put under one umbrella.
So a private equity firm will make an investment in what at its onset was a 1, 2, 3, 5 unit operation. And now the PE firm acquires it and there's a mandate for growth. They didn't just buy it to sit on it, right? But they need a real estate partner to act as a conduit for that growth, because the PE firm is not set up to do a programmatic rollout. And so a group like ours can go to a specific market or a number of markets, identify the opportunities, execute the real estate strategy, and we can get into ways to manufacture value with the leases, but we're an outsourced real estate department for private equity firms that have acquired dental, derm, autism therapy, urgent care, physical therapy.
And so that's where I was going is physical therapy has been around. Dialysis has been around. Are you seeing more in the ambulatory space? Are you seeing more in the behavioral space? I'm just trying to figure out where you're seeing more demand.
Behavioral is becoming more prevalent. There is what's the word I'm looking for? There's the stigma on behavioral health. And even there's sectors within behavioral health, specifically addiction treatment. We've done deals with an opioid treatment tenant. It's private equity owned. We've done a number of those where we'll acquire an old orthopedic office, single tenant, 8,000 square foot building. We know the tenant wants to be there. It fits their criteria for expansion because they have all their algorithms that tells them this is where they're going to be able to have the most impact for their patients. And we retrofit this orthopedic office, and it's now a single tenant net lease deal. But it's in a space in behavioral health, and more specifically in addiction treatment, opioid treatment, which is a whole huge we could have a whole day's worth of panels on the opioid epidemic. But that's an example of where we helped a private equity firm and for a tenant and in a space that 5-6 years ago people weren't doing opioid treatment clinics.
Right.
And now they're more of a household name, if you will.
Thank you. Thank you. Let's switch over to the industrial guys. David, what are you seeing in terms of tenancy? Obviously there's Clorox and DuPont and P&G or whatever. Are you looking at deals with more 3PL logistic guys? Are you looking at deals that are like manufacturing or just different sectors within industrial that you may have not really thought about before that you think are here and to stay and to grow and thrive?
Well, I mean, as far as where we see opportunities, it's probably a deal that might be secondary, might actually be a tertiary market. It has a manufacturing component. If it's 4 walls and a roof in Maine in Lehigh Valley, the developer has absolutely no fear of exit and no lack of capital chasing that deal. So we try to look at deals that have something different, something where maybe it's a little bit higher basis, but it's supported by a long-term lease. And those kind of deals we see a lot of it comes from M&A activity from private equity firms that are either buying and actually working on a deal that's part of the closure of the M&A deal, or monetization of the assets after the deal is completed. So we see opportunity there. And that's where we're focusing. I mean, we'll keep our head in the game on the really high quality and investment grade stuff, but it'd be hard for us to compete with some of the REITs and people that really are just basis buyers. This is a net lease forum, but when you come to that kind of asset category, the 36-foot clear tilt, so on and so forth. Pricing is totally agnostic as to tenancy and term. A 5-year deal with nobody is going to be priced not much differently than a 15-year deal with an investment grade credit. The only difference might be if you could potentially CTL a longer term lease, there might be some pricing differential, but by and large, it's an agnostic market as to the things on real Class A industrial right now.
Steve, you want to jump in on that?
Yeah, I was just going to say, about a year ago, we closed on a 4-building portfolio, Indianapolis, Oklahoma City, Atlanta, and St. Louis. Couple of investment grade tenants, others were sub-investment grade, but great distribution buildings, good, very strong secondary, one primary market, excuse me, being Atlanta. That deal now, had a WALT of about 10 plus years, 4 different tenants, all buildings, single tenant, obviously. I don't recall the cap rate, but it probably compresses 100 basis points now. So what we've done is to kind of touch on what David spoke about, is that we're looking at opportunities in other markets, but not just other markets, but different building types. So heavy manufacturing, stuff in the construction supplies, auto parts sector, especially EV is very hot right now.
So you find a little better yield when you go out a little bit on the, getting off that traditional sector use?
You get out of the traditional, what people think of as industrial.
Yeah.
I mean, we love something that's manufacturing. There's interior cranes. They're on 60 acres with X amount of square feet outside storage, lay down yard. I mean, that tenant can't leave. You can't replicate that. You can, but it's tough, right? So they've got heavy machinery in the building. They need the lay down yard. There's a reason they have to be there. You look at it, it's not pretty, it's not sexy real estate, but it works for them. And it's, they're not going anywhere. And the cost for them to go somewhere is substantial.
But,
they've been there for
but again, if you're pricing in yield, it cuts the other way, or it slices the other way on the sword, which is if they leave and you're in the sticks, and that's a heavy steel manufacturer with 15 and 20 ton cranes, and they go bye-bye, you theoretically should be pricing in some of that risk, right?
You price in that risk and you get paid for the risk. I think that you're looking at it, maybe it's a high 6 cap deal, maybe a low 6 cap deal, but they've been there a long time. And so you're getting paid for the risk, but
So there's still deals out there. There's still deals.
Right.
Yeah.
Yeah.
How about you, Adam?
Yeah.
We're more on the commoditized side of things. We want to develop that box in Maine and Lehigh Valley. Where we try to differentiate ourselves on the acquisition side is speed. We can close pretty much any deal that we want to buy. We can close in less than 30 days. We don't have any outside debt. So it's a quick meeting and we're good to close. Where we can differentiate ourselves, the other way to differentiate ourselves on the buy side is we're looking at the asset. As said earlier, we're looking at the asset. We're not so concerned with the tenant. If it's a good asset and the tenant goes out, as long as we're buying it at a market rate, it'll lease at a market rate, and we can do that quickly in-house. On the development side, where we try to differentiate ourselves is speed to market. So a tenant comes along for a build-to-suit. Somebody that doesn't control any land doesn't really have any edge in that. There's probably 20 people, including a couple of general contractors, that can put up an industrial building in Chicago if the tenant and their broker go out and identify a piece of land. We try to control land. We try to have that land pretty much pad ready. And in today's world, it used to make a huge difference on the development cycle. In today's world, with precast and steel being so far out, it doesn't help as much, but it takes a ton of risk out of the project for the tenant, and it does compress the time frame. Unfortunately, instead of 24 months, we can maybe get something up in 16 months or so. But whereas it used to be the difference between us 6 to 9 months and somebody else was maybe 18. So
sort of tangential, but just curious if this use, we'll start seeing more. Is there an onboarding with manufacturing? I would also say maybe in the biotech sector as well. It was pretty interesting when COVID hit. I never realized that the United States doesn't produce any of its own penicillin, for example. I think that's not only a national security issue, but we've got to start onboarding some of these essential needs. Are you guys seeing, whether it's, healthcare and biotech, or whether it's industrial with essential goods, are you guys seeing more tenant demand on the development process there, or is it just still logistics and we're a consumption country and that's what we do? Or
for us, we're not seeing the manufacturing side because that's not really our niche. to talk a little bit about the logistics side, I mean, the prime example of running out of toilet paper when COVID started, right? Nobody wants to be the next company to run out of whatever it is. So, we have one tenant that's a manufacturer here in the Midwest. They're warehousing in the Midwest, but they buy the parts for their product from all over the world. So their attic stock of parts has gone from, just in time to 6-9 months production, because they don't know where the next bump in their supply chain is going to come from. And then we're also seeing that, on the consumer side. I mean, just the inventories that people are carrying are so much longer. And it's using up a lot more warehouse space. That's a big part of our demand right now in Chicago and across the country.
Yeah. Want to take it, John?
We pursued a build-to-suit opportunity for a single tenant, aseptic, injectable medical manufacturer in Spokane, Washington. This was probably 18 months ago. The challenge with it was it's a single tenant use, and I love the way they phrased it. It was a pre-revenue company, which means they didn't make any money. So how do you price the development yield and the exit on a company that, all they have is an idea and a really sexy company deck? And it was the kind of opportunity we could be entrepreneurial and pursue, but it was also a challenge because, we're always thinking about, okay, what are we going to do with this thing after we build it, and what can we sell it for? And so you asked about the reshoring of manufacturing. There is an absence of Class A medical manufacturing facilities in this country. The product that we do have is antiquated, and there isn't enough new product, and it takes so long to build. The other challenge with it is you have to have all of these orders lined up for the production of whatever medication you're going to be manufacturing, and then you build the facility. So it's sort of
So this is a third-party manufacturer of pharmaceuticals for Pfizer, Moderna, or Johnson.
That's right. They do clinical trials. So Pfizer or Moderna would contract with them to produce their clinical trials. And then ultimately when a drug gets approved, it then goes into production. So there's different ways that these facilities can operate with the big boys.
So since you didn't do the deal, what cap rate did you underwrite that to?
I'm trying to remember what it was. And we were probably in the 8 range to try to get on a yield on cost. But what we also tried to do was...
Sorry, how much was the building to build? Over 50?
This was a $40 to $50 million project. And what we also tried to do was put the tenant in the deal, right? When we can, we try to be entrepreneurial. And if the tenant can play with us on the real estate side, either by investing or just a profit participation, we can develop into a higher yield, and they can share on that upside, because we don't know what the exit cap is going to be. If it sells from between X and Y and we spread over 1.5 points or 2 points, then that extra spread or excess profit, we would offer, and we do this a lot, we would offer to share with, this company if the company's allowed to do it based on their board of directors, et cetera. We do the same thing with doctors.
It's a good way to get into a higher cap rate.
That's right. We do the same thing with our physicians. If all the physicians want to own real estate so they can tell their friends they own real estate at cocktail parties, that's why they want to do it.
Right.
But if they can be a participant in the deal on the real estate side, we love it, right? Because it aligns our interest with our tenants. If we have a way to extend their lease to manufacture value, because we're going to have a capital event, they're more inclined to do it because they're going to profit from it because they're participating on the real estate, on the partnership side. So we try to be creative when we can in healthcare and in manufacturing.
Yeah. And I don't want to steal too much thunder from the sell leaseback, but we did talk about it on our call a couple of days ago. And on the sell leaseback side, I guess we'll start with industrial. What are you guys seeing in terms of a structure? Are you seeing full net, absolute net leases? Are you seeing 10 years, or are these logistic guys so emboldened with a 15, 20-year lease? Maybe you guys could just walk through what you're looking for, and maybe where you guys have executed something on the sale leaseback front in your specific niche.
Yeah, we'll look at anything. It could be from 8 to 15 years. We prefer that 12 to 15 years, obviously. But I think in today's market, with the cap rate compression and the demand for the 15-year term, it gets pretty competitive. We're willing to take the risk on a lease back if we call it 10 years, for example. We like the tenant. We like their story. They're financially sound. They're making money. They're not a pre-revenue type idea. We've seen those too. And, I love how they hide it in the back of the deck. There's no revenue. Okay.
Right.
So I'd say that obviously we want to have a little to no obligation at all as a landlord, absolute net lease. From an industrial standpoint, that seems to be the norm, right, for the most part.
And how much on a percentage basis are you stretching, sort of overmark the market on that? If, rent's a $5 rent and it's sell lease back, do you guys threshold it based on the underwriting of the credit, the, sort of mission criticalness of the site, and you'll tap out and say, we will not pay over X on a percentage basis of market, or how do you?
There's really it's more of an art than a science for us. It just depends on, again, the credit, the tenant, what their story is, where the building is, the fungibility and pliability of the building, and what we could see be used for in the future should anything happen. And we'll stretch a little bit above market if we believe in it, but we're not going to stretch above market X% and then agree to 3% rental increases. I mean, it looks good at the front end, but I think it could turn around and bite you years down the road. Obviously, we're a long-term holder, so it doesn't really affect us. But I think it was mentioned on the prior panel, that tenant then has to stretch. They have to perform. They have to meet those expectations. And we don't want to put that stress on the tenant. I mean, we're okay with. We've looked at deals with rental increases as low as 1.75 to 2%. I mean, 2%.
So you put more saliency in the occupancy costs than the mark to market, and
I would say that's fair.
Yeah. How about you? You guys are buying, and you've just repeatedly have gone back to where fundamental industrial buyers. We're looking at the price of these buildings. How do you guys view sell lease back, and have you been able to execute on some of that?
We have, and the way really we look at sell lease back is the underlying value of the real estate. So can I buy it? Can I buy the sell lease back at or near replacement cost? And if the answer is yes, then I obviously would much rather have Amazon as a tenant than a pre-revenue company. But we're focused on the underlying asset and what's the value there, and that certainly underwrite the tenant. But if they go away, what's my next step? As far as sell leasebacks, we're looking at a lot of this core standard stuff that everybody else is looking for, and we love to do those deals. We can do them quick. But some of the other things that we're starting to look at is, we're looking right now at a sale leaseback on I guess I call them a post-revenue company. They're trying to sell it to a VC firm. And the building is absolutely terrible. And they want a 3-year leaseback, absolute net. The upside for us is if we buy the deal, when they move out, there's no renewal options. We're going to scrape the building. We've got a great development site for a brand new building, kind of main and main. So, we're starting to look at things like that where, kind of a covered land play. And we find that a lot of our competition has a hard time fitting that into one of their buckets of money. So we can differentiate ourselves that way.
Oh, that's good. David?
In the
Yep.
Okay, most of the deals we see in the sale leaseback are private equity monetizations. And what you pay for the property, we don't want to get too far ahead of our skis relative to basis and rent per foot. You are dealing with lesser credit, in some cases, lesser locations. So you want to be careful about not putting too much credit value into your pricing. A lot of terms we're seeing are 20 years. They come right out of the box at 20 years. But we are seeing a slow drift now to 12 and 15 in the sale leasebacks. And I've seen a spate of 17-year deals. And I asked a broker the other day, what's the driver of the 17-year ask on 3 deals that I've seen in the last week? And he said, well, the tenant says 15 and we say 20. So we've decided to cut it in the middle at 17. So it's not very scientific, but it's kind of the real world in these kinds of things. Most of the deals that are sale leasebacks are truly absolute triple net leases. We would be open to some landlord responsibilities in those kinds of situations, but you don't really want to buy somebody else's problem. Now, if you can find a problem to solve and build that into your pricing in some kind of a aspect of the deal, then it's a different story.
I think when we evaluate sale leasebacks, we do so with, there's certainly quantitative reasons to do one, and then there's qualitative ones. And the qualitative factors we looked at in the healthcare setting is, you're buying the practice, but who are the physicians in the practice? How much gas do they have left in the tank? Are they, young, and do they just hire 3 more physicians and they want to take that capital and expand and add more locations? Or are they in their 60s and they're empty nesters and they want to go buy a boat? There's different reasons people do a sale leaseback. And for us, we looked at a portfolio of, I think it was 25 or 27 dermatology clinics in the Southeast. And we were executing the sale leaseback with them because they wanted to use us as, again, this conduit for growth, because we were going to go on a roll with them and roll out additional clinical locations in addition to providing capital and helping them exit, the ones that they already own. And what ended up happening was a hurricane hit the Panhandle like 2 days before we were supposed to go non-refundable. And so we didn't know what that was going to do disruption wise to their business. And so we ended up backing away. But it's an example of how we were going to try and use a sale leaseback as a means for additional de novo growth.
Okay. I think we just went over our time by 5 minutes. So that flew by. I do want to leave with just one quick question if I can. Let's just go down the line. Where do you guys see cap rates in the next, call it 6 to 12 months?
Start down at that end.
Okay.
I think we're going to see 6 to 12 months. I think we're going to see cap rates probably continue to dip a little lower. At the outside of that 12 months, I could see them maybe coming back to where they are today. I don't think there's going to be a ton of movement. The fundamentals are, especially in the industrial sector, the fundamentals are just too good.
Okay. David?
We don't see a lot of change. I mean, I subscribe to the idea that this inflation bump that we have right now is really more of a pig in a python, and I don't think it's going to really change the needle much on prevailing interest rates. So I think that spread's still going to stay where it is. Capital flows keep coming in. I would say there's a small bias to compression of cap rates, but not a material change from where we are.
Thank you.
If I'm buying, I hope they come up. If I'm selling, I hope they go lower.
Well, where do you think they're going?
No comment.
All right. Good answer, Steve.
Yeah. The reality is we're in the longest bull run we've ever been in. So nobody knows. I think from an industrial standpoint, and that's all I can really speak to on my end, is that I would not be surprised to still see slight compression over the next 12 months. I mean, every time I turn around, there's a different money source in the market. There's a new family office getting involved. How much? Probably not what we've seen the last 12 months, but I would not be surprised if we see, call it 5 to 10 basis points, depending on the market, continual trickle quarter to quarter, possibly. But if history is any indicator, it's going to have to stop at some point. But, we don't know.
Thank you. Thank you all for listening. Panelists, thank you for participating in your time. Sorry we don't have time for too many questions, but thank you. Have a good day.
Okay, thank you, Mark. I appreciate that. As he said, I'm the Director of Business Development with Envoy Net Lease Partners. We're based here in Chicago. I'm sure, as you can tell from my accent, I am not from Chicago. So I'm from South Carolina, like Brad. That was good. That was good to hear. But I thought before we got started, I would let each panelist take a couple of minutes to introduce themselves, tell a little bit about their company and their role with the company. And Sean, you're virtual with us. Good to have you. And why don't you start us off with the introductions?
Sure. I'm Sean Keene. I'm the Net Lease Finance Director for First Savings Bank. We're headquartered in Louisville, Kentucky. We are a national direct lender in single tenant investment grade asset. Recourse, non-recourse. Our primary profile is the 1031 exchange investor.
Great, thank you. Dave?
Good morning. My name's Dave Collins. I am with Motive, which is formerly Rich Uncles, which we'll explain in a little bit. Head of asset management. We're a company with about 500 million under management, basically single tenant, but some double net leases as well. About a third office, third industrial flex, and a third necessity retail. Great.
Hi, everyone. I'm Katie McLaughlin. I'm a director at Prudential Private Capital, which is part of PGIM, the asset management business of Prudential. I'm on the CTL team, so we provide financing for single tenant properties with long-term non-cancelable leases that are leased to creditworthy tenants. We provide construction and permanent financing and also financing to facilitate acquisitions and sale leasebacks. And it's all based on the underlying credit. So we're property type agnostic. So we really provide financing for all property types. And construction side, we've been very active recently providing financing for build-to-suit projects.
Great. Josh?
Good morning, everyone. My name is Josh Zhang. I'm the Director of Investments at Four Corners Property Trust. Four Corners, as you all know from Brad's presentation, we're the Darden spinoff REIT. Just about 5.5, almost 6 years old now. Public under the ticker FCPT. We started off buying just restaurants, but now have expanded across medical, automotive, and other types of single tenant retail net lease.
Great, thanks, guys. Glad to have you here. So we've got two from the lending side and two panelists from the investment side. So that's great. I thought we'd start things off from the borrower investor standpoint, and this will be directed toward Josh and then Dave as well. Josh, can you tell us what it was like accessing capital during the pandemic and how it compares to raising capital today?
Yeah, happy to. Let's just say it's a lot more fun today. I think everyone remembers the start of 2020. The capital markets were actually on fire. 10-year treasuries were at a all-time low since 2016. Our company's stock was at an all-time high, and the music was playing. I think when COVID hit, obviously the credit markets froze. The capital markets basically came to a halt. Temporarily for a short time. I think what was surprising to me was just how quickly things rebounded. And I think, there was a temporary halt, and then, you had some opportunistic sources of capital out there. So, you could still access capital, but it's going to cost an arm and a leg. And then pretty quickly then after, things came right back. And as everyone on the previous panels have mentioned, the market has just sort of roared back both on, capital abundance, investments, and this, that, and the others.
Great. Dave?
Well, we're in a little different position because we started as a crowdfunding company. We're a non-traded REIT, public REIT, and we started in 2015. Our thesis was that the crowdfunding space gave us the ability to talk directly to the retail customer, which in our case was private investors. So we went through that process. We set up two REITs, treating it as a California REIT and then what's called a Reg A REIT to go to non-accredited investors. So we were really transitioning to a different model when COVID hit. So we had stopped our fundraising. We had gone to an accredited investor model, which quite frankly didn't work that well for us. What was happening was there were a lot of other crowdfunding REITs out there. They were going to direct asset investment. So they were taking individual assets, bringing them to market. The returns were much higher than what we could offer. So that pool of capital really shrank. We took the opportunity to rebrand. So we rebranded as Motive from Rich Uncles. If anybody here is from Southern California, I'm sure you heard those commercials because they drove everybody crazy. But at the end of the day, we were in a rebranding mode. So we needed more institutional capital. So we recently did a preferred stock offering of 50 million. The bankers basically came back to us and said, oops, we didn't go high enough. We could have gone higher. We heard upwards of 90 to 100 million. So that was at the end of this COVID cycle, but I think it speaks to the fact that, as we've heard on and on today,
There is so much capital out there. For us, the crowdfunding model is still part of our DNA, but it's less important. It's not a good source for accumulating large amounts of capital. The institutional side is where we're playing today. We're able then to go out and acquire properties at a larger scale than we could have prior.
Great. Thank you. Let's venture into the lending side just for a few minutes. Sean, you're on the banking side. Can you give us an overview of the current lending market right now and how it relates primarily to the permanent net lease financing?
Sure. On April 1st, 2020, April Fool's Day, 2 weeks into COVID, I took 2 phone calls early in the day from landlords. One owned a Chipotle, one owned a Panera Bread, telling me that those 2 national investment grade tenants would not be able to pay rent for the next 90 days. I thought the Armageddon. We didn't take any more phone calls after April 1st. And from that date till today, the activity level from the bank net lease lending side has been triple the volume, the opportunities. It's been something that we would have never anticipated. Aggressive, almost insane pricing and structure from our competitors to win deals, all-star deals, investment grade in primary trade areas. So it's a time we've not ever experienced. And to hit certain numbers that we need to hit, we kind of have to dip our toe in that arena of maybe being a little more aggressive than we would want to, just to win our fair share of deals. And I'm hearing this from competitor banks that they're experiencing the same levels. Words like interest only and non-recourse at high leverage that banks typically would not have even entertained are starting to get there in order to achieve the volume goals that they need to hit.
Absolutely. We're definitely in unprecedented times and the markets are very strong right now. Financing markets, I should say. Katie, you're on the lending side as well, but involved in some different areas than Sean. What is your take on the lending market right now, specifically to construction lending?
I would echo a lot of what Sean just said in terms of all the activity and sort of the short-term situation that happened right at the beginning of COVID, when I think a lot of asset managers were really focused on their portfolio and trying to assess, okay, what are the implications, really focused on portfolio management, and the market was a little bit upside down at that period. Also, that was sort of the April 2020, May 2020 timeframe. But then since then, it's been extremely active. We've seen, a ton of opportunities. And I think, like everyone, sort of deal triage is a big focus of sort of, given how competitive everything is, where do we spend our time, especially if we, are seeing pricing or terms that we think just don't make sense. And so that's where we have focused more on build to suit activity, where we can get involved early. A lot of times a lease has to, have certain things in it to make it best suited for CTL execution. So that's even if it's just extending the lease term, because the way that CTL loan is sized is it's basically a present value of all of the rental payments. So if you have a 20-year lease instead of a 15-year lease, you can get much higher proceeds. And so getting involved in those conversations early has benefited us. But yeah, absolutely. In terms of rates are super low. And even as we've seen treasury rates kind of creep up a little bit, we've seen credit spreads compress. So you're still sort of in the same place that you were in from an all-in coupon rate perspective. Certainly a lot of transactions that are 20 years or longer are getting done inside 3% fixed rate. So very competitive, kind of continues to be. So we'll see going forward, but we're seeing a lot of activity and it doesn't seem to be slowing.
How's your deal flow today as compared to pre-COVID type times?
Yeah, so on the CTL team, we actually had our biggest year ever in 2020. So, we had a little bit of a blip, I would say. But also there were other lenders that sort of pulled out of the market a little bit in sort of the depths of COVID. And so that allowed us to be a little bit more opportunistic on certain transactions. But yeah, very, very active.
Right. Yeah, deal flow. You heard deal flow discussed earlier in the first panel, and that's something I'm going to touch on now. We're from an investment side, we're in an environment where demand greatly outpaces supply, as we all know that. So, Dave, let's direct this at you, and Josh, from an investment side, you chime in after Dave. But in this environment of aggressive demand, lack of supply, how have you had to modify, or how has it affected your investment strategy?
Risk. Quite simply, it's more risk.
Right.
So we're playing in three groups. As I said, we're in the necessity retail space. We're in the what I would call light industrial manufacturing, and we're also in office, suburban office, back office, suburban office. The perfect trifecta of where you don't want to be today. I think Sean mentioned the rent stream was, he had a blip. We were fortunate we didn't have a blip, but the day of reckoning is coming. So from an acquisition perspective, we acknowledge that for us to get the yields we need, which is in the 6 to 7 range, we're going to have to go out the risk curve. We're pretty agnostic when it comes to what we'll look at. So we're really a very flexible business. So, we're looking at stuff with very short lease terms. We're looking at stuff that has some CapEx risk. We're looking at stuff that has locational risk. But we do try and buy smart. So we're always cognizant of how do we get out. Now, some of the folks on the panels here were long-term holders. We're frankly agnostic on that as well. So you could argue that we look at every deal for the blank slate. And that's kind of how we look at it. We really need to get money out. So for us, we have a fairly experienced team and we're very nimble. So we can really assess a property very quickly. We can do a good risk assessment. You also heard today that speed to market matters. And for us, it does as well. So we're an all cash buyer. We will do things like order our third parties before we're even close to having a PSA negotiated. We're doing everything we can to get to the front of the curve. The other thing we've changed philosophically is we don't like to do anything but our best offer early. What we found is that what worked for us in the past, where we would go in and we would have the kabuki dance back and forth for 4 rounds, 5 rounds. We just don't play that anymore. We acknowledge up front that we're probably not the most preferred buyer, so we have to be the strongest. And so we go in very strong early and communicate that to whoever's on the sell side to make sure that they understand that we're kind of doing our best and final early. It doesn't always work. As you know, there's so much out there that every strategy is subject to a lot of retrades, but we've won our share in the last year. But again, the stuff we're looking at, it is not institutional. So when you look at an industrial building, we looked at one a month ago, it was 24 clear height at one spot in the building. The eaves were 14. It wasn't cross dock. Oh, and by the way, the lease term was 4.5 years. We will look at that. Why? Because it was in a great location off I-95. And we knew that somebody earlier said, if they left, we'd scrape it and build a better, bigger, shiny new toy. That's our philosophy. So again, very nimble, very opportunistic, willing to take thoughtful risk, but at the same time, part 2 to that story is there were 15 bidders on that asset. And one went hard with 500,000 day one. So it's tough out there.
It is very tough. Josh, your company targets restaurant properties. And so how is the current supply demand imbalance kind of impacted restaurant market and other retail markets for you guys?
I have to work a lot harder. I think, it's not just in this current environment, although it's especially accented right now, but as a public REIT with, public capital, there's always an immense amount of pressure to do more. To buy more, to grow more. Great. You did 200 million last year at a 6 cap. Why don't you do 300 million this year at a 6.5 cap, right? And I think, one of the main lessons for us during the pandemic was because, as Dave mentioned, how you do more is you take on more risk, or you get more creative, or you offer these services. And I think that's something that we're definitely looking at and thinking about as well. But, one of the biggest lessons for us is to kind of just stick to your guns and stick to your gut. Thinking about our acquisition criteria today versus 2019, not to sound smug, but it hasn't changed much. We never bought a Starbucks without a drive-through. We don't buy assets on the backside of a mall or shopping center. We focus on not only four-wall economics, but credit and the trend that this is going. And I think, obviously every player, every institution, every buyer or seller has different mandates. But for us, we're about being patient capital. And if we don't need to, don't take on more risk, right? Just to fulfill volume. I think, one area where Four Corners has been fortunate is that, we were previously confined to restaurants. And so instead of having to necessarily take more risk right now, we have expanded the top of the funnel. And so we've gone into automotive, medical retail, auto service. And so that's helped us still find supply and acquisition activity out there without necessarily having to come in on price or go down the risk spectrum as much as, the pressure is on there.
Right. Dave, do you have any thoughts on how long we're going to kind of be in this period of heightened investor demand and lack of supply? Any thoughts on that?
Well, I think it's easier to talk about one side versus the other. I think that, everything we've heard today, I would echo that nobody's seeing a fundamental sea change occurring in the next 12 to 18 months.
Yep.
I might be a little less sanguine about inflation and the impact on interest rates, but other than that, I think, my views echo most of the panelists that I heard. What was the second part to your question?
Oh, that was it. I was just saying about the supply demand balance. Kind of.
I mean, one of the things that gives me pause, and we're a little off topic, but we were talking about industrial, and yesterday we have an industrial building out in DeKalb, and I was out there yesterday, and I drove around, and our office is in Newport, but I live in Dallas, so similar topography, flat. I probably saw 30 signs of available land to build on for industrial. My concern on that front is it's easy to build, it's quick to build. How high is high? And it's a concern that we talk about a lot. I mean, right now, I'm old enough to have been through a number of cycles, and I can tell you it's starting to feel like a bubble to me. It's starting to feel pretty frothy. Mm-hmm. And it's driven, if you want to talk about the 800-pound gorilla, it's Amazon. And so from our point of view, we're not seeking those kinds of properties. We just don't know where they're going to end up. So we're not pushing. We're really going for the more, I think earlier was talked about some private equity guys buying manufacturing and then monetizing that. And we're all over that asset subclass. We love it. And that can be in, Podunk, Pennsylvania. It doesn't matter where it is to us. If there's good highway access, we think the fundamental business is solid. We are definitely going to take a hard look at that kind of asset.
Great, thank you. Let's touch on underwriting a little bit. Sean, from the bank side and where we are with demand as strong as it is, what's the current state of underwriting on the permanent loan side?
Yeah, well, to us, a new buzzword obviously came into play once COVID hit. Essential tenant, the C stores with the gas pumps, the QSRs, the pharmacies. Those dominate our pipeline and have dominated our pipeline the last 18 months. I would probably venture to say 80% of our business is, the C store with the gas pumps, QSRs with drive-throughs, and the pharmacies. We're starting to see COVID clauses in some of these leases, Starbucks and 7-Eleven. So getting a handle on what implications that could be down the road, God forbid we ever get there again, what kind of rent abatement will be introduced into the to the rent payments, and what that does to the cash flow. Will you match it with a mortgage abatement? Those are questions we're all kind of discussing internally. But, you know, we haven't wavered one bit on our underwriting fundamentals. You know, we're in a different world. We deal with 1031 investors coming to us with predetermined equity of, you know, 50 to 60% equity. So we have a lot of cash in front of our mortgage, and we feel very comfortable. But we've really not, you know, wavered on pushing the envelope on just our historic underwriting fundamentals.
And from your perspective, has there been much pressure to try to waiver or relax some of those underwriting guidelines?
Sure. I mean, there's volume pressures to get ultra aggressive. But we really have tried to resist as much as we, you know, as much as we could. But the temptation certainly has been there.
Great. Thank you. Katie, for you, how about your state of underwriting right now, especially as it relates to construction lending?
Yeah, I agree. I mean, our underwriting standards are the same, which is it's all based on the underlying credit, but we also feel those pressures. You know, the way that we're benchmarked is off of public corporate bonds. So CTLs are treated like bonds on insurance company financial statements, not mortgages. And so because the yield profile is superior to a public bond, life insurance companies want as much CTL product as they can get. So certainly there's a lot of pressure on us to originate. So given that, you know, we are looking at just more broadly, this is, I would say, across the industry in the life insurance company space, looking at more sort of like a hybrid between a CTL and a real estate loan. Historically, the traditional CTL was fully amortizing. So all of the debt gets paid through that initial lease term. But there are some structures being put together now where there is more of a residual, still very conservative residual, but that helps make the numbers work a little bit more, you know, in this competitive environment where the benefit of CTL to the sponsor is getting maximum proceeds. So to the extent you can have some residual, that really helps. So we're looking at those on sort of a case-by-case basis. Part of it too is there was some regulatory concern about how those types of structures would be treated, kind of going back to what I say about is it a bond or is it a mortgage, but there has been some clarity from the NAIC, which is the sort of regulator of insurance companies, about those structures kind of you know, being okay. So I think that will open up, you know, something that's new and creative that we'll be pursuing, but you know, every situation is different. And we think about credit first and then sort of property second. And, you know, the stronger the underlying credit, the less we're focused on essentiality of the asset to the tenant. If it's a more cuspy credit, then we want to be secured by a property that's really important to them that they want to continue to pay rent on. So that's how we kind of think about it holistically when it comes to underwriting. And then on the construction side, I would say, you know, we do take construction risk. So, you know, we'll fund during the construction period, but it is well mitigated construction risk. We'll look to have a GMP. We have actually an in-house construction monitor called PGIM Real Estate Loan Services that helps work with us and kind of oversee construction. And so we have a lot of kind of provisions that get us comfortable to be able to provide advances, multiple advances during the construction period, like a bank lender would, and then it just converts to the perm once the tenant moves in and starts paying rent. So we feel like we've gotten a good, you know, we have a good track record there, and we have sort of a good program in terms of assessing construction risk. So that's definitely been a big area of focus for us.
What are you seeing as the biggest challenges that borrowers face today in financing their projects?
On the construction side?
Construction or perm or
well, Sure. So I'll talk about COVID, I guess, because we were very curious is the wrong word, but nervous, I guess, to see how all of our construction projects would fare during COVID. And actually, surprisingly, there really wasn't much delay as it relates to like crews on the ground. Most of the delays were actually related to permitting and approvals at like the municipality level, because a lot of offices were closed during COVID, or they didn't have the right people in, or they couldn't accommodate signing documents virtually, like, you know, things like that. But for the most part, our projects were on time and on budget, which was good. And I think general contractors are very aware and have been of the whole supply chain situation. And so, you know, we do have those GMPs, which offers protection where the general contractor is basically backing their hard costs. And so they've, you know, built in more contingency, had, you know, budgeted more time, are billing stored materials. So they, you know, acquire the materials earlier. So that's actually, I think, gone better than maybe we were thinking and we were certainly worried about. So it seems like, you know, for the most part, the construction projects have been progressing on time.
And have you seen the construction costs start to moderate a little bit?
Yeah, so
recently?
we've heard that. Yeah, this is just sort of something that I've heard within the past couple weeks, actually, is that, you know, maybe we are sort of past the peak of, you know, costs being really high, and that, you know, the view is perhaps we've turned the corner on that. So it remains to be seen, but that's sort of the latest that I've heard.
Great, thank you. Josh, this is for you. How have you seen businesses and operators manage their balance sheet and access capital differently because of COVID?
Yeah, that's a great question. You know, I think for the short term, you see a lot of businesses and operators act a bit more conservatively, right? It's like having a stable, conservative balance sheet is like wearing your seatbelt. It doesn't really matter until it really does. And so, you know, right after COVID, we had a lot of you know, operators that, you know, held cash reserves, paid down debt, you know, made sure books were in good order. I think we are now entering another phase where we're seeing a lot more aggressive growth. Rates are low again. So, you know, you could argue that, you know, a pure debt to EBITDA multiples no longer as relevant or can't compare apples to apples to before. And we should look at, you know, debt service coverage ratios or interest payment coverage. I think regardless of, you know, what metric you want to look at, it's, you know, again, as mentioned, kind of just sticking to your underwriting. You know, Sean was mentioning and everyone else on this panel that there's, you know, immense pressure to kind of flex things to, you know, get that last deal in, whether it's deal structure, underwriting standards. And for us, you know, just trying to stay as disciplined as we can, and when evaluating operators and doing investments.
You were all trying to stay disciplined and achieve the yield, right?
That's right.
That's exactly right. That's basically the bulk of what I had for the panel. Do we have any questions out there that anyone would like to direct to anyone on the panel as regards to capital markets?
Too close to lunch.
Yes, getting too close to lunch. Exactly. Would anybody like to make any other comments before we adjourn, or is everybody good? Good. Okay. Thank you. Thank you, Sean.
Thank you.
Mark, did you want us to get started? Val? Okay. Hey, almost good afternoon, everybody. My name is Dan Wagner, and we're here to talk about 1031 and the net lease space. I appreciate Mark Menzies for having us here. The Real Estate Journal has been around since 1985. 1985 is the year I graduated from high school. So This is a great organization. We are going to be talking 1031, and we have some really good people here on our panel. We have two folks that are not with us, but they're on the Zoom land world. And what we're going to do is I'm going to introduce myself and my company, and then I'm going to ask each individual to do that. So my name is Dan Wagner. I'm with the Inland Real Estate Group of Companies. We're in Oak Brook, Illinois, and I'm the moderator. Inland has been in business for over 50 years. We were created by 4 Chicago public school teachers. They got other Chicago public school teachers to give them money. They raised that money and they did so well. They left teaching. They ended up having 42,000 apartments in Chicago. They're the largest landlord of Chicago. The tax laws changed in the 80s, and the limited partnerships they had, some of them were underwater, so they wouldn't let other teachers go bankrupt. So they went to Walmart and they said, hey, Walmart, can we do sale leasebacks with you? Walmart said, sure. They went to Treasury. They said, Treasury, can we 1031 exchange these people into a fractional share interest in these Walmarts? Treasury said, oh my God, you're going to save these people? Go ahead and do that. And that was kind of the pivotal moment for Inland. And now we've purchased over $50 billion worth of commercial real estate in the United States. And we were the ones that created the 1031 like-kind exchange all those years ago. So that's me, and my job is to be the government relations guy. And so we work really hard at Inland to protect and defend the 1031 like-kind exchange, which is near and dear to everybody here. So I'm going to ask our friends who are on the Zoom to start first. And if I could have Scott Saunders, please say who you are, your company, and what you do.
Great. Dan, great to be with everybody remotely on Zoom, along with Bill Exeter. I'm Scott Saunders at Asset Preservation. We're a national qualified intermediary. We're based out in California. We've got an office in California as well as an Eastern office in New York. We do like-kind exchanges. We've done over 200,000 exchanges, and we provide the security of our parent company, Stewart Title, which provides a letter of assurance backing the proceeds. And, I just want to thank being associated with Dan as the moderator here. Many of you may or may not be aware of how great of an advocate he is for Section 1031. So Dan and I have done probably at least 30 to 40, maybe 50 Zoom calls with people in Congress, educating them on why 1031 is valuable to the industry, particularly now coming out of a kind of a post-pandemic environment to repurpose and reimagine. And Dan Wagner always kind of is the last one on deck that kind of ties it all together and talks about the value for, the whole real estate space, whether it's ag, ranch, commercial, residential. But Dan's just a huge advocate, and we're grateful to him and Inland. So it's great to be with everybody.
Scott, I'm going to send you that $20 later. Thank you. That was really good. He's really smart, by the way. Thank you, Scott. Now, the guy who I was with in Las Vegas the last 2 days is Mr. Bill Exeter. I flew home last night. And did you get home last night or this morning?
Last night.
You did last night. Okay. So we were at the National Council of Exchangers out in Las Vegas. But Bill, tell everybody who you are and what you do.
Sure, and ditto Scott Saunders' comments about Dan Wagner. What a trooper, the gladiator for the industry. So glad to be associated with him. For those who haven't worked with us before, I'm with the Exeter Group of Companies. Part of that group is Exeter 1031 Exchange Services, which serves as a qualified intermediary. We handle all types of exchanges, all 50 states. We also handle foreign property 1031 exchanges. Also part of the group is Exeter Trust Company. So we're licensed, regulated, and audited by the Division of Banking. All the 1031 exchange funds are held in Exeter Trust Company. So they're subject to that regulatory environment. That also allows us to offer self-directed IRAs for those investors who want to invest in non-traditional assets, such as real estate, deeds of trust, mortgages. We do title holding trust, land trusts for the negotiation, acquisition, and holding of real estate confidentially. And various types of specialty custody services as well. So glad to be part of the team today.
You kind of know about this qualified intermediary space, right?
A little bit.
Yeah, a little bit. Yeah. Okay. And you guys aren't the QIs aren't regulated, right? You guys, that's why you want to go with somebody like you guys.
Right.
Gotcha. Okay. Well, we have two of our guests on Zoom introduce themselves. And now it's a pleasure to have our live folks here. Why don't we start in the middle with Tracy Trieger. if you could highlight who you are and what you do.
Hi, everyone. Tracy Trieger with Syndicated Equities. We are a private equity real estate investment firm. We've been in business for about 35 years. We have been doing 1031 exchange compatible syndications for about 25 years. We have a net lease brokerage team. I've got my colleague Josh York here in the crowd representing that group. And the thing that I think we're possibly more well known for is for our syndications with high net individuals and accredited investors, pull together a bunch of strangers to do a deal together and somehow make it work out right. So glad to be here today. Thank you.
And I love getting to know Tracy because she was able to say, now remember, it's tree and then gur. So I got that right. So good job, Tracy. Thanks. Another wonderful person here, Robert Bodwin with Spear Minerals. Robert also has a background where he was the Houston Rockets. You were their
mascot.
There you go. So interesting guy.
So I guess that makes me a little bit of a weirdo in the room. 21 years as a mascot and pivoted to the oil and gas business during the pandemic. We actually don't view ourselves in the oil and gas business except on the arm where we do working interest in drilling deals. We are a real estate company in that we sell subsurface real estate. And many people are surprised, whether they're realtors or a lot of the people I've talked to in this room individually already, that subsurface property is in kind and 1031 exchangeable, eligible for any of the surface property that you guys are dealing with, whether it's apartment complexes, rental homes, strip centers, whatever it be. A lot of the customers that we get come to us. They sell their surface property and they put it all into mineral rights, or sometimes they're buying another piece of property and they just put their boot into it. So they're avoiding the capital gains and they're putting it into the mineral rights. A lot of people really want to know right away what the cap rates are. When oil was $37 last August, we returned an 8%. 14 months ago, we returned an 8% annualized return when oil was 37. For those of you who keep track, oil almost hit $84 yesterday. Our worst month was a 2% annualized return when the world was going to hell in a handbasket. And I'll leave you with the other thing. Since you outed me about being a mascot, I also have two sets of twins from two different marriages because God blessed me. God blessed me with two sets of twins.
Well, we share something in common. I have triplets plus ones. We have Irish quadruplets. So we went right away from man-to-man to zone. So it was a big deal. But the other thing is he's had about 3 hours of sleep. So you were in Texas at 10 o'clock last night, right?
Yeah. Some people find me motivating. So I had a motivational speech last night in College Station at 10. So I'm working on 3 hours of sleep, flew in this morning.
So his comments will be pretty interesting.
Yeah.
And then last but not least, we're really proud and honored to have Katie Byrne with Whipley Public Accounting. She is absolutely brilliant at CPA, and we're honored to have her and appreciate her very much for putting up with a guy like me in charge of moderating. I'm like laissez-faire, like, oh, we'll just get up there and talk. And she's very organized. So as a CPA should be. So there you go.
Hi, everybody. I'm Katie Byrne. I'm probably the least cool person in this room as the CPA. But as you mentioned, I'm a CPA by day, and on the nights and the weekends, I'm a hockey mom. So that generally means if I'm not sitting in my office at home, you're going to probably find me in a cold ice rink somewhere in exotic places like Bolingbrook, Illinois, to Detroit, Michigan. We're going to Oxford, Ohio soon. So I have my time filled up between work and hockey. But right now, during the day, I'm a senior tax manager at Whipley, which is one of the top 20 accounting and business consulting firms in the nation. I specialize in real estate and construction. I got a couple colleagues over here. One person that's definitely significantly smarter than me is Jim Lockhart, and he'll be presenting a little bit later on some tax planning strategies as well. But in general, what we do with our clients is we try to help them plan in advance. We do some deal structuring. We're going to help them execute, specifically with 1031 exchanges. It's always better to get in and do the planning. I've had a couple clients just recently who came to us. They were brand new, already did the 1031s didn't necessarily execute correctly. So sometimes we're the cleanup crew and seeing what we can do to help them continue to defer some gains, even if they haven't structured it properly in advance. But it's always a good idea to get us involved at the beginning with those deal structures and 1031 planning, and also some alternative, options. If a 1031's not going to be right for you, and we do a lot of qualified opportunity fund planning and deferring gains that way. We have some specialists in our office that help with that. Yeah.
And your company has a booth out here, right?
We do. We have a booth right out here. So go grab your Whitfley swag on your way out. Make sure you get your stress ball or your little USB plug-in.
I love that. The USB plugins, and you got some stuff you're giving away too, right?
We got tons of stuff.
So we got good swag. So the next question we're going to get into is I'll show you what, in honor of the 1031, I'm wearing Halloween socks because obviously 1031, right? So the 1031 is near and dear to all of our hearts. And we have been going through some interesting experiences. We had President Trump, who with the Republican House and Senate originally, they talked about getting rid of the 1031. And all of us came together to protect it. And luckily, with a lot of hard work, we were able to save it. And the 1031 exists for real property, but it was taken away for private property. So no more yachts or jets or I guess Van Goghs. You can 1031. But we thought that as an industry, the Real Estate Roundtable and all of our groups that were working together, the Federation of Exchange Accommodators, National Association of Realtors, we thought we could put our feet up and say, 1031 saved, no issues. Well, then the candidate Biden highlighted how he's going to eliminate the 1031. He's going to double capital gains, and he's going to get rid of stepped up basis. And that's been keeping us a little bit busy, as you all know. And so we're going to talk about our this space and politics and what each one of us has had to experience. So I'd like to go back to Scott Saunders. Scott is the past president of the Federation of Exchange Accommodators. And I guess my question to everybody will be, how has politics impacted your business, Scott? So that's kind of a big question. We only have like another 45 minutes, so don't take it all.
All right, I'll keep it short and concise. Regrettably, I think 1031 to a lot of people looks like a real attractive pay for, right? People look at how much revenue could come in terms of taxes. And so regardless of political party or persuasion, it becomes an attractive target to go after to generate revenue. We have been exceptionally busy, and I'm sure Bill would probably say the same thing. The market at most price points has been very active. Certainly on the residential side, extremely active, but we're still doing a fair number of commercial transactions, ranches and farms. From a political perspective, as I kind of alluded to earlier, through the Federation of Exchange Accommodators and that whole real estate coalition, we have been meeting with people in Congress probably once to twice a week, face to face, and really just educating them, saying this is a valuable creator of jobs. And we've got some reports that'll back it up, and I won't get into the minutia, but we've got data to show just how much in terms of job creation, in terms of how many transactions go through an exchange. With commercial real estate, it's vital. So at this point in time, so far so good. We are not in the House Ways and Means bill as a pay for. So that's the good news. Now, this is a moving target, and I won't get into the weeds too much. Maybe Bill will jump in. But yesterday we had the senator from Arizona, Sinema, say she is not in favor of increasing taxes at all. No more higher corporate taxes or personal taxes. So to pay for this big budget reconciliation plan that's going to be somewhere between, came out at $3.5 trillion, it'll probably be scaled back to $2 to $2.5 trillion. Now they've got to find other sources of revenue. So where we were breathing easier that we weren't in the House Ways and Means, now they're going to have to find revenue to pay for all this new spending. So again, I think many of us in the industry are now concerned that somebody might get clever and think 1031 is a pay for. So we're going to keep advocating. I'll still be on Zoom calls with Dan, and we've got, the Federation of Exchange Accommodators working in conjunction with National Association of Realtors and others has really taken the lead. We're going to keep educating people on both sides of the aisle of the value and do our best. So far, we've been very fortunate, but it takes all of us working together to do that.
Scott, what if you could tell everybody again, they might know this, but just for people that don't know, what is the Federation of Exchange Accommodators?
Federation of Exchange Accommodators is the trade association for qualified intermediaries and for ancillary services. So for those that are involved with other types of replacement property, whether it's DSTs, we've got banks that are affiliate members. So it's anybody that is involved with facilitating exchanges or related to that from a business model. Their website is 1031.org and a great resource. Highly recommend you work with somebody who's associated with the Federation Exchange Accommodators, which are here abbreviated the FEA, because the other one's a mouthful.
And Scott has been the past president, which is a huge job, working really nonstop for the last few years to protect the 1031. And you happen to get the chair position right when everything was happening. So you took time away from your business, and all of us appreciate your efforts. So thank you, Scott. Now, Bill Exeter, tell us about politics in your neck of the woods. You're out in San Diego. So I think they do a few 1031s out there, right?
Just a few. And poor Scott had the perfect timing. It was like the perfect storm. He got elected, and then we had the threat to 1031 exchanges. He's probably thinking, oh, geez, what a year. But Scott was certainly a trooper and a gladiator there as well. And Scott kind of touched on everything there. So certainly, the issue of using 1031 exchanges as a pay for is, just something that's misunderstood. People don't really understand how that is going to work. So it's all about educating members of Congress as to how the 1031 works, how investors think, and what would really happen. And so all of us have been doing a ton of education on both sides of the aisle just to make sure they understand what is a 1031, how does it work, and really how a lot of investors would just not sell if there was either the elimination or restriction of that. So fortunately, we survive, and at this point, it's not in the bill or in the markup, so we're really good to go there. But it certainly had an impact on the industry. I mean, combined with the fact that you had a frothy market, we're coming out of COVID, there's pent-up demand, phenomenally low interest rates, there's a cash position that's unbelievable out there in the economy. And then you combine that with this, the potential threat to reduce or restrict the use of 1031 exchanges. The market has gone crazy. So our volume is about quadrupled just in the last, say, 8 months. It's been a challenging time because it's hard. Nobody wants a job. It's hard to find somebody to hire, but at the same time, your volume has quadrupled. So that's kind of the impact that this has all had on us.
Could you also let people know about IRAs?
Sure. So we were successful in getting the proposed changes in the 1031 exchanges removed or not included in the bill. Kind of the surprise was some of the changes that were included in the bill that would affect investors that have individual retirement accounts. And some of those were to cap the amount of cap the amount of balances or funds you can have in your retirement accounts. And if it exceeded 10 million, there was distribution requirements. So those were of concern. And this, I think, came out of the whole publicity around Thiel's IRA, who was the founder of PayPal, where he's got a $5 billion IRA. And a lot of members of Congress just think that's not right. The other area that I think has a more significant impact to all the smaller investors is the proposal that if a self-directed IRA were to invest in some type of a non-traditional asset, typically be some type of a securities offering, like a Reg D offering, and the requirement is that the investor be an accredited investor, they would become prohibited transactions. So twofold, it wouldn't allow self-directed IRAs to go forward and invest in those type of assets that are, require the accredited investor or certain types of net worth or certain types of education or licensing. But it also did not grandfather in those who had already made those investments. And there was a 2-year window where they have to divest themselves of those assets And again, these are just the proposed changes. And Dan, I think you have more of an update there in terms of how the conversations have been going and where it looks like it might be today.
Yeah, if you could imagine, so like, a company like Inland, we have non-traded REITs. You have to have qualifications to be a accredited investor. And so if you have a non-traded REIT in your IRA fund, you would have to divest that in 2 years. So, I mean, how do you do that? I mean, that you don't control how you get rid of that, or you have to sell at a big loss because there's no really secondary market for that. So it's pretty intense. We're bringing the group back together. One of the lead organizations is the Institute for Portfolio Alternatives. They're working really hard to negotiate with the House Ways and Means Committee, and they hope to be able to get a cap, maybe a $10 or $15 million cap, that anything below that is fine and you don't have to divest and you can still do accredited investor investment. So we believe that's going to work, but we don't know. It's very much concerning if anybody's into investing in IRAs. So that's going to be something you want to keep aware of. And then we're going to go now to Tracy Trieger. Tracy, thank you for, you have some really interesting insights. I appreciate you talking about the politics of this and maybe a different aspect of the politics of this.
Yeah, so certainly we're dealing with the existential threat to 1031s. I sort of feel like this industry, the sky has been falling in that respect, really for a really long time, and somehow we've managed to scrape through, which is terrific. And the limitations perhaps on the IRA investments that Bill has talked about. One of the other things that's come up a little bit on one of the prior panels is the change in the solicitation rules that has opened things up to crowdfunding of private placements, which in turn has had a couple of effects. One is that now there's some more competition or different kinds of competition from different places in order to participate in these kinds of investments. And for the much to the chagrin of a lot of our existing investor base, FINRA has gotten very, very, very involved in regulating these 1031 syndications, the DSTs, the TICs, the land trusts that we use. The questionnaires to participate have gone from about 2-3 pages to this 10-15 page tome with 1 million boxes to check, which is really sort of a pain in the ass, frankly, and that's a technical term. In order to participate, to ostensibly convince some regulator somewhere that the person that has perhaps millions of dollars invested with us knows and understands what they're doing to invest, maybe $500,000 in a particular real estate deal. So that's been sort of a change for the worse that I've been seeing. But that's what we've been seeing.
Thank you. And then if we could go to Katie Byrne. Katie?
Yeah, well, I guess I'm in the unique position that in general, politics just offers me a lot of job security, right? Like anytime and the opportunity to relearn things over and over throughout my career. But anytime we have any sort of change in a president or the majority party, we're probably going to see some tax law change, right? It's going to happen about every 4 to 8 years. Sometimes it's not that much. Sometimes, it's a big sweeping change. We just, went through this with the TCJA back in late 17, even as recently with all of, the coronavirus related changes from 2000 and 2001. And most recently, we've got this Biden's Build Back Better plan with all of these proposed changes. So our job as CPAs is basically every time they make a change or we've got, we're hearing about some new plan, we're just trying to digest how that's going to affect our clients. We're communicating with them, we're planning for them, and eventually we're going to execute. And a lot of times when we execute, we don't have a lot of great guidance from Congress or whoever's coming up with all of these great tax law changes, right? They don't give you all of the answers in there. But right now, just related to 1031, the reason we're up here is, the proposed law is going to potentially limit the deferral of gain to just $500,000 if you're single, $1 million if you're married filing jointly. So we're seeing the potential for some limitation on full 1031 gain deferral benefits. So right now what we're doing is kind of thinking to ourselves, if this happens, what are some potential options that we can start talking about with our clients?
So you're kind of also a therapist for your clients too, then, right?
Yes, sometimes we have to talk them off the ledge because every time they see that there's going to be potential change, I mean, this has been going on forever and it's not necessarily, Democrats don't always raise taxes and Republicans don't always lower taxes, right? It's not that consistent. But sometimes we just have to remind them, yes, this is happening now. Yes, this is proposed, but keep in mind, it's probably going to change in 4 to 8 years. Again, let's do things that make sense, not do things because we're scared of what's going to happen. So yeah, we're a little bit of therapists also.
Good job.
Just,
Way to go. Well, I'd like our mascot, Mr. Robert Bodwood, if you could highlight what
Great. I'm the
politics is
Red
for you.
News mascot now. First, Tracy, I love a speaker that can work in ostensively and pain in the ass into the same sentence. Well done. Thank you to all CPAs. They are our friends. Financial advisors are not. They steer everybody away from us because they want every last dollar under their management. So we always advise people to get advice from their tax attorneys or their CPAs. Also want to thank the FEA. We were here last month as Spear attending that conference. And certainly we don't want the 1031s to go away. I was talking to my friend Doug here at the break, and he said one of the great things about it, he asked what the minimum was. And in general, our units are 120,000. We do half units at 60. He said, but do you do other amounts? And we absolutely do. Anytime we have boot money, we work with people. We could do $46,331 if need be on boot money. A big thing to stress here is this is deeded property. You are not buying an interest in an LP or an LLC. You buy this just like any other real property, and then you walk away from us and wash your hands of Spear Minerals. You're not dependent upon us. As far as where things are going with the price of oil, a lot of people might be surprised to know that oil usually does much better under a Democratic president. If you look back historically, oil prices are always higher under a Democratic president. That's theorized because they push the green initiative and the public towards that, and it drives the price of oil up. I'm not going to speculate. I'm going to tell you that oil almost hit $84 yesterday. As I told you earlier, we returned an annualized 8% when it was $37 a year ago. A lot of people predict that oil is going to 100 in the next 6 months. Many predict that it's going to 100 by the end of the year. There's some outliers that are buying positions that it's going to 200 by the end of 2022. The important thing to differentiate about our product, and a lot of the people that we get are real estate investors. And the one thing that's different is this is truly passive income and mailbox money. There is no vacancy. All the property is leased up. It is actively cash flowing with 170 PDPs, which is a proven, developed, producing well, and 250 PUDs. If anybody talks to you about a mineral rights portfolio and doesn't mention how many PUDs they have left, be very wary, because that means most of the property's drilled out. If they have a lot of PUDs left, that means it's proven land. It's not a question of if they're going to get the oil, it's just a question of when. It's very similar, our property, to a triple net lease. There's no liabilities, no expenses, and no vacancies. So we thank the FEA. We don't want 1031s to go away. And although you're all going to be paying for it at the pump, if you want to hedge your bets, buy mineral rights.
So what's gas going to be in another couple of months? And when you buy a gallon of gas?
Depends on what part of the country.
Yeah,
Anyone's guess. I think, honestly, it's going to be $4 or $5 a gallon.
Isn't that going to be great? $5 a gallon. Wouldn't it be fun? Scary stuff. Well, we have these great experts here. Bill, did you want to say anything about gas?
I said, unless you're in California.
Oh, that's right. Okay. So from the inland standpoint, what we got to experience is when the president during his green book said that he wants to keep 1031. And as Katie said, he wants to cap it at 500,000 or $1 million for a couple. He said that would be in effect January 1st, basically of 2022. But for any other capital gains, the president has in his green book still that he would go back at January 1st and take back an additional amount of money to get to claw back more money. And his goal is to double capital gains. So that had everybody pretty freaked out in the investment world. And so our Delaware statutory trust business has been booming. We can't keep the product on the shelf. I mean, we're coming out with new stuff all the time, but everybody's been trying to do their 1031s and DST. So that's kind of been our experience of what's happened with the wildness of politics. And as Bill talked about, the bill that exists now in the House Ways and Means Committee does not have the 1031 in it. It does not have doubling the capital gains tax. It's going to go up by 5% in the bill. And then in that bill, it also has the keeping the step or keeps the stepped up basis. So that's what we know right now. But until it's done, it's not done. The next question I wanted to find out, it's pretty interesting when we all are looking at ourselves in the mirror at 2 a.m, like, boy, I love what I do. And this is the reason why I'm working. I'm proud of what I do. I want to ask each person up here what they're proud of, most importantly, from the standpoint of their business and 1031 and good things that have happened with their clients. So Scott, if you can tell, you have a unique story to tell, if you let everybody know that.
Yeah, be happy to share that. Thanks, Dan. We did a really interesting transaction here in Colorado. So I'm based just south of Denver. We did a conservation easement up out of Boulder, and it was a good sized transaction, about an $8 million conservation easement. And the story was the land had been in the family for over 100 years. So basically their basis was zero. They couldn't afford to sell it, right? The taxes would have been prohibited. So it adjoined the city of Boulder. And what they did is they created a new conservation easement. It's hundreds of acres. It created a wildlife corridor, created trails, happened to have a recreational railroad that was associated with it. It's a really neat story of kind of how 1031 can provide some environmental benefits, right? People that were there locally benefited, wildlife benefited. They picked up more open space that adjoined some other areas, so they're able to expand that. The people that own the property, they ended up going into the types of assets that inland has. They went into Delaware statutory trust. So they went out of the land that had been in the family for a long time. Now they had that income coming in. They didn't pay the taxes. The city and the residents of Boulder benefited. So it just goes to show, 1031, the story, even though it's a powerful strategy for real estate, whether it's residential or commercial, for people to redeploy into better performing properties, there are a whole bunch of other benefits of this. In fact, I know Dan hears often our buddy out in Iowa talking about, how there's benefits environmentally where they actually create conservation easements that help with filtering the water so the toxins don't make it down into the waterways. So anyway, just wanted to share that perspective.
And you could highlight, where did the farmer, what gives the farmer impetus to want to sell to a conservation group? I know the farmers are dirt rich and cash poor, right? So we have, they're part of our coalition to save the 1031. And then the conservation groups as well. It's a really big deal. The conservation, we have the Land Trust Alliance, the Nature Conservancy, and just all around, especially in the Chicagoland area, we have all these forest preserves. Well, a lot of these forest preserves were owned by farmers, and the farmer, the last thing they're going to want to do is pay capital gains taxes. So a lot of these open spaces that we come to love, they're preserved because of the 1031. And that really makes people pause, like, wow. And so 25 years ago, the National Reit and the Real Estate Roundtable said that when the 1031 was attacked 25 years ago, who saved that were the conservation people out west, and the Cattlemen Beef Association, all those different groups saved it last time. So it's interesting, all the different dynamics, because this sucker's been in the tax code for 100 years. Now, Mr. Bill Exeter, tell us of your experience, what have been some good experiences for your career with the 1031?
I think the fun part about 1031 exchanges is being able to look outside the box and trying to solve the difficult problems that clients have. So probably one example would fit in today's market, where it's a hot market, multiple offers, bidding wars, et cetera. And how do you solve some of those issues? We're seeing a lot of clients that are selling multiple assets, maybe 5 or 10 single families, and exchanging into one larger asset. And in today's market, there's a lot of moving parts there when you have that many properties involved in those transactions. So being able to layer the different 1031 exchange structures, whether you start off with a forward or regular 1031 exchange, followed by a reverse exchange, potentially followed by another forward, or vice versa, is just a fun, challenging strategy to help clients deal with all those moving parts, especially in markets like today.
Thank you. Well, and Tracy Trieger, if you can highlight in your experience, why are you proud of your industry and what you do in your company?
Sure. So one of the things that we've been doing, and one of our first reactions after sort of the deer in headlights when everything shut down for COVID, is that we have started to do some social impact type investments and have made those types of products available for DSTs and other 1031 investments. Our first investment out of the box right after COVID was to acquire a new Goodwill Industries warehouse and retail store. And for those of you who don't know, Goodwill Industries, their mission is employment and job training. So you look at a time with record high unemployment and people being furloughed and laid off of their jobs entirely. And you've got a nice single tenant, triple net lease with Goodwill. And they don't have to pay for their stuff because everybody is stuck at home cleaning out their closets and just giving it to them. Here, take this product to sell. And they're providing job training for folks in the warehouse, in the stores, and that's what they do. We have expanded this over the past year. We earlier this year purchased a fertility clinic to help people that want to have children. And we are looking at opportunities for a lot of the products that folks here work with. I mean, a Walgreens in and of itself may not be have huge social impact, but put it in a neighborhood that doesn't have a drugstore. Put a grocery store in a neighborhood that doesn't have one. Put a medical service provider in a neighborhood that doesn't have one, doesn't have a university health affiliated healthcare service. And there's a lot of opportunities to do that. And we've been trying to do that when it's possible. And frankly, we've gotten very good traction with that, particularly from a younger demographic of investors who figure, gee, if I'm getting the exact same return that's at historic lows, why not do something that makes a difference? And so we're making a difference.
That's fabulous. ESG stuff. That's good stuff. Thank you. Katie, would you like to answer that question for us?
My answer's not dissimilar to Bill's. I mean, just in general, what I'm most proud of is just constantly being surrounded by people with a great deal of expertise, right? I'm always finding somebody smarter than me and learning from them, but it just allows us to infuse that creativity. There's no two 1031s that are ever alike, right? We're always structuring them and helping clients plan for them to optimize their goals, right? Like, what's your ultimate goal? And sometimes that takes a lot of creativity. And sometimes, like I mentioned before, we come in a little late and we're doing a little bit of cleanup on times where they haven't properly planned. And that's when you need to use your attorneys, your accountants, somebody who's got a lot of expertise in 1031s, your qualified intermediaries, to make sure that you're planning properly to execute them. And we've still been able, sometimes in those failed 1031s, where we ended up potentially with boot that they didn't realize they were going to have boot that was in excess of the actual gain. So they were going to have to recognize a gain they thought they were going to defer in some way, still coming up with ways to be able to defer gains at least another year and gives them a little bit of time. We come up with some other strategies also. Sometimes it's just going to be, instead of, buying another property, we're going to take our capital gains from the sale, we're going to invest it into a qualified opportunity fund, which, offers a different way to defer the gain right now until 2026, and potentially any gains on appreciation for the time that you've had it in an investment permanently. And then other ways to just help, we do a lot of cost segregation studies, in the real estate world, and that just offers the opportunity to be able to, accelerate those depreciation deductions, so that if we do have a property where we couldn't do a 1031 or something, we couldn't find replacement property, and they have a gain, say, okay, let's do a cost seg on this property that, a different property, right? And recognize some accelerated depreciation deductions to get some losses. So it's just the creativity, the constant expertise that we're surrounded with, and the different ways we can come up with, ways to save money for our clients.
Great. Thank you very much. And now, Robert.
First, I want to point out that your centerpieces, those oil drums, are for you to take. So first come, first serve. They are not for oil, they are for alcohol. They're flasks. They're not the kind of flask you're going to sneak into a concert. They're not that small, but please take those home, whoever grabs them first. We also have playing cards out there because we like to ironically say our product is not gambling. What we're most proud of is that we have safe double-digit returns in real property for generations to come. And I want to explain that. This is not a drilling deal, especially down south. When people hear oil and gas, they get turned off sometimes because they've lost money on speculative drilling deals. This was speculative in 2014 when our owner went out and bought 90 tracts of land that had 0 shale wells. We now have over 170 active wells that are pumping oil out of the ground. This is 95% of everything we're pulling out of the ground is oil. And that is cash flowing to those mineral right owners now. And there's 250 spots left. Now, a lot of people think, well, what happens when all the oil down there is gone? That doesn't happen. We don't have the technology to do that yet. In an initial shale play, which can take 30 years, we only get 9 to 15% of the original oil in place out of the ground. So part of this is a tech play, and that we're looking for more technology to get more and more oil out of the ground. But we also have 250 PUDs available. When we went on sale 14 months ago, we were returning between 6 and 8%, but ultimately we're projecting 10 to 20% returns for generations to come. Now, if oil hits $100, which a lot of people outside the business are pretty confident that it will, our CFO in good faith is estimating 32 to 35% returns while oil's at $100. If that sounds too good to be true, sorry, it's not. They're the facts. A lot of things that are misconceptions. What happens about electric cars coming out? Even if the Green Deal goes through 100%, world oil consumption will only be down 15% by 2050. Couple reasons for that. Only 70% of a barrel of oil, only 30% of a barrel of oil is used to make gasoline. 70% is used to make plastics, polymers, rubbers. Jet fuel is a huge one, and in all the factories for manufacturing around the world. And a lot of the developing nations will not have electric cars. We like to joke in the office that even the Tesla itself is made of plastic. The batteries in it are made of plastic. So that's one of the reasons that oil isn't going away. We're going to need oil even if we go electric. So what we're most proud of is that we're diversifying a lot of people's generational wealth and their retirement away from the volatile market into safe double-digit returns.
Thank you. We have obviously incredible professionals here. I'm going to talk about in my world of inland, we're really proud of these 4 teachers, like I talked about, who saved folks all the way back when they did. But in today's world, we're proud of the Delaware Statutory Trust. We're proud of everything that we do. But when you have people who are tired of the toilets, trash, and tenants, they're able to cash out, which is terrific with farmers. Especially, but we had a couple who were owning a deli in Manhattan. They were exhausted because all they could do was sell their sandwiches to make, that's how they paid their bills. They owned the building, but they saw they would be wiped out with capital gains. They were going to be facing to sell to sell deli sandwiches for the rest of their lives. A realtor was at a meeting who understood and learned about what a DST was. The realtor went to those folks and said, look, if you sell, you can 1031 into a Delaware statutory trust and you can, not worry, you go passive investment. And they started crying because that was their solution. And there's so many different examples like that we have. And I know that Tracy has similar examples too of people that really this benefits folks that who have special needs kids that are wondering, what do I do with this portfolio of properties? And they can get into the DST world, and it gives them really ability to sleep at night because it takes care of some issues for them. But with our little time left, I did want to see if Tracy, if you could talk about, because I know you wanted to say something about what happened with the pandemic. You had a couple interesting comments when we talked.
Yeah, so one of the things, and we've talked about it a little bit this morning, is that folks are getting a little, with the cap rate compression and low interest rates, a little more creative about what they're buying. And I also think that what I'm hearing from the architects who are designing space is that there is now a confluence of all of these asset classes merging into one another. Somebody gave me the name, the moniker commerciadential, which is that you're now seeing offices that have features that look a lot more like your home. Homes, apartments are starting to have office features. Retail combined, we talked about medtail this morning, and we've seen that in a number of different ways. We just sold a month or so ago a medical office ophthalmology practice that also had a retail component. They were selling eyeglasses, sunglasses, things to clean your eyeglasses and sunglasses, all of that. This confluence of a number of different asset classes coming together in a way that I think is interesting and creative, and maybe a potential solution for some of the current stagnation that we're seeing, while you have a lot of capital sitting there trying to find a home and worried that if they buy something as is, where is right now, that the exit is going to be like what I call Hotel California. You can check in anytime you like, but you can never leave. So that's sort of what we've been seeing. And I thought that was, an interesting observation.
So you see, one of the cool things when Mark asked me to do this, it has been so fun because I got to meet these really talented, wonderful people, stalwarts in the qualified intermediary world. I've known them, and they're just terrific. If you ever have any need for 1031 and you need a QI, Scott and Bill know their stuff. Tracy, appreciate getting to know you in this process. Robert, I had no clue about the mineral stuff, so that was been very interesting. And Katie, you are smarter than I could ever be, and much more organized. But we're proud to be here today with the RE Journal, and I believe have about 10 more minutes, and I wanted to leave that open for any questions you might have. Yeah, go ahead.
What can we do on an individual level besides contact our congressman?
So the question is, what can you do on an individual level to protect and defend the 1031? So a couple things. One is looking at your networks of family and friends. It always amazes me the 6 degrees of separation. If you're able, I've been at different groups where they say, oh my gosh, I know this lobbyist for a union, and that's been a really important thing. And we've been able to contact that lobbyist, and they were able to get to some of the members of the House Ways and Means Committee. So I'll quickly highlight the whole world for saving the 1031 is the House Ways and Means Committee, and Richie Neal, who is the chairman out in Springfield, Massachusetts. He's the number one guy. And then the number one guy in the Senate is Senator Ron Wyden. That's the Senate Finance Committee. So everything starts in the House, House Ways and Means by the Constitution, by law. You have how a bill becomes a law, like from Schoolhouse Rock. Well, that's true. I mean, it starts there and then it goes over to the Senate. And right now what we're experiencing is that you have the House where you have the Senate sent over the infrastructure bill for about $1 trillion, and that's you had 10 Republicans or 11 Republicans vote for that, so they didn't need to use the reconciliation process. But then Nancy Pelosi said, we are going to put all this together with the social infrastructure stuff. Well, that then made the Republicans fall off of it in the House. So they're going to put all this together under one reconciliation bill. Reconciliation means that you're going to have the Democrats go on their own in the House, Democrats go on their own in the Senate, but the Senate's tied 50-50. So Kamala Harris as the vice president makes the tie-breaking vote. But before Nancy Pelosi can get that package now out of the House, they have to, as Democrats, the moderates and the progressives are having this internecine warfare right now. And it kind of is playing itself out on the media. And it's going to all depend what they're going to get to, what number they're going to get to. Once they pick a number that Joe Manchin and Kristen Sinema from Arizona will agree to, then they can pass that. It's Nancy Pelosi's goal to have that number by October 31st, and then they want to send it over to the Senate. But then in the Senate, the idea is that one person can blow it all up. So you could have Bernie Sanders that says, oh my gosh, I'm not going to want to pass this at all. And he could blow it up. So it's really an interesting discussion. We have worked hard, people like yourselves that have contacted their members of Congress. The big thing is, and if Scott wants to talk, I know he wants to talk a little bit. I know Scott and Bill, you guys have donated to different PAC funds, but Scott, if you were to answer that question, what can someone do? I think I know your answer, so I'm setting you up. What can they do, Scott?
Well, that's a softball pitch there, Dan. I would say the Federation of Exchange Accommodators, get plugged in with them. And by the way, they've got a parallel website that you can find on there. So go to 1031.org that talks about legislation. You can donate there. And the other thing you can do, and this is probably the biggest thing as an individual, you can go on there and there's a way to contact your congressional representatives. It takes 2 minutes. You go in, you put in your zip code, and there's a pre-form letter that just says you support 1031 for the real estate industry. Send that. One of the things that moves the dial back in Congress is people hearing from constituents. The more noise we make, the more effective we are. And, as a niche industry, 1031 is kind of small. So the more that those of you that are involved with commercial real estate and all the ancillary industries can send that out to your databases and have them chime in, it really makes a difference. People in Congress listen. When people are sending emails and burning up the phones, they take that into account and it influences their vote one way or the other. Bill, your thoughts?
Absolutely agree with that. And I think both for 1031s and for self-directed IRAs and all the other issues, it really, really, really needs all the individuals out there to weigh in. It's kind of like voting. You go there, it takes 2 minutes to do that. You hit submit and it's either a yes or no vote. So you're telling them you're opposed to these changes. And the more people who vote against this, that oppose this, it adds up and it absolutely makes a difference.
The other thing that you can do as an individual, everybody in this room is a real estate professional. We as an industry, our 1031s comprise a significant portion of our revenue, and they affect all aspects of real estate. The accountants that help do the planning, the attorneys, the title people, the engineers, the environmental people, the brokers, the lenders, everybody is affected. Talk to the people, educate yourself, talk to the people that you do business with, get involved with whatever organizations you're involved in. Most of them are part of the coalition that Scott was talking about with the FEA that have been lobbying and contributing and educating all of our representatives. And there's some really wonderful studies, one by Ling and Petrova and one by Ernst & Young, micro and macroeconomic studies showing the impact, the economic impact of the 1031 exchanges and the breadth of industries and areas that are affected. Educate yourself and educate your peers and get the organizations that you spend your time with to know and understand how important this is.
Great point. I got to tell you, it has been interesting with the Democrats in charge of this. What has kind of been our strategy? Well, one strategy, we went to the IBEW out in DuPage County, and Frank Fercell's there. I said, "Hey, Frank, this is as Tracy highlighted, that macroeconomic study said that 568,000 jobs are created every year for the 1031 through remodeling because owners maintain and buyers renovate." And he said, "Dan, I love jobs for my union guys, but you'll be surprised when I tell you this. We're mostly proud of having our pension funds, and our pension funds keep our retirees being able to pay their bills. So if you can prove to me that that REITs are impacted by this, that will be a big deal." So Inland got Baker McKenzie to do a study, and we were able to show the union that yes, indeed, REIT stock would go down, the returns wouldn't be as high. And he's like, "We're on board." The national one can't say that, but locally we can, and that's been very effective when we talk to members of Congress on the Democrat side. Secondly, DuPage, or in Chicago, we have the African American Chicago commercial real estate leaders. And they, Graham Grady, if you know him, he's the CEO of it. He's been terrific because they've been able to highlight how for inclusion and diversity, the 1031 is one of the best ways to get capital into diverse areas. And that's been a big deal from inclusion and diversity. Bronzeville built the Mariano's. That Mariano's is in Danny Davis's district. I'm like, David Doing developed this. He's like, well, and then New York big investor came in 1031 exchange into it and put a ton of money, and it lowered the crime, it raised the jobs. And I was able to tell Congressman Davis, and David Doing did this, and he said, "That's been my neighbor for 20 years. I mean, it's just these synergy things that people don't realize how the 1031 has impacted everything. And then you also have, this is like the 401k of real estate, because the staff members of Congress folks don't understand this very much at all because they're 22 is the average age. And I, knock on the door. I'm like, "I'm here to talk about the 1031. They're like, "1031? No, it's 11 o'clock. And so you have to really get into depth and talk to them. And this is like a 401k of real estate. You use pre-tax dollars and you're able to grow, and then you pay the tax at the end. And then finally, we had the mayor of Naperville, who's just fantastic. He was able to highlight to members of Congress on this huge webinar that we did to the staff. And he asked me, "Dan, to go find out how many 1031s have been done here in Naperville." So I call IPX 1031, and they said that just out of one QI, that in 5 years, over $450 million worth of 1031s have been done in Naperville. And the mayor was like, "Oh my God, politicians, we don't even have a clue of that." It just shows you how free markets work. None of those companies that redid their medical office building or strip mall, none of them came to Naperville asking for a handout. It was already just baked into how things work and grow and shuck and jive, so to speak, in the economy. And the cool thing also is that he was able to tell everybody, Naperville, you have Ogden Avenue, and there was this horrible Kmart building that was really old, dilapidated. This 80-year-old guy owned that, and he was never going to sell until he died. He said he's going to live to be 120. It was absolutely horrible. They were going to look at condemning it because this old guy said, I'm going to get killed on capital gains. Well, Costco came in and said, "Hey, old guy, we want to buy this from you, and you can 1031 exchange it." The guy did it. We have this whole dilapidated shopping center has been totally torn down. Those are the 568,000 jobs. This is an example of that. Built up a new business, a new building. Another example of 568,000 jobs. And then the people that work there, it doesn't even include the people that work there because in those 568,000 jobs. So the synergy is amazing. But ultimately, the bottom line of why we're going to save the 1031 is because the juice isn't worth the squeeze. When President Biden said we're going to cap it at 500,000 and go to $1 million, that's $2 billion a year for 10 years. That's $20 billion. What is that? A rounding error in trillion? When you talk trillions, with these studies that have been done, it shows that for transfer tax fees, for depreciation recapture, for recording fees for local and state governments, you're going to lose $5 to $7 billion a year alone. So it's like, oh my gosh, that's just nuts. Why are we even talking about it? Right. And then the other thing is, look at all the 568,000 jobs alone. That's income tax. So it could go up to 17 billion, but the politicians won't let us include that. So it's just fine. We're able to still say, hey, it's going to be a net loss of tax revenue. So all these things together help combine it. But the big question, the big thing you all need to know is you have to continue to talk to your members of Congress to get out there and be a part of all this discussion. Mark, I believe we have hit our time. And I got to tell you, the RE Journal and you are terrific. And we're really blessed to have this kind of gathering where, a year or so ago we have COVID, and it's fun to be in the same room with everybody. So thank you for everything you've done. And I want to thank our panel, and please join me in thanking them for doing such a great job. Thank you, guys.
All right, we're running a little bit behind here, so we're just gonna hop right into it. I'm John Feeney with the Boulder Group, and we've got a great group of panelists today to talk about the sale-leaseback market. Before we jump into it, I'm going to let the panelists introduce themselves. We'll start with Elizabeth over here on Zoom.
Thank you. I'm Elizabeth Randall, president of the Randall Commercial Group. We work in 12 southeastern and midwestern states, working in commercial investment real estate, sales, development, and acquisitions. And we specialize in sale-leasebacks primarily for healthcare and professional headquarters.
All right, Guy, you want to take it over?
Good afternoon. My name is Guy Ponicello. I'm a managing director at Oak Street Real Estate Capital. Just briefly, Oak Street is a private equity real estate investment firm. We invest on behalf of institutional clients, largely pension funds, both state, local, and corporate. And with our closed and open-ended funds, we have about $20 billion of discretionary capital to invest in the sector. And I would say 70% of our business is sale-leaseback. So quite a relevant part of our business that I'll be talking about with these guys today. Thank you.
Good afternoon, Dan Nyhan from Mesero. I'm in the sale-leaseback group of Mesero Financial, which invests in the net lease space on behalf of Mesero's own account. To Guy's point, about 90% of our acquisition activity is sourced via sale-leaseback. So very excited to be here and talk about sale-leaseback.
Hi, everyone. I'm Jim Hansen with Davis & Young. We're a real estate services firm. We're based in Toronto. Back in 2008, we began our march to global domination with our first office outside of Canada here in Chicago. We're now up to about 5,000 employees, 120 offices worldwide. I'm in our corporate finance group, which is a team within the capital markets group who primarily represent non-investment grade credit tenants in sale-leasebacks. Those are either privately owned firms, private equity firms, or non-rated companies.
Good afternoon, Daniel Max with Stream Capital Partners, likewise a sale-leaseback advisory firm focusing on the lower middle market.
All right, everybody, thank you for the introductions. We're going to jump right into it. Let's start with Guy. How has the sale-leaseback market been for the past 12 months for you guys in terms of transaction velocity?
So I would say that at the beginning of last year, it was a little choppy. I mean, there was a bit of trying to go through a discovery stage in terms of what was going on with the pandemic and impact on businesses. And I think as it sort of started to sort its way out, and there was a greater comfort level and kind of where certain businesses were going, we have seen a huge pickup in activity, particularly with respect to manufacturing sale-leaseback. So we, traditionally our funds are earmarked towards investment grade credits. And I would say that, those deals are still out there. They're a little bit more challenging because, IG credits have a lot of access to cheap capital right now. But we have been forging into non-IG and really seeing a significant pickup of activity. We acquired $4 billion, a little over $4 billion last year. I think we'll be short of that this year, but hopefully we'll still wind up somewhere around $3 billion when we're all said and done.
Daniel, do you want to tackle that question as well?
Sure. To Guy's point, in 2020, there was almost a standstill in significant sale-leaseback deals that were coming to market, with a lot of buyers trying to understand the implications on a long-term basis of a potential complete shift in certain credit classes. As we've now gone into 2020, I think we've seen a much more robust issuance of new sale-leaseback deals. And the only point that I would make is that the number of competitors has increased at a much more significant rate than the amount of deals and the capacity. So there is a supply and demand problem currently with acquisitions.
Do any of the brokers on the panel want to tackle that as well from a different perspective?
Yeah, I would refer to it as a supply and demand opportunity. On the broker side, representing sellers, we do find, our investor lists of folks who are signed in non-disclosure agreements are longer than they've ever been. Our bid lists are longer, which allows us to, really look at the transaction, create value for our clients throughout the deal. There's been a lot of focus on cap rates in a lot of the conversations today, but it's not just cap rate. It's a lot of other aspects of the lease where we try and create value. And I think one of the panelists this morning talked about sort of feeling abused by some of the demands on change of control and assignment and subletting provisions, which are really important to us and our clients, especially with a private equity backed firm. If you've got a sale leaseback deal with a 15, 20-year term, but you've got a private equity company who needs to execute a strategy and exit within probably a 3 to 5 year time frame, you need to make sure that at the end of the day, the real estate lease is not going to be the tail that's wagging the dog on their value creation thesis. So, the number of new investors in the market, the different perspectives they're taking on the market has allowed us to really create value for our clients and do some pretty creative deals.
Yeah, but I would agree with what was just said. I think we're seeing a lot of new players who are sort of pivoting away from office and retail and hospitality assets and deploying capital into these long-term industrial sale leasebacks, medical office space. I actually was talking to one of the investors that we work with on a number of the sale leaseback deals, and we were saying how in 2019 there was sort of more stringent terms as it relates to assignment and change of control, and that's one of those provisions that we tend to be sort of negotiating at the LOI stage rather than sort of waiting, a month and a half once we get down the road and start negotiating that. So obviously the new players entering the arena is resulting in more competitive processes, which of course is great for the sellers.
All right, we've had a couple of you mention these new players in the space. Why is it that you think they're entering the space, and how are they differentiating themselves from some of the people who've been in the space for a long time? Elizabeth, do you want to jump on that?
Yeah, I'm happy to, because that's something we talk about a lot in our firm. And, if you think about the extreme yield compression that fixed income has had for the last 12 years, that is really pushing a lot of new participants, new buyers and investors into the long-term net lease space. So I think you're seeing a lot of averaging of, what may have been a third in bonds now is 25% in bonds, and then putting more into the net lease space as a big part of the strategy. We're seeing that in large family offices. We're seeing it in big institutions, and then we're seeing it down even in the local individual level. So I think a lot of it is just a yield replacement strategy from one standpoint. I think another side is the idea that there's just so much turmoil in global markets, and then the valuations of markets, domestically are very high. And there's a lot of propensity to leave the traded markets and then put it into long-term net lease deals that are very much feel like a security, but they're not. And the last thing I would say is I think some of the recent push has to do with the inflationary pressure and expectations that are coming. Of course, real estate is typically seen, as are other hard commodities, as a great hedge for that. I think that's going to be a big piece going forward. And, obviously we're in a sale leaseback panel. I think to kind of compound the importance of sale leaseback going forward is going to be the construction costs, making it harder to go new development. And then you're going to have people looking more at the existing real estate there. And how do you create product? Well, you got to convert it from owner occupied to investor owned and tenant occupied, and sale leaseback's the solution there. So I think all that speaks to, a variety of new entrants into this space, specifically via sale leaseback.
Yeah, I think the question was why are we seeing so much capital, correct, in the
Yeah,
sector?
correct.
I mean, I think performance is first and foremost the number one reason. I mean, if you look at how the industry has performed during various market cycles, it's always benefited from when there's been market, just issues. You sort of saw it in all the various economic downturns. There's a flight to quality, there's a flight to safety. And I think we always benefit from that. I think historically, if you also look at any of the publicly traded net lease REITs, they performed exceptionally well and weathered the storm on a very good basis. So I think it's one of those asset classes that I feel like it's just finally starting to get the attention of a majority of the truly institutional capital sources. And now you're hearing about, groups like Invesco and others saying, hey, should we start a net lease fund? Or Brookfield, hey, how do we do more net lease oriented deals? Because our capital is seeking a return that is provided in the net lease sector with higher probabilities. You could still get an 8 to 11% kind of cash on cash return on some deals, IRRs that are sort of in the same range. If you're buying hypercore net lease, you might be trading down to 6 to 8% on an overall IRR, which, again, for some of the best real estate assets in the greatest markets, that is a risk-adjusted return that a lot of people are willing to receive, especially when the alternative is, safety of government bonds that are trading, in the very low 2% range. If you go outside of the US, they're negative. So I think I think from a risk-adjusted return, it's one of the best asset classes that's consistently year over year through the markets performed exceptionally well.
All right, we've got a couple guys on the panel, Guy and Dan, who work at firms where they're tried and true. They have a track record, and when you transact with them, you know what you're going to get. How are these new firms differentiating themselves from you, and what's their, upside? Is it they're paying more for these assets, or how are they getting the deal instead of you two?
I think that is probably a better question for somebody like Jim, who would be giving a deal to a competitor.
Foolishly giving a deal to a competitor.
As I would say.
No, I think, it's an interesting question. And, so, we as an advisor to the firm executing the sale and the leaseback, unlike one of the earlier panelists who said, yeah, we'll go through 1 or 2 or 3 buyers before we get one that sticks and we execute the deal. We don't want to do that. We want to make the right choice the first time and execute the transaction the first time around, not have to go back out to market when it's a little shop warm, when people maybe moved on to something else and have lost some enthusiasm for it. So we really think long and hard about the new entrants and the new investors in the market and how experienced are they. A lot of them are leveraged buyers. What sort of debt relationships do they have? What sort of credit work have they done? I think that, from our perspective, representing the sellers, we'd much rather, execute a transaction with a Mesro or an Oak Street or, one of the large public REITs who, we know they got a warehouse line and they're all equity and it's just an easier deal. What we tend to do, and I don't want you guys to get mad at me for saying this, the new entrants to the market, we really press them on price. We say, look, if you want to get this deal, you got to outbid the market and you have to, really win it based on the going in cap rate. And then we use that cap rate, of course, to shop that number to everybody else and push the value with the guys who we want to do the deal with. So, the new entrants in the market, they're funny because they provide diversity of thought. They provide uncertainty. And I think, they upset the status quo where people used to be like, well, I know, again, one of the earlier panels, we go into any deal, there's 5 or 6 competitors. We know who they are. We know where their hot buttons are, it takes to get the deal done. Now people really don't know who's going to show up in the market and whether, they're tax motivated or credit motivated or what really is driving them. So I think it allows us to keep the investors more on their toes and press a lot of these points that are important to us.
To one more, just, quick follow on to that is, there are from, experienced players in the sale leaseback market, a number of covenants within the lease are very, very important when you get to change of control, as mentioned before, casualty, condemnation provisions, early termination options. Some of these, all of these covenants within the lease, as there are more and more entrants, more and more people from the fringes are going to have different risk preferences or risk tolerances to some of these, particular issues. And in frothy times in the market, those people create a new market. And so as, people who have been here for decades, you want to make sure that the market doesn't shift in a particular way so that another 2007, another 2008 occurs where everybody's creating leases that are just unsustainable.
Go ahead, Daniel.
One thing that I was going to add is with the new entrants, sometimes, having the additional bidders and perhaps the more aggressive pricing is attractive. But I know one thing that we did touch on is, sometimes in certain situations, certain transactions, certainty of execution is going to be paramount. So while you may be getting, an additional 10, 20, 30 basis points on cap rate, having, the reputable buyers like we have here, could sort of be more important than just squeezing out every additional dollar on the transaction.
I would say that's especially true, working with a PE firm, where, depending on what the use of those proceeds are going to be, if, let's say the proceeds from the sale leaseback deal are going to fund a bolt-on acquisition or something, they need to know that deal is going to close when they need it to close. So they can't take the risk. And even though they're generally looking for the last dollar, certainty is important to them as well. I completely agree with that.
If I can ask a quick sort of question for the buyers here, I think kind of piggybacking off your lease comment, have you seen with the new players who might be a little bit more malleable on leases in terms of change of control and things like that, have you guys sort of moved the needle on your end in order to continue to be competitive with the new entrants?
I would say that, we're always trying to be flexible in any of the leases that we're doing, where we never want to be the reason why a company can't recapitalize themselves, can't sell themselves outright, can't expand a facility and the like. So we always sort of take it from that perspective is, how can we be protected that we're not going to be in a situation where we wind up the next day, we have, a company that's 10 times net debt to EBITDA levered. But at the same time, you have to be able to provide some level of flexibility from where they currently are, knowing that the potentiality is that, they might get sold to a private equity oriented buyer where debt is an absolutely useful means of generating the kind of yields that they need to generate for those investors. We get that. So we always try to, to be very flexible on that end. But I have seen, and I've been told by folks like Jim and others that, there are groups willing to buy that deal that you're willing to buy, and they don't have any covenants in there. They don't have any kind of change of control issues that potentially, would restrict these guys from doing anything. And I would say that there are a lot of groups that new entrants, particularly in the market, that are proposing certain lease terms that ultimately become an issue when they go to finance the asset. And so, you try to be upfront with everybody and be flexible, and hopefully reputation, which is a massive part of being successful in this business, sort of, takes at the end of the day, takes the deal. But yeah, I mean, all that stuff's getting watered down to a certain extent. We try to maintain the base minimum of what we need to be able to be secure from for our deals. And I would say that, because at the end of the day, credit is like the number one thing that probably any of us really focus on, right? When you're buying, our investment memos now are approaching probably, 40 pages, and half of it is dedicated to credit, peer review, etc. If you kind of wind up in a situation 2, 3, 5 years from now where the credit deteriorates significantly, it's a very different proposition for your limited partners in those funds you're investing on behalf of. So it's how do you create that flexibility at the same time, protect yourself over the long term, knowing that businesses are going to be bought and sold? It's always like the most delicate and the most crucial part of any of these sale leasebacks, don't you think?
Yeah, and I know we've spent a lot of time on change of control because nobody wants to talk about casualty or condemnation. But you know, in each lease that we work on, or at least are looking at, we try to think of really the myriad of scenarios that could exist, because a restaurant company doing a sale leaseback has a different set of circumstances than a manufacturing company doing a sale leaseback, and the change of control rules within the lease need to be appropriate for whatever industry. And so predominantly, as effectively a means of leverage for many of these companies, we need to treat this similar to as some of their secured lenders treat their debt. So, you know, we have similar types of underwriting, similar types of provisions within the lease to ensure that the tenant would not be able to dilute the value of the credit to an extent that would make the investment not as valuable.
When you guys are looking at these deals and there's these new entrants who are coming in and maybe stretching a little bit, are you seeing deals come back to you, you know, 30 days later, 45 days later? And how are you working with the tenants at that point in time? Are you reevaluating the deal, or you just, our offer was our offer?
We have seen that, and it depends on why the deal comes back to us. Was there an issue with the physical aspect of the building, or, you know, environmental, or, you know, was it difficult to finance, or, you know, so we really try to, you know, figure that out first. But it isn't our goal to take a pound of flesh just because, you know, people come back to us and, you know, now it's we're the second or third buyer. You know, we just try to be thoughtful about, you know, if the brokers are willing to sort of be honest with us, then we can certainly go into it with eyes wide open. But yeah, we have seen that where people, you know, they overbid it and the financing falls apart, or they don't, you know, they don't have all the equity shored up. There's a lot of folks out there that'll tell you we're all cash buyers. And then when you kind of really understand their structure, they neither have the equity nor the debt truly lined up. And so you kind of have, you know, both pieces that are in flux. So a lot of times that's where we see deals kind of coming back to us.
We mostly see these deals come back to us, and I kind of chuckled when you said when they don't have either the equity or the debt lined up. Well, it turns out the all cash buyer, you know, is relying on an unreliable lending source from overseas. And, you know, it would actually take 90 days to get some commitment. And now that deal that was supposed to close in 30 days has no real timeline. You know, our goal, similar to yours, is to not really take a pound of flesh, but it's to really adapt when appropriate. If the market changes and you see a dynamic shift, you have to appropriately then reevaluate. And so I think, you know, our goal is to be a good counterparty, not only with the seller, but also intermediaries out there. So our goal is to continually, you know, keep up a reputation that has been, you know, forged for 30 years.
Did you want to mention something, Jim?
Yeah, I would just say that, you know, because we've got deep bidder lists, you know, it allows us, this may drive you guys and other investors in the crowd a little crazy. You know, we have lengthy conversations before we award the deal. Like I said earlier, we don't want to go back a second time. We don't want to have to remarket a deal. So, you know, we really try to have lengthy conversations on everything, you know, source of debt, source of equity, underwriting, credit review, lease terms, and really understand where people are at before we award it. And the other thing, again, you guys may or may not believe me, you know, we try to advise our clients. We say, you know, sometimes if something's too good to be true, it's not true. So you may get offers, you may see terms where you're like, man, how could they do that? And it's like, we got to pick at this one and figure out if that's really achievable or not, because, you know, as guys said, they may offer you something, you're like, they'll never get this finance. I don't care how much they tell us they can, this will never work. And we will oftentimes, you know, it's not necessarily the best cap rate that wins the deal. It's not necessarily what looks like the best offer in the first round that gets the deal. You got to pick at it and advise your client on what you really think is achievable and who can get it done. And that's where these long track records definitely come into play.
So I don't think it's a shock to anyone to say the last 18 months have been crazy for a variety of reasons in the sale-leaseback market. Elizabeth, when you're advising clients, if someone comes to you with a certain segment of industry, are there certain spots today where you're just saying, I'm not interested in the assignment? Are there certain pieces of the market that are soft to the regard that you're not interested?
Yeah, that's actually a great question. I think we've got a strong list of areas we're very interested in, and then a short list that we're avoiding. And for us, I just don't see the risk premium for the big box and discretionary retail. So that to me is very concerning over the long term. I feel like we were trending towards some concern going into the pandemic, and I think that we've had significant consumer shift and behavior change that really going to come out of the backside of this, where that is going to be an area where I think a lot of problems are going to result. And then I think that's going to probably trigger some sort of symptoms across the shadow centers around those areas. But we started to see softening in the big box. Now, all the cap rates have gone down, I would say, relatively speaking. So you got to look at it relative to some of the ones that have moved lower. But that's one area that we're concerned with, both that style, the box, and then also just the discretionary, kind of carving out the really pristine, located, in great markets. Those are probably very insulated. But the ones that are kind of the secondary and tertiary box, that's a big area of avoidance for us.
And then to Guy or Dan, have there been any new segments that you guys have expanded into? I think Guy, you mentioned maybe going non-IG as a new avenue for you.
Yeah, we sort of are asset class agnostic. We try to focus on credit first and foremost, and then structure second, and real estate honestly becomes third, even though we wind up doing a lot of thorough underwriting on all of the various aspects of real estate. But for us, historically, we've always pursued investment grade transactions. So we've been diving now into non-IG, and specifically where we're seeing opportunities, it's in manufacturing facilities. So they're a little more complex. They have some environmental issues, some have, age, and, you have to wonder about whether or not there's readaptive use when you're acquiring some of these manufacturing facilities, because some of them are located in markets where there really is no other user. So, I think that that's the area that we probably are seeing the most opportunity of late, has been kind of in the private equity, manufacturing, facility space. And, some industries like food, beverage have performed extraordinarily well, during the pandemic, and they're expanding, and they're selling their businesses. Private equity guys are buying those businesses because those EBITDAs have shot up over the last 24 months. It's the right time to sell if you're a private, owner, or another private equity guy looking to recapitalize. And oftentimes we come in and provide sale-leaseback financing for those deals. So it's a new asset class for us, but one that we think, from a risk-adjusted basis, the yields are very attractive.
Our underwriting is very similar to Guy's and the team at Oak Streets, in which credit, structure, and really real estate is a tertiary issue for us. And so with that being said, we've been interested in all flavors of real estate and have tried to adapt our credit underwriting standards continuously so that we're able to appropriately price deals as they come to market, with the current environment in mind. So I think to Elizabeth's point earlier, if there's big box retail coming to market, it needs to be at a significant risk premium as compared to other type of essential retail. But that notwithstanding, it's not that we don't have interest, it just needs to be priced appropriately.
And Daniel, what's keeping you the busiest? Which segments of the sale-leaseback market?
Yeah, I would say probably industrial, and sort of piggybacking off of what they were saying earlier is, given that we do a lot of non-investment grade sale-leasebacks, we typically look at like the holistic story of the company, meaning what's their operating history at this location, what are their bolt down costs, what sort of investment in machinery and equipment do they have, is it a profit center for them, meaning are they simply distributing last mile product from this facility? Is it pretty easy for them to get up and move, or do they have, a 30-ton machine and $50 million in equipment, which would essentially disable them from moving, barring, them going belly up or something like that. So like Guy was saying, the real estate sometimes is almost secondary and tertiary, although it's ultimately a real estate transaction. But thinking about the company sort of holistically, and the items that I mentioned is a lot of what we sort of digest when we're underwriting properties.
The one thing I would add is what's the money going to be used for, right? A lot of times that's always pretty important. If you're going to do a big sale leaseback and the private equity guys are just taking all of the investment out day one, sometimes you can get comfortable with that, but a lot of times you're gonna probably balk at that. So we look at, is it going to be a big dividend payout? Is it working capital? Is it, expansion capital? What is the money get paid on a debt? You generally want to see a little bit of all of that for sure. I mean, not so much dividend payout, but we want to also make sure that, we're sort of not holding the bag and then the company gets heavily levered and the private equity guys or owners or whoever just take all that money out of the company.
Debt's really cheap now. So what else are they doing besides paying down debt? Or what's the driver for the sale leasebacks that you're seeing the most often?
Yeah, I think, what we see in the private equity world, it's, people are using the money to execute their strategy, whether it's expanding a plant, building a plant, doing a bolt-on, the money's being put to work. It's not paying down debt. It's not being used to make a dividend. These are, our clients are value creators, they're value builders. There's a nice arbitrage in the lease constant versus their cost of equity, but even in sometimes for the lower credits, their cost of debt. So, they look to the real estate to really help them create value at an enterprise level and again, eventually get to that exit.
And on the larger corporate side, it's pretty consistent that the capital raised is either used for either a acquisition or really a stock buyback. It's bifurcated into those two things. It's extraordinarily rare to see a sale leaseback done now where they're paying off debt. As you said, the credit markets are so liquid that large corporations do not need to do sale leaseback to pay down debt.
We heard about inflation a lot today too. How are you guys structuring deals with that in mind?
Escalations obviously help. We try to use the escalations as a means of protecting ourselves a little bit with the inflation. But typically we lock in the debt shortly after the acquisition or alongside, so you kind of have a perspective on what your cash on cash returns look like during the hold period. And you try to effectively make sure that you're considering the right bump structure, but it's hard to get away with more than 2% annual escalations. I know in some markets, California, you can get 3 or 3.5, but oftentimes we're doing deals to compete in this market that are below 2%. So it's you hope that the bumps help, but it's obviously just locking in the capital, the debt as soon as possible, so you can have some sort of visibility to your cash on cash returns, and then the remaining factor if the deal goes through without any hookups is what's the residual value going to look like. So, but we try to protect ourselves, based on, buying it right, the bump structure, and hopefully putting on the debt that sort of allows us to get the kind of value from the cash flow that ultimately will drive those returns for us.
And I think guys said it, that when underwriting a deal, the bumps and the initial cap rate are just the initial part of the equation when we're underwriting. The residual value and then testing really the valuation on the back end. What is market rent? What do we think that this asset's going to be valued at the end? Which, as you're getting into these more esoteric type of assets, that becomes a real problem to really conceptualize, because what is market rent for a building whose occupant is the only occupant in the area? So it's if you have a manufacturing facility, you can't really ballpark market rent if that's the only bumper manufacturer in the entire state or something to that effect. So it's, these are hard sort of questions that you're trying to figure out through the entire process. But Inflation is inevitable.
Elizabeth, do you want to add anything from the advisory side?
I think the point was made, and it's a great point. It's just locking the debt in as long as possible. And I think that if the risk and paying a little bit more on the front end and having a long-term fix, that's the ultimate, to me, that's the ultimate concern. And then of course, just a triple net or absolute net structure with, even just to your point of 1.5% or 2% bumps, really the inflation there is on the cost of the building is really shoulder on the tenant. And so you're just making sure that you're staying and the assets growing by way of your small rental increase. So I think that those two things together are probably the biggest combat.
All right, looks like we have a few minutes left. Are there any questions from the audience for any of our distinguished panelists here?
Yes. More quickly, I want to show you guys up there. Pressure on change control, right? We all know that you guys get a lot of pressure on that from players in the market. When you're going through underwriting this because of some of that pressure, what other metrics are you guys looking at besides, the tried and true, like rate, leverage, rent coverage, coverage, EBITDA? Are there any new things that you guys think are important to look at when underwriting that maybe traditionally?
And just repeating the question, it was, are there any non-traditional factors in underwriting today that you weren't looking at maybe 3, 4, 5 years ago?
Sure. It really depends on the industry. And so when doing your underwriting, I think at times we're actually less concerned about change of control and more concerned about the dilution of the business. And if there is, let's say, a business where you have, 2 streams of revenue and we're doing a sale leaseback on one of the streams of revenue, and the other stream is really the profitable stream of the company, how do you ensure that a spin-off of that sort of credit would not dilute the credit tendency that you have? And so being creative, trying to work with your counterparties is really what we're trying to do. But we're also trying to plan for an inevitability that somebody's going to try and even if it's not on purpose, but how can we shield ourselves from a downside risk of a complete credit dilution? So that's how we're trying to think about it.
There was one thing that Dan, you said, which is a great point, which is sometimes, you see companies that have various sort of related businesses that can oftentimes be spun off on their own. So you can sell parts of a particular business. Maybe it's, ceases to be sort of strategic to the overall operation, but that business that they might spin off produces the greatest portion of margin within the company, right? So there's always that's the area that we always try to be a little bit more creative on, is how do you make sure that you have all the various components in there that, you're protected whoever comes in and is a new owner. But what if they spin off a certain portion of the business? So, you kind of have to think through that as well. And you could do it based on credit covenants that they have to maintain throughout the lease term. But, that's just another battle you got to fight. You have the event that happens when you sell it, and how do you adjust for that? But then, are you going to put, items into the lease that are equivalent to credit enhancements or credit covenants that they have to maintain through the entirety of the lease? Again, in a competitive market, it's hard to get away with that stuff right now. So it's that's kind of the biggest challenge that I see, especially with non-IG deals, where that could happen. You could have a PE guy saying, I'm going to just buy that part of that business, or, leave everything else for somebody else.
And I would add to that too, we do a lot of the healthcare from that standpoint, and we're
obviously,
looking.
Obviously, you guys are very smart in your due diligence in what we get. We oftentimes have to break down, so Todd, your question, EBITDA and revenue and all that, we get questions, how much revenue is generated out of this facility? How much EBITDA does this facility generate? Who are your largest clients, and which of them are serviced out of this facility? Where, you're underwriting the credit, right? So it's a 3-legged stool. It's credit, it's quality real estate, it's how essential is the real estate. You're underwriting the credit of the company who's going to be the lessee, but people really want to know, how essential is this building? What happens in this building, and how important is it to the overall enterprise? And I think that's where When you have a building where you've got a lot of revenue or you got a lot of profitability in a particular enterprise, in very little of it is coming out of a particular building, the investors are going to be a lot tougher on that change of control and a lot tougher on what you can do with that building because they're sort of, they're nervous going in. Whereas if you've got, a great Class A building and 70% of the company's revenues coming out of this thing, you as the representative of the seller can drive a much better deal in terms of those provisions because you say, look, this thing is essential. They're never going to leave. Nothing is ever going to happen here. And so it's really sort of situation specific.
Any other questions from the audience? I think we probably have time for one more. All right. Well, thanks for your time and thanks to the panelists.
Thank
today.
you.
Okay, guys.
Brad, if you can hear me, can you put your picture up? There we go. Okay. There you go. Hey. All right.
You all hear me all right?
Brad, can you hear us?
I can hear you. Can y'all hear me?
We can, yeah.
Perfect.
Well, thank you, everybody. I'm Joel Staffolino with JRW Real Estate. We source deals, single tenant and multi-tenant triple net deals for exchange rate. Just passed about $4 billion under management. And I'll turn it over. I'm here with Brad and Tanner. You guys want to give a little brief introduction? Tanner, we'll start with you.
Oh, there we go. Thanks, Joel. My name is Tanner Brawley. I'm the Director of Acquisitions for Brabant Real Estate. Our headquarters are just up the road on Michigan Avenue, and we've been buying exclusively net lease properties for over 20 years. We're currently acquiring assets for our 18th investment fund.
And I'm Brad Motley. I'm a partner here at Trinity Real Estate Investment Services based here in Fort Worth. We are a single tenant net lease brokerage focusing, primarily in the Southeast Midwest, but we've closed deals in I think 39 or 40 states at this point. And I'm glad to be here.
Glad to have you too. It's my first one of these doing. I'm glad to be back out in the open and wearing a tie for the first time in a year, but it's good. It's the first one I've done with kind of this hybrid with having Brad in Texas. So it's a cool setup. Brad, why don't we start off with you? Our topic was 2021, a wave of optimism. I think we've heard from everybody else in the crowd. It's really such a different environment than we were in a year ago, 18 months ago. What are you seeing, from your position what are you seeing in the buyer pool and kind of the differences between now and kind of the starting to be post-pandemic world and where we were before?
Yeah, so we generally categorize buyers into one of three different buckets. You have your institutional buyers, and then you have private exchange buyers, and then you have what we call private discretionary buyers, which are buyers looking to add to the portfolio without being, I guess, under the gun of an exchange, just having capital to place and could take their time with it and I guess be more a little selective if they wanted to. Those three buckets, all players are still there and operating. I think the mix is a little different in terms of some being heavier than others. For an example, I pulled a quick sample size of deals we closed in 2020 versus 2021. In both years, you had about 60% of the buyer pool of transactions that we worked on was 1031 buyers, 1031 private buyers. In 2020, you had 25% of that was kind of the discretionary pool that I talked about, and then 15% of it was institutional. The interesting thing that I noticed in 2021 is that those two percentages flipped, where you had 25% being on the institutional side and 15% being on the kind of discretionary side. And I think that what's the reason for the difference, if you look at there's a handful of REITs that are publicly traded that we kind of track, and of those, you had acquisition guidance on those 5 REITs increase 40% above where 2019 was, and then you also had
acquisitions net of dispositions increased 50% against 2019 for those same handful. So overall, you've got the institutions being more aggressive. They're finding things that are in the middle of the fairway for them and getting more aggressive to make them happen, because their cap rate guidance also dropped by about 20 bips on average as well. And because of that, I mean, you've seen a massive compression in yields or in cap rates since 2020, which I think has really kind of pushed more of the discretionary buyers out of it. You had some people that were opportunistic last year that, you know, there's a ton of capital on the sideline. Debt was cheap if you could, you know, find the right lender and get the deal done. So it was an opportunity to place money if you had some capital kind of sitting on the sidelines. And I think that yields have compressed to a point where some of that discretionary capital is starting to slow down a little bit.
Is there anything you're seeing as far as the REIT? I didn't realize it had gotten that high, of 40 and 50% upmark from 19. Are you hearing anything for next year? Is that likely to go forward, or is that sort of a catch up from, you know, going on pause for a period in 2020?
I think it's going to be a mixed bag between the five that we look at. To keep names out of it, I mean, there's a couple that were very aggressive in 2020 that ramped up even further in 2021. There were a few that kind of hit the pause button in 2020 that have caught up in 2021. And I think we'll probably continue to ramp up a little further in 2022, you know, barring any sort of market conditions that go out of whack. But yeah, again, barring anything crazy, I would expect it to continue into next year. That's just my gut feel based off of what I've seen, not necessarily, you know, hearing from them directly that this is the plan, I guess.
And are you seeing maybe more on you're saying the public guys, a lot of what you're seeing is maybe just an ability or a willingness to pay a little bit more for the same quality product? Are those other buyer buckets that you mentioned, are they moving around in quality, or is it, are they just paying more as well? Or what are different groups of buyers doing and what you're seeing?
On the private side, it's a little bit of a combo. So right, I think that if you kind of go back to last year, there was this big bifurcation in the market where we talked about the haves and have-nots, you know, focusing on credit first, especially, you know, pandemic still being somewhat fresh in the mind. So there was this heavy reliance on credit, which pushed the yield down on, you know, anything really investment grade credit with any sort of term. But then you had kind of the have-nots where, you know, it's funny, I was thinking about it earlier. Around this time last year, every deal that we had on the market, the first question that any buyer would ask is, did they have a COVID rent break, or did they have a rent abatement? And now I don't know the last time I was actually asked that question. But you had that other group, kind of the have-nots, that had to make adjustments or had maybe a more troubling outlook that no one really got excited about. And that's I guess we're far enough away from it now that that's kind of merged all into the same thing. You still have the middle of the fairway, you know, good credit, long-term lease stuff that the institutions are getting more aggressive on and really competing with a lot of those 1031 buyers, but coming with an angle of a surety of close that helps them get the deal with pricing being equal and everything else. So then that also leaves kind of the have-nots, which is picking up a lot of momentum, but that seems to be the target for a lot of the private investors, just because that's essentially what they're left with.
Andrew, do you have anything to add as far as quality or what you're seeing, you know, in your bidding out there in the market?
Well, there just seems to be a massive supply-demand issue for quality net lease product. As Brad pointed out, we're seeing much bigger 1031 exchanges. We're seeing new players into the market, new institutional players into the market. And overall, you know, post-COVID, people are putting a really big premium on quality or on stable, predictable cash flows. And that's what the net lease sector has traditionally been known for. So now you have, you know, tons of capital chasing fewer deals and record low cap rates.
Are you seeing any lightening up of that? Are people placing money and maybe getting a little less aggressive looking at stuff now versus a couple of months
Well,
ago? Or are you
where
still-
interest rates are right now, the 1031 guys are now having competition because the institutional buyers have such cheap access to capital.
Interesting. How long do you think that lasts, sort of that bubble we're in, or the optimism and the, I know it's tough to say and it depends on a lot of different factors, but what's your take from seeing stuff out there?
I think the current run is dependent on two important factors: tax policy and interest rates. We've talked about the 1031 rule extensively today. And, at the start of this year, it looked like that could be coming to an end. I think that would be really bad for just about everybody in this room. But fortunately, that doesn't look like it's going to be the case. But it does look like the capital gains is still on the table. So if Washington was to go out and completely scrap capital gains, the entire real estate sector would suffer a massive blow. Fortunately, I don't see that happening, but what I do see as a compromise is moving the capital gains from 12 months out to 3 years or even 5 years. So now the question becomes, how do the longer hold periods affect the supply and demand issues that we've been talking about all day?
Stuff. Brad, do you have any inkling, if you're looking out there in the buyer pool? A lot of people, I think, were sparked earlier in the year by fear of tax reform. We're not out of the woods yet, but maybe it's less severe than people thought in earlier in the springtime. Any thoughts on what that does to the market next year? If the market hates uncertainty, if we get to a position, even if it's not ideal, but there's some outcome to this?
I think the unfortunate thing that we've had to endure the past few months is just the uncertainty. And just because there's been a lot of political pushing back and forth, a lot of stuff in the news, you never really know what's what. You look at drafts of the $3.5 trillion infrastructure package, and it kind of comes out in pieces and pieces. And everyone, I think one of the last pieces, I think the actual last piece was the tax reform piece of it. But anyway, this was first the Build America Back Better, whatever the plan was from Biden. I think it was first talked about back in April. And, it was heavily highlighting the tax reform piece. And then it's like no one really talks about it, or no one really dives into the details on it. There's a lot of speculation up until, I guess, last month. So there was that 5-month period where there was just a lot of uncertainty. People weren't really sure exactly even how the remainder of 2021 was going to look. There was some concern from some private people that we deal with that a lot of the tax reform was going to be retroactive to apply to all of 2021, regardless of when it was passed. So then now you're looking at potential cap gains issues of, I sold this back in March, and now I've made that decision based off of this set of rules. Those rules may change. And I think we're out of the weeds on that. I think at the very least, there's more certainty of how 2021 looks. And so the horizon becomes a little more clear in terms of how to operate in this calendar year. I think that 2022 is still a huge question mark. So for most of the people that we're dealing with and talking to on the private side, it's having the clarity of like, okay, if these are the moves I need to make by the end of this year, I at least know by the end of this year what those rules are going to look like and what the consequences or rewards would be. So I'm going to execute on this first, and then I think there's still going to be another kind of wait and see period, early Q1 of 2022. Because honestly, I don't know if anything really gets passed or pushed through prior to the end of the year anyway. So I guess long story short, I think that people understand where we are and what the next few months will look like. From there, we'll probably fall into the same trap that we had from April to September of this year.
It's interesting. Yeah, interesting input. What would you guys say you're running into some of the financial buyers on a basis at all? Some of the non-real estate buyers, I've heard them called TINAs. There is no alternative, just because they're looking at it and saying, I can't make money anywhere else. I'm yield starved. We'll dive into this pool. It seems like all the time we're hearing different groups that are announcing they're coming into the space. Are you actually seeing it show up, or is it something that's still being formed?
Is that a question for me?
Either one of you, Tanner, you want to take it to start, and then Brad, you can jump in.
I think that's actually a better question for Brad.
So I guess if we've seen it, it hasn't been directly. There's been a couple of smaller under the radar funds, if you will, that have started up over the past year that I think have gotten capital from some of the groups that you're talking about. Or, you know, large shopping center funds that have coming out of COVID decided to play more in the single tenant net lease market. That's something else that we've seen. But I have also read articles of a lot of pension funds and a lot of institutional kind of larger capital funds increasing their share of real estate as a part of their portfolio. And that's a combo of potentially seeing the upside, as well as if you look at the bond market and some of the other alternatives right now, just the yield's not there. So, I mean, I guess long story, I've seen it, I've heard of it. I just don't know if I've seen it directly, if that makes any sense.
And Tanner, you're not running into it on bidding lists.
On the bidding list, not as much. It's the usual suspects, the bigger 1031 exchanges and the publicly traded REITs.
Interesting. Yeah, I'm not seeing it as much. I'm hearing a lot about it. We did run in on one deal we were chasing, and it was, you know, BB or BBB credit, and 3 real estate guys kind of all bid in a pack, us being one. And then there were 2 financial players out of Manhattan that looked at it and said, well, a bond from the same company is yielding, you know, 1.5%. We can pay a 3 cap for this, and it'll be, you know, we'll be off to the races. So it's the first time I ran into it, but I'm curious if we'll see more of it in 22. I'm not sure. What do you guys, and this is a question for both of you, but we've hit on taxes and some of the other things, but what do you think the biggest potential threats or disruptions to the, you know, kind of the optimistic, the market speed and strength as it is now, maybe over the next, you know, 12 months, but really 36 months or so also?
Well, as we've talked about COVID quite a bit today, but I actually think that COVID was a net positive for net lease real estate. Sounds strange to say that, but our QSRs are seeing record sales. The essential retailers are crushing it. And even casual dining is making a really strong comeback. A big concern for us is childcare. We're a big investor in the childcare space, and we've seen a lot of our locations crawl back to profitability, even with labor shortages and work from home environments. But we have a lot of locations that are still operating in the red, and this is 18 months after the first lockdown went into effect. So the next 6 months are going to be really telling, as a lot of the big corporations have announced, you're going back to the office January 1, 2022.
Yeah, I would add, just as far as the net lease market as a whole goes, the disruptions in the development cycle have to get sorted out in some way, just because that is probably the biggest barrier to supply right now. You know, if you look, this will be kind of a long-winded answer, but if you look at supply altogether, I mean, similar story, like it's 3 different buckets. You've got your institutional guys, you've got your private investors, and you've got your developers, right? Institutional players aren't big sellers right now, you know, as per my comment of like being a 50% net growth. And the private guys are kind of private investors making up the majority of the sell side right now, as a factor of just realizing gain while you can before the cap gains does increase, as well as kind of factoring in and making any moves for a last minute exchange to set themselves up for the long haul. in fear that, some early 2022, even though it doesn't look probable right now, 1031 could go away. And so the lacking piece there that we've had historically has been new development, and it's a prime target for the 1031 buyers. Is obviously a prime target for groups like Tanner and other institutions. And we're just, there's a number of things that go into clearing that up. Primarily it's, how much are these retailers going to be willing to expand? I went back and looked. I like using O'Reilly as a good example in this case, just because I feel like they've always been very steady, right? They don't go through like massive waves of adding 500 stores and then 5 years of nothing. They're also not constantly always pushing the envelope to get over their skis. So I went back and looked at their numbers for the past few years. 2019, they added 220 stores. 2020, they added 156, and they've set their guidance in 2021 at 175. And again, that's a middle of the road tenant. There's some on the other end of the scale. Well, you've got your 7-Elevens, you've got your Dollar Generals that are going to find a way to add as many units as possible anyway, right? But you've also got some on the other end of the scale that had big expansion plans that just scrapped it in the middle of COVID and haven't gone back to it. So like, that's one thing that as guidance comes out for a lot of these publicly traded retailers, I'm curious to see how many stores they're willing to add and how that compares to previous years. But the other thing that's got to get figured out here is the labor market. Things, just general construction is running more and taking longer. You got subs walking off jobs. You've got supply chain disruption causing. So quick example, we just moved into a new office here, and during the course of our construction, plywood went from, I think, $35 a sheet to $90 a sheet. Another quick story, something we're dealing with now. We've got a new development property under contract where the building was pretty much done. The last thing they were missing was a pole sign. And they had to bring in we had to wait 3 weeks, and they had to bring in a guy from another state just to pour the footing for the pole sign, basically a concrete tube in the ground to affix the pole sign to. Had to bring in a guy from a neighboring state, drive 7 hours to do it because no one else in the market would take the time to do the job. So that's, and I don't know how it gets figured out. I don't know how the labor issue gets itself figured out. I don't know how supply chain figures itself out. But I think the first indicator has always got to be how much are these retailers willing to expand.
Yeah, it's interesting with the example you threw out with the footer holding up, an entire deal and an opening and a certificate of occupancy for a new and expanding tenant, because you can't find any workers willing to pour a 3x3 slab of concrete. It's something we're seeing all over. Are you, and it's kind of speculative, but do you think it makes tenants more, and for both of you, is it make tenants stickier for even shorter term deals? They're less likely to relocate or leave or go to another location, since is that a temporary or a longer term trend?
I can see both sides of it. I mean, especially for those that are publicly held, right? You don't please shareholders by going backwards in revenue, and it's hard to gain revenue on a substantial level if you're not adding stores. And if you're losing stores, if you're net negative in store growth over a fiscal year, typically doesn't make people happy. And I think, and there's also 2 levels to the expansion side. There's here's how many we want to add, and here's how many we can add. And the how many we can add is subject to all of the labor and supply chain issues that I just talked about. And it's going to look bad on us if we set our guidance as we're going to add 200 stores, and we find out midway through the year that we only have the sheer ability to add 125. It's going to come up as we came up short, right? So to answer the question on shorter term, I mean, I think that there's always going to be trying the attempts to right size the rent in exchange for an extension and then this and that. But those that have been slower to grow and add units over the past few years, I think are generally going to be more willing to stick around as opposed to walk from walk at the lease expiration.
Yeah, definitely. It's interesting. And we've actually heard some from retailers, saying, hey, I think everybody's complaining about labor shortages and anybody trying to do anything to their house. It's just tough to get, anybody to show up. And I had one retailer tell me, look, you think it's hard to have somebody come and regrout the tile in your bathroom. Imagine trying to build a new store ground up with all the subs and all the different people. So it's an interesting pocket we're in time. We'll see how it works itself out in the labor. Tanner, are you seeing anything as far as like the daycare, their groups back to expansion mode, or is it pretty much everybody hunkered down still and some groups still in the red, some groups not?
We haven't seen a lot of expansion in the childcare space, but overall, the lack of new development is further feeding into this supply demand issue that keeps coming up. And I think, childcare and everybody else, unless you're a QSR or a grocery store, most tenants are still trying to figure out what their real estate profile looks like in a post-COVID world.
Interesting. Well, Brad, do you have anything you'd like to add here at the end, or Tanner, it's usually at a real estate event like this, we have to ask for the prediction of where cap rates will be in 12 months or any other predictions for next year, but we've kind of covered a lot of that.
The general cap rate question, it's tough. I would say that there's always there's the stuff that we had mentioned to watch. If things remain constant and ideally the supply side figures itself out and tax implications stay where they are, there may be a slight uptick just based off of interest rates and expected inflation, and maybe a little increase in supply, but not much. What I try to look at whenever I kind of get the feeling that I'm seeing a lot of back on market blast or new pricing, which I feel like I'm starting to see more frequently even today, that tells me that things may be starting to ease a little bit. And I don't, it's one of those things like you find the floor and then when you've kind of crossed the line and now you have to adjust back up to it. But we're also still seeing things get done at ludicrous cap rates. I think it's hard for me to imagine them being compressed any further than where they are now. I'll put it that way. So they're either about where they are now or slightly higher around this time next year. But the three kind of big things to watch there are the tax reform piece, the labor markets, and just how much retailers are going to be willing to expand.
Tanner, what's your thoughts?
I would love to sit here and say that cap rates will be 50 to 100 basis points higher in 12 months, but I just don't think that's going to be the case. There's just so much capital moving into the net lease markets. Our impression is interest rates will stay at historically low levels for the time being. And I think we'll see more record cap rates.
Are you seeing, as Brad mentioned, kind of some deals coming back saying new pricing or back again or whatever kind of label you want to give it?
Absolutely.
You're seeing it. Is that or is that stuff you chase? Is it coming from a lender not being willing to stretch?
It's a lot of times it's deals that we had seen on the market 12, 24 months ago. And all of a sudden they come back around, no change in lease term. They've not updated the building, and they want 50 to 100 basis points lower than what they were asking for 2 years ago. That's pretty frustrating.
Yeah, for sure. Well, that's about it. Thanks so much. We're going to take a 10-minute break, and then I think we're going to be back here at 2:15 for the Advanced Tax Strategies panel. And I really appreciate everybody's time today. Thanks so much.
Well, I guess we're going to get going. They're encouraging us to get started. And for those of us who are listening, my name is Jim Lockhart. I'm a partner at Wipfli. I lead our real estate practice throughout our firm. I'm based out of Minneapolis, but find myself in Chicago, New York, and LA quite a bit. And I've worked with and done deals with my friend here to the right, and we spoke on panels before, but I'll let Ed introduce himself.
All right, I figured out the microphone. That's my first accomplishment of the day. Ed Hannon, a partner at the law firm of Posanelli outside of their Chicago office. I've done a lot of transactions with Jim and his team at Wifley. Focus of my practice is tax-flavored real estate transactions and inbound foreign investment in the United States. Have spoken on a lot of panels on the topics we're going to talk about today, which is what's happening with tax rates, what's in the new proposed tax legislation. And as Jim can attest, anytime you give a speech like this, you want to make sure you log on to your tax notes and other press to make sure that nothing's been released 30 seconds before you jump on the podium. And I'm assured by our crack staff back in the office that nothing has been released. So this is all accurate to the minute. So that's a good sign.
Well, it's kind of funny. We were talking about this, and I'm not going to tell you how many administrations I've been through and tax law proposed changes is, there aren't any really wrong answers and there's not really any right answers because we don't have any answers right now. So, so this is kind of easy. And if you have any really difficult questions, we have Katie sitting right over there. So she's certainly my technical backup.
And part of what we're going to talk about today, breeze through some of the proposed tax legislation, but also as advertised, talk about tax strategies. What are we seeing people doing? We've already had a couple panels on 1031, but talk about what structures are being used, particularly talk about a hybrid structure involving Delaware statutory trust in your traditional real estate fund. Jim's going to talk about what he's seen in opportunity zones. And then sort of wrap up, if we have time, what's been being floated out there among non-institutional investors is the UPREIT structure, the 721 REIT structure. Is that really a viable alternative to 1031? So I know Jim and I both have strong opinions on that we'll get to. So with that, why don't we jump right in? If we can go to the next slide. This is going towards the tax legislation. How do we get here today? Well, President Biden had a lot of proposals that he talked about tax law changes, but it wasn't until May of 2021 that the U.S. Department of Treasury issued what they call the Green Book. And the Green Book was the first time we ever saw Biden's proposals in writing. Now, it wasn't couched in terms of actual legislative language. It was more of a narrative, but it was the first time we could get our arms around what do these rules look like? And, I always get questions, well, was the Green Book a special pronouncement? Is this a big deal? And the answer is no, the Green Book comes out every year, but this particular year, it was of great interest because it had these tax proposals. So if we go to the next slide, we see that in September 13th, there were a lot of one-off proposals that came out, nothing of note. Couple things on carried interest that really went nowhere. But on September 13th, the House Ways and Means Committee dropped over 100 pages of actual legislative language on these changes. And what's interesting is some of these changes followed what was introduced in the Green Book in May. Others were completely different. So we're going to spend a little bit of time going through, what caught a lot of the press and what caught, what's changed between May and today. Per this morning, Wall Street Journal, there's a sense that none of these tax law changes will be included in the new bill. They have a couple of senators who are holding out. So as Jim said, this may be right, this may be wrong, but the nice part is in talking about this, neither Jim nor I can be incorrect in what we say is going to happen. Absolutely. So why don't we go to the next slide? So this is perhaps the biggest difference between the Green Book and what was proposed, but obviously just to quickly level set, long-term capital gain rates apply to individuals. If you hold the asset for more than 12 months, there's a special 20% rate that applies. So the game that gets played, how long have you held the asset? If you do a sale prior to 12 months, how do you make sure that for tax purposes, you're deemed to hold that asset? Because chasing that 20% rate, obviously very beneficial. So what do we have on the table with the next slide? Under the Green Book proposal, and this was President Biden's original proposal, that if an individual, and it was unclear if it was married filing jointly or individually, had over $1 million of taxable income, the long-term capital gain rate would become the top marginal rate that applies to ordinary income. So this would effectively cause a 37% long-term capital gain rate. Well, there was a lot of wails and gnashing of teeth over this. I know my phone line burned up of how is this possible. Fortunately, between May and September, that changed. But let's focus on two other less publicized changes that were put out there that also have the effect of increasing the tax rate. There's the concept that was introduced several years ago called the net investment income tax. And if you're a passive investor, this 3.8% net investment income tax would apply to various items of gain, including passive rental income, gains from the sale of equity if you were not actively involved. There's also a complementary 3.8 self-employment tax. So if you were active and that income was deemed to be self-employment income, you were subject to the 3.8% one way or another. Well, in the May Green Book, they basically said, well, we're going to change the rules. So regardless of what you do, whether you're active, whether you're passive, you're going to get hit with one of these two taxes, one of these two 3.8% taxes. So the concept of having capital gains taxed at ordinary rates fell off the shelf in the September legislation. So let's see what we actually got. Going to the next slide. So, keeping with Biden's, he's not going to change any tax rates for people making under $400,000. We'll see that the long-term capital gain rate is going to go up to 25%. The effective date in this proposed legislation is September 15th or September 13th. So if you have a transaction that closes after that, your risk is that this higher rate will apply. In the legislative language, there's a carve out. If the amounts received after September 13th were subject to a binding contract that were entered into prior to the date, you get to use the old rates. And what does that mean? Well, there were a lot of questions of what if I have a term sheet? And my response was, well, is it a binding term sheet? And the answer would be no. It's like, well, then that doesn't get there. But where it does work is that if you have an earnout, if you have an installment sale, if you have payments being made after the initial close, but still received after September 13th, if this legislation is passed, that 20% rate would still apply.
Yeah, but it's still wet cement. We don't know if it's going to survive or not.
Right. This is all speculative.
Right. I know I've had some clients just scrambling and crying over this one.
Yeah. So the next slide talks about sort of the two what I call the stealth tax increases. Like the Green Book, the proposed legislation increased the scope of the 3.8% tax. So this is going to, if it passes, will have the effect of increasing long-term capital gain rates by an additional 3.8%. But unlike the proposed change to the actual capital gain rate, this change does not come into play to 2022. So we're going to do an example that shows, what if you sell, in last July, what if you sell in 2021, what if your closing slips to 2022, and you'll see the tax costs get dramatic. Now, the next slide is yet another stealthy tax increase. There's a proposed 3% surcharge if your taxable income is over $5 million. And, the press is focused, high net worth people who have recurring income of over $5 million. But the practical aspect of this, if you're selling a piece of real estate or if you're selling your business, you're going to have a significant amount of gain in that 1 year. This would have the effect of, again, increasing the capital gain rate by an additional 3%. So when you take all those increases into account, you're not just going to 25%, you're going to 31%. So a very, not focused on in the press They've just focused on the move from 20 to 25, but want to keep these into account. So let's look at an example and then let Jim chime in. Sort of a typical example, we've got a taxpayer. Melissa owns a single member LLC. She owns land. It's undeveloped, and she sells it to a developer for, generating $30 million of capital gain. So let's compare and contrast what happens depending on when she closes this transaction. So the next slide, scenario 1, she closed it back in August before the proposed effective date. Well, we get to apply the current rules. $30 million of long-term capital gain. The net investment income tax, we're going to assume that did not apply because she was active as part of a larger business. So her total tax is going to be $6 million on that $30 million of gain. Well, let's go to the next slide and change our facts up a little bit. Let's say that the legislation passes as drafted, but we close in December. So remember, our change to the long-term capital gain rate had an effective date of September 13th, but the other two tax increases, the expansion of the net investment income tax and the imposition of the 3% surcharge, don't apply until 2022. So Melissa's $30 million of gain is taxed not at 20%, but at 25%, but we don't have these other two taxes apply. So her $6 million of tax cost has now gone up to $7.5 million of tax cost. Well, for whatever reason or another, and since I'm the attorney in the room, I'll take the blame. In scenario 3, the closing slips to 2022. Instead of closing on December 31st, it closes on January 5th. You say, well, what's the big deal? Well, here's the big deal. If the legislation passes, we'll now have the long-term capital gain rate of 25%, the net investment income tax of 3.8%, and because her income is more than $5 million, the 3% surcharge. So now her $6 million of gain has gone to over $9.5 million of tax. So that's obviously doing some math, $3.5 million of extra tax cost just in the change of closing date from August to January. Again, as Jim pointed out, this is assuming that the tax legislation passes as drafted. There's a lot going on. Within our firm, we have weekly calls with our government relations people in Washington who provide us an update. And to summarize, they're saying it's absolute chaos. It's absolute the Wild West on the horse trading. What you're hearing in the press is only a fraction of what's going on behind the scenes. But generally speaking, they're targeting to get this done by month end. Conventional thinking, from what I'm being told, that's not going to happen. They're looking for prior to the Thanksgiving break. And the skeptics are saying, well, if they can't get it done by Thanksgiving, it's just not going to get done. So again, we don't know anything, but just have to be prepared that if this goes through, you can see the dramatic increase in tax costs that are coming to people who are selling their real estate investments. So one other stealthy tax increase, if we can go to the next slide. There was a special in 2017, when they lowered the corporate rates, they created a special tax deduction for flow-through entities. And that basically took the highest rate from 37% on ordinary income down to 29%. Well, in this proposed tax legislation, in effect, that deduction would be eliminated if the taxable income was over $400,000. So again, that's sort of our fourth stealthy tax increase that we have in this tax legislation. So just something to keep in mind. So Jim, I know there's some other things. Why don't you talk about some of the other corporate tax changes on the next slide?
Sure. So for tax years beginning in 2022, the top marginal ordinary tax rate is going to be increased to 39%, which applies to income over $450,000 for married individuals filing jointly. The corporate tax rate is changing from a flat 21% to a marginal 26.5% rate. So the corporate rate's going to be 18% on the first $400,000, 21% on the next income up to $5 million, then a 26.5% rate on anything over $5 million. That's pretty straightforward. Next slide, please. The one that we're hearing about is the carried interest rules. And that's the, that they're extending that. And that changed a few years ago, saying that if you had a carried interest, you had to hold it for 3 years in order to get capital gains treatment. Well, for tax years beginning after December 31st, 2021, individuals with AGI of 400,000 or more who hold the carried interest for less than 3 years will not be eligible for long-term capital gain treatment. In fact, they've expanding the applicability of the carried partnership interest rules to a holding period of up to 5 years now. So you're going to have to hold it longer in order to get the preferable treatment.
And not to interrupt, but what's interesting is under the 2017 version of these rules, which is current law, whether through a drafting error or otherwise, real estate that was held for investment or held for productive use, generally your 1231 property, was excluded from this 3-year holding period. At least that's what most advisors believe. So you would have carried interest on a real estate deal and you didn't have to worry about the 3-year holding period. Well, in this proposed legislation, they fixed that, so to speak. So now these new capital or carried interest rules, if they come into play, will apply to real estate. So this would be a significant game changer if passed. So, again, this is in the Green Book. They had a completely different approach to carried interest. We don't need to go into the details of that. This seems to be an entire rewrite of that approach. So they're still guessing on how to attack carried interest. But again, does some of this pass? Does all of this pass? Does it pass in this form? Nobody can say with certainty.
Oh, absolutely. And then the excess business loss limitations, which impose an annual limit on the ability to use business losses in amount over $524,000 is extended permanently. And it imposes limitations on the use of discount valuations for the gifting of non-business assets. Again, who knows?
So tell me some good news.
Yes, this is some good news. This is a huge planning opportunity. We have, believe it or not, lots of clients that have S corporations that hold appreciated assets. There's a proposal that would allow S corps formed prior to May 13, 1996 to convert to an entity that's taxed as a partnership, like LLCs, to convert to an LLC or partnership on a tax-free basis. So that's huge. And you think, well, who owns assets in S corp? A lot of companies do, a lot of families do, a lot of folks who've invested years ago and who perhaps got really bad advice and put them in those entities. Well, now you can avoid the tax on the conversion, on the appreciation, if you make that switch within 2 years after the end of the year. Huge planning opportunity. So if you have clients or know people that do, this is something that I would talk to them about and consult their tax advisor.
Yeah.
We get issues all the time from people that own property and want to do a 1031 or some transaction out of it. And you weren't able to because you'd have to pay the tax on the transfer out. Well, now go ahead and make the change and do your 1031, 721, whatever it is.
No, exactly. And even though S corporations and LLCs that are taxed as partnership are both flow through, the S corporation rules, you have to have an eligible shareholder. You can only have a single class of stock. As Jim alluded to, distributing property out of an S corp is a fully taxable event. So if they give us this freebie, this is a game changer on fixing all those problems. And, for those of you who sort of understand, why would you ever own real estate in an S corporation? I blame LegalZoom. You can form a corporation for $50. You can file your S election without any problems. Why do you need an attorney when you can do this? I've got my entity that protects me from liability. And then, they give Jim a call and say, okay, here's what I've done. And Jim cringes and saying, you have no idea what you've done.
You have no idea. What is really fascinating is we work with a lot of QIs and we get a lot of difficult transactions and, what do I do? And there really wasn't anything you could do. So a lot of like family farms and, I feel like I'm in the older generation now, but people even older than me that have held assets for years, their local consultants said, put it in a C Corp, and then S Corps came around and some made the conversion, some didn't. And so now here's a great opportunity just to get them out. So.
Good. So let's get past the what if stage. If we go to the next slide, we'll get to the fun stuff in our last half hour. Tax planning structures in anticipation of rising tax costs. I've already told my wife and children, December 31st is the witching hour. Maybe I'll see you for a turkey leg at Thanksgiving, but don't count on seeing me because all the deals that are going to get done in the next year and a half are going to get done in the next 3 months. So, what can you do? Our list are a bag of tricks that Jim and I have, 1031 exchanges. We've had several panels on that, but we're going to drill down a little bit on some of the structures we're seeing and really this hybrid Delaware statutory trust fund structure that I think we're going to see a lot more of. And then Jim is knee deep in the opportunity zone structures. If you make that investment or make that commitment this year, you still get the full benefit of the 10-year deferral. So those are expected to be hot. And then a lot of discussion on using the UPREIT structure as an alternative to 1031. So we'll spend some time talking about that. So just in the next slide, we sort of have our bag of tricks for like-kind exchange structures. Back in 2001, 2002, it was all tenancy in common. And, that industry imploded in 2008 spectacularly. But, when we're seeing drop in swaps, when we're seeing people want to get out of partnerships or people who, are buying property with 3 or 4 other individuals that they do business with, we're still seeing tenancy in common used in those unique situations. The Delaware Statutory Trust really came into vogue in 2004. There's a lot of limitations on when you can use that structure. For example, you can't refinance while the property is held in the trust. But let's sort of compare and contrast between the tenant in common structure and the DST structure, not from a tax point of view, but from a structure and financing point of view. And that'll lead us into sort of the punchline of this discussion of the fund DST structure that we're seeing used to bring in 1031 investment as a co-investment by a real estate fund. So let's go to the next slide and just sort of an overview of the structure for the tenancy in common structure. So each co-owner has its own single member LLC and they're on title to the property. So because they're on title, our lender is going to say, well, each title owner has to be a borrower under the loan documents. Under the tax rules, the decision to sell, refinance, lease require unanimous consent. Sometimes that can become a cumbersome process. But practically speaking, what does that mean on having each co-owner be on title? Well, if you want to buy somebody out, if you want to change who the owners of that particular TIC owner are, under most loan agreements, you're going to have to get lender consent. And if your loan, like many loans, is going to become part of a securitization, you're dealing with the master servicer or the special servicer. And for those of you who have attempted to try to get consent out of a master servicer or special servicer. Pack a lunch, it's going to take some time if you get it at all. So it's a cumbersome structure, not one that you can easily take people in and out of. If you want to park somebody in, park somebody out, TIX is very cumbersome. Contrast that to the DST structure. And what I like to explain to clients is that there's only one borrower. There's only one property owner, and that's the Delaware Statutory Trust. So think of it as your typical special purpose vehicle that's formed to take down the loan. So do the lenders care who the beneficiaries are of the trust, who are the owners of the trust? Well, they do for KYC purposes if you own more than 20 or 25%. But generally speaking, as long as your individuals who are on the non-recourse carve-outs continue to have an ownership interest in that trust, it's more of a mechanical issue on making transfers than anything else. So, there's 7 general requirements. I've mentioned one. You need to have long-term financing, or at least financing long enough to serve your like-kind exchange purpose. So just finished up a transaction right now where the loan is 3 years and renewable. And we're discussing with the lender and the parties that, the trustee can't renew. They can't make that decision because for tax purposes, that would be a refinancing. So we've decided that this is going to be a hold period for less than 3 years, and then everybody can trade into something else. So it's not as flexible of structure as tenancy in common that basically says you can do whatever you want as long as you want that cumbersome multi-owner, multi-decision-making factor. But in the right circumstances, the elegance of the DST structure allows an ease of borrowing and ease of transfers.
I usually recommend the DST when I know you have passive investors and the developer, and you want to be able to exit as easily as possible, because usually our developer clients want to trade. They eventually want to trade the asset, and the passive investors want to take their cash sometimes. They don't care if they pay the tax and go their own way. Some of these 7 requirements that are in there, when you first read them, it's like, oh, I can't do this, I can't do that. It seems too restrictive. But I've seen, generally speaking, you're able to paper around most of those restrictions.
There's structural workarounds for most of them. For example, one of the prohibitions is that you cannot renew leases. Well, for those of you who are aware of Delaware Statutory Trusts, you know that multifamily property is put in Delaware Statutory Trusts. So you use a master lease structure where the parties forming the DST will form a master tenant entity. The lease is between the DST and the master tenant entity, and then the master tenant entity subleases the property out to the ultimate user. So that's one of the workarounds. Another workaround, we've already talked the financing. You don't terminate the DST. There's what's called the springing LLC concept. So you would, if in circumstances, you would simply file articles of conversion, take it out of DST form, put it in a Delaware LLC, fix what you need to fix, and then you can convert it back into a DST. So as Jim said, there's ways to fix it. There's also ways that you can get into yourself a lot of trouble if you don't know what you're doing. So, I think it's a great structure in the right circumstances, but let's go to the next slide and look at, sort of an emerging structure that we're seeing. So we have our fund LLC, which is your typical fund. They're looking to buy their 4th property, and, either a new investor or one of the existing investors says, okay, I've just sold a building. I have $10 million of like-kind exchange proceeds looking for a home. You're looking to fill your capital stack. Do you want my $10 million? And they talk to their tax guys and say, well, you can't like-kind exchange into my fund. And the person says, well, then you make me whole for the tax costs. And they laugh and the phone is hung up and they all move on. Well, this structure avoids that discussion. Here you have what's in effect a co-investment vehicle where the fund is one of the beneficiaries of the DST. Sarah, who's our like-kind exchange investor, puts her $10 million invested into the DST that buys property for. The fund will form the master tenant entity that solves our lease problem and allows basically the fund to run the property as if it's in a single member LLC. Now we go back to, there's certain things the DST can't do. It can't refinance. It can't do capital calls, but this has allowed the fund to take down Sarah's money in a tax efficient way. Now, the next step of this, if you're in the mood for a lot of complexity, is once Sarah's 1031 exchange is old and cold, call it a year or two, can Sarah contribute her beneficial interest in the DST to the fund in exchange for Class B units? And the answer is it can be done. It's a tax-free capital contribution under Code Section 721. The complexity is, how do you make the economics work? Because you have the existing Class B unit holders, the investors who have put their money in and taken risk with respect to the entire portfolio. And they want to make sure that when Sarah comes in, she doesn't get a better deal than they got. So how do you work Sarah's money into the distribution waterfall to satisfy both parties? And that's where the complexity begins, because either you pre-wire that into the fund when you bring on your initial investors, or else you're pouring through your fund documents to see what kind of consent you need to create a special class of units for Sarah to get her in step with your existing investors. So, when I introduce this concept, I'm the tax person. I get to come up with crazy concepts. My transactional and securities guys cringe when they know what I've just unleashed upon them in complexity. And I say, well, it's really easy from a tax perspective. And I'm glad I'm working remotely and have partners all over the office so they can't storm down the hallway to strangle me. So this is a very interesting structure. It's being used a great deal, somewhat stealthily, but I think one we're going to see more and more, especially as with tax rates, if they do increase, a lot of 1031 activity, there's going to be even more 1031 money sloshing around in the marketplace. And, this could be put down in the bag of tricks of some way to capture that market.
Oh, for sure. There are large funds right now going under the structure just to capture 1031 dollars, just to attract that investment right now. We have a number of clients looking at it.
Yeah, so this will be interesting. So this is, what are the emerging alternative investment structures out there? For those of you who stuck around to listen to Tax Guys late on a Thursday afternoon, we appreciate it. So here's your key takeaway. But Jim, you're knee deep in opportunity zones. That's something where I'm fortunate enough at the firm that we have a whole group of people other than me that have formed our opportunity zone working group out of our Kansas City and Dallas office. But you're right in the front line. So why don't you walk us through some opportunity zone basics and really what the deferral opportunity is, because there's really two opportunities and the second one's better than the first.
Yes, it is. The second one is way better than the first. I remember when opportunity zones came out and they said, wait, what? I get to permanently defer my tax on the appreciation of the investment. To me, that is the ultimate opportunity to do that, because many of you who are investors and developers out there, when you pay the tax, it's really hard to earn that money back when you pay that tax. And so when this came out, we had a number of clients, looking at this, and we still do. You and I talked earlier today that we're super busy in the opportunity zone space, and you said you were too, and I know you are. And we're seeing clients doing a lot of deals, and we're certainly helping them with them. So if now, and we've also looked at these for people that can't do a 1031 for one reason or another, it's just not going to work for them. they can't find the replacement property. They're in a partnership and they can't agree amongst themselves. Do they want to do a trade or not? We're not big proponents of the drop and swap. I personally don't think I've ever done one. So you don't have to answer that.
I won't.
And so, so to us, we've had a number of clients go into the, into qualified opportunity zones, where they're just looking to place those dollars either because they found a really good real estate investment, and that's of course the reason why you want to do it. Or I've actually had a couple of clients that were hell bent on not paying any tax to the government and just threw it into a fund. But it is still a very viable opportunity to not pay tax. As far as a deferral on the first benefit, on deferring the tax over a period of years, that's gone down, and that's going to be going away here. So the permanent deferral is really the reason why I suggest that you do it. Now, not all states go along with that, so you have to understand, what's going on in your state, and there's some other issues that you need to look at when going into it. What's your leverage look like? I mean, what is the deferral worth it or not? But generally speaking, we're having a number of clients do it.
And what's interesting about the permanent deferral, it's a 10-year holding period.
Yep.
But you can go from one opportunity zone investment, have that be sold, and roll that gain into another opportunity zone investment as long as you hit that cumulative 10-year period. So it's not necessarily a 10-year hold in one piece of real estate or one project. It's a cumulative 10-year hold, which I think is something that most people don't understand. They focus on that 10 years. How can I own something for 10 years? So it's more flexible than I think this opportunity has credit for.
Oh, yeah, absolutely. We are working with a client now. It's a $42 million multifamily opportunity zone thing that they developed, put it up, ready to go, and they've held it for a couple of years now or so, and they got an offer that they can't refuse. They're going to sell it, and they're going to roll it into another opportunity zone. But yes, you can certainly do that, and as long as they keep doing that or meet that 10-year holding period, they will certainly benefit from that.
Good. So the last topic we want to hit quickly before we go to questions is the UPREIT structure. And back, as we know from our luncheon panel, one of Biden's original proposals was to significantly curtail 1031. So with that, and I don't know why all of my California clients, they must have gone to the same cocktail party. They all called me the same week, tell me about this UPREIT structure, this 721 structure. This guy's telling me that instead of doing a 1031, I can contribute the property, into a partnership owned by a REIT and not pay any tax. And, I sort of paused and says, well, that's chapter 1. He's like, well, what do you mean? It's like, well, you're going to get, special allocations that's going to undo that deferral. If the REIT were to sell your property within 7 years, that's going to undo your deferral, and you can't do a subsequent like-kind exchange out. So when you sell your interest in the REIT, you're paying all of that capital gain that hasn't been previously recognized. Also, there's opportunities that any sort of refinancings within the REIT can cause you to have phantom gain. So, generally speaking, when we do UPREITs on an institutional level, there's a tax protection agreement that's entered into. And then I sort of paused as they digest that and said, well, when this guy was pitching you on it, what did they say was in their tax protection agreement? How long did it go out? Did it go 3 years, 5 years, 7 years? Paused on the end of the phone. Well, he didn't even offer one. I'm like, well, there you go. So, as far as, for the institutional people, everyone's all over this UPREIT structure. There's highly negotiated tax protection agreements, for your 1031 seller who's, hitting the home run and walking away with a big gain. This is an incredibly complex tax structure that they're stepping into that doesn't result in permanent deferral.
Oh, I agree. And the more institutional type REIT that you have, or publicly traded REIT, the ability to negotiate and get some of those things that you need to protect your tax position are essentially non-existent. That's been my experience with clients. If you can find a private REIT or one that's not traded, you may be able to negotiate with them, kind of cut a special deal on your protection and your debt allocation and refinancing. So, we've tried to steer clients more towards that type of REIT structure. So we can protect their, downside in the future. But yes, 721 transactions is a tax deferral transaction. But like Ed said, there's just all sorts of traps in there that just may come back to bite you.
So I think that covered our topics at hand. It's 10 to 3. I know it's getting late in the day. You guys started really early. Any questions from the audience? Any questions from the Whiffley table?
Katie, how do we do, Katie? Okay.
All right. Well, we'll wrap that up. Give you guys a little 10 minutes back to your day, but appreciate your time and really enjoyed being part of this panel. So thank you for having me.
Thank you very much.